I'm here outside of Wall Street to bring you the education that's been locked inside those walls for decades. Generations of knowledge that was almost lost will be brought to light. Welcome to the Wall Street Collective, brought to you by the Daily Traders. Let's pick up where Wall Street left off.
Hi, everybody. This is Chris Cady. I'm here with Jack and Mark and Steve Hawkins, the number 2 authority in the world on market profile. And he's here to give us an introductory to advanced beginner segment on the basics of market profile. And think about it this way. It's a way of displaying data that allows the market to segment itself in a way that is what we would call an organic way. The market self-defines itself. We're not imposing anything on that. And so without further ado, we're very honored to have Mr. Steve Hawkins. He's currently in Chicago, Illinois right now.
Right. Well, thanks a lot, Chris. I appreciate the opportunity, Jack and Mark, to participate in your event. What I want to really start with is just kind of the nuts and bolts of market profile. I think it's important for the students to understand that this trajectory that's going to make them successful and get them to the point where they can own a place in the Hamptons or the Lambo or whatever they want in their life. They really need to put in the homework. Just like whatever vocation you're pursuing. If you want to become an accountant, you go to university. If you want to become an electrician, you go to trade school. Trading is no different. Obviously, there's lots and lots of successful people we all hear about making money trading, but that's the 1%. And to get them to that level, they've really had to work hard to get to that. And I think the most beneficial thing of market profile is it really allows for you to build an education, a platform to work from. And what I want to do for you today is kind of work through the process of understanding the real basics of what a profile is. So what you have on the screen here is a market profile display. I can have jump back in and bring my friend Chris back into the foray here, and he can tell you a minute or two of the history of our profile with Peter Stottlemyre and the development of it. Can you do that for us, Chris?
Sure. I first became aware of market profile about the beginning of the internet, but the profile was created by Pete Stottlemyre, who is a grain trader in Chicago, and he was asked by a guy who ran a clearing firm to create a new way to help the people on the floor look at prices from a different perspective. And it's evolved over time. I mean, as you can see, its basic distribution is a standard bell curve, and the people using it were allowed to see the way the market traded using both time and price. A regular bar chart won't necessarily show you how much time is spent at a particular price. And that's the advantage of the profile. We can talk about how prices are accepted or not accepted, or if they've spent a lot of time there. Anyway, so it originally came from the Board of Trade in Chicago, where they traded grains since the 1800s, I think, right, Steve?
Yep, I think in the mid-1800s, correct.
And market profile was probably created in with around the creation of the bond market, I would say, which had to be in the early 1980s or the late 70s. Is that right, Steve?
Yeah. I think the first profile probably put out by the Board of Trade was early 80s, 81, 82, 83. I don't remember the exact year.
And so this is way before computers and the internet, and so it was all done on paper. Is that right? That's right, Steve, right? It had to be done on paper, right?
Yeah, you remember all the locals would create the little profiles on the back of their trading cards. That was pretty common back then once it started getting some traction.
And so it's obviously it stood the test of time. It allows you now, especially with 24-hour markets, it allows you to understand what happened in the market while you were sleeping. It tells a much better story once you're aware of what each shape or lack of shape is really meaning or is trying to tell you. It's important that the idea of profile is offers you a potential to get insight in a way that other types of data segment displays, whether they're trend lines or moving averages, can't do. Market profile is a wonderful tool. It is necessary to understand structure and the background of the market, which is important to understand if you're participating in the present moment.
Right. Yeah, it's a good explanation. I think understand that what we're working with as far as the basic profile concepts and trying to understand the construction of a profile is what I want to do today. We're going to the progression, understand we're working with a progression. The progression is understanding the shapes as Chris mentioned, the background and the foreground, but all things that are more advanced. We're really working on the 101 today. So, I think it's important to understand what is a profile. It's a data organizational tool. A bar chart, people look at bar charts, they integrate trend lines, stochastics, moving averages. What is that? Just think how difficult it would be if you're just watching a ticker, all the prices going by. Why people develop these tools is a way to organize data. So that's the whole purpose of what is the profile. And actually, Les Rosenthal was the head of the director of the exchange when he approached Pete and asked him to, we want to generate more order flow from off the floor. Can you help us do something? So Pete came up with the statistical bell curve. You might remember that from your stats classes, the Gaussian distribution, just ways to organize data. So if you can move on to the next slide.
Sure.
We can.
So for everybody watching, Pete Stottlemyre was the creator of Market Profile. He's still alive, and Steve has been with him as his number two guy or his partner for, I would say, I've known of it for 40 years almost.
Yeah.
Right?
Yep. Yeah. Started working with him out of university indirectly, and then the late 80s, and then got back involved with him early 90s, and that's when we started developing higher level market profile software. But so I've been kind of on the path with him for majority of the whole profile evolution. So as you can read right there, what is a profile? I mean, it's nothing more than the standard legacy profile is a 30-minute profile. So the difference between a bar chart, a 30-minute bar chart, and a market profile, the first difference would be that we're assigning letters to the range of the bar, and that's going to be the first difference. And I think, today, a lot of people are going to use a different resolution. So instead of having a half-hour input, they might have a 5-minute input or a 30-minute input or anything in between to create their profiles. But the whole purpose of the profile is to organize the data into a way that one can understand it and conceptualize it and work from it. I always like to say that a profile gives you a visual representation of what's happening in the pit. Chris can attest to the activity in the pit and the difficulty of trying to organize that data. And I think that the profile gives one a good visual representation of where prices are accepted, where they're rejected. I don't know if Chris wants to touch on anything.
Well, yeah, Steve. When we first started learning from Pete Stottlemyre, he said the very first thing he said in 1991 at the NYMEX, he says how you segment data is going to be the key to the future of trading. He was worried about the markets going 24 hours and us having to sleep, and then we needed to be. Pete was always talking about how to be in step with the market, right? And so, So the difference here with the profiles is that you can start and stop your data collection at a particular point that maybe you can't do with a bar chart, which is automatically segmenting data based on the clock.
Right. And also you recall back then, I think since my involvement with trading, I can recall when I first started trading the bonds, I'll just use the bonds as an example. They first started trading from 8 a.m. to 2 p.m. Then they opened, 40 minutes earlier, 7:20. So you could address the economic numbers come out to 2, then 7:20 to 4. Then you had a night session, from 8 till midnight or 1 or 2. I forgot exactly when it ran to. And then as Chris mentioned, we're now trading. A lot of markets are open, 24 hours, less an hour or two, just for the clearing firms to clear out the queue and reset all of their hardware. So I think, the whole understanding, first of all, of the profile, the organization of the data, then secondly, the participants. I think Chris can attest to that also way back when he first started. The liquidity was on the floor, as we call it. So all the deep pockets, the locals could take any order. Later on, the late 80s, 90s, whenever you got all the funds involved in the marketplace and you got the liquidity moved off the floor. So I think the whole way of organizing data, understanding it, moving from the trading pit or the markets being a day trading vehicle to something beyond that is also well addressed within the profile. And as Chris mentioned, the ability to organize it, self-organize it, segment it based upon the time zone, Asia, Europe, US, or whatever one feels is beneficial to their trading.
One of your favorite just a quick aside, one of your favorite setups is when people are caught off sides
Right.
in the profile, right? Like that's perhaps something that's easier to see in the profile than it would be on a bar chart. But we digress anyway. We digress, right? Hey, do you guys have any questions yet, right? Other than
I'm excited to move forward and talk about the actual formations of the profiles and what they mean, dissecting that. But going back to the models, Pete Stottlemyre said in 1991 about how the future of trading is how that data is portrayed to us. And it's true. It's like if we, try trading off a line chart, and as traders, our job is to react to the market. So how that data is segmented is wildly important to our interpretation, how we're actually going to act on that and make trading decisions.
Yes. Great. Yes.
So here is the next chart. Yes, it's nothing more than displaying the same amount of data with letters versus the bars, and that's all. This usefulness of this is I just kind of just put this out here just so you can see that you're seeing different letters, and if that was blown up and you could see them clearly, you would see that they're chronological letters of the alphabet. We're skipping a couple just for whatever reason. And then you go from, obviously, there's 24 hours in a day. There's only 26 letters in the alphabet, so we use uppercase, lowercase. But that's just the whole purpose of this letter, of this screen, is just understand that these bars are represented by letters. And we can move on to the next slide.
Hey, Steve, people always ask if A is 8 in the morning or something like that, and B is 8:30, and C is 9 o'clock, and D. Do they change, or are they always represented?
No, you'll find that the board of trade, as I mentioned, own the rights to the profile, and so everyone who uses a profile display, i.e. a Bloomberg or an eSignal, a CQG, whatever, they should pay some type of royalties to the board of trade, and there are entities that have worked around that by using characters like stars and different things beyond the letters of the alphabet. But beyond that, it is consistent. Board of Trade's in Chicago. The profile is built in Chicago, so we use the letter B as in boy. For 8:30 Chicago time to start out. As Chris mentioned, A would be 8 to 8:30. B would be 8:30 to 9. 8:30 is when the stock market opens. So going forward from that, you're just continuing building, consecutive letters referencing the half-hour periods. Then you get the night session, you get the market closing, you get the market opening an hour later. Then you continue the whole process of adding some upper letters, and you get to the end of the alphabet. Then you rotate into the lower letters of the lowercase letters of the alphabet.
Thank you.
And that's a good segue into the next. Here we are.
All right, there you go. Right. It's so strange that for years people have asked that question. Do the letters change?
Yeah. I mean, some people would think, as you said, just the time zone, right? We're changing the clocks this weekend, right? So does that change anything? No, it does not. It's always going to be referenced the same. So that's a good question. And as you can see, the outer letters of the circle, those are the uppercase, and just kind of the progression is Chris mentioned 8 a.m. Chicago time, 8 to 8:30, then be 8:30 to 9, and so on and so on. So that's whatever it's worth. That is meaningful information, because I think that's one of the big benefits or one of the many benefits of the profile is if you read the book, and I'm not trying to sell my book, but the idiosyncrasies of the market, there's tendencies for markets to put an extreme during a certain time of the day. So I could tell you that, and Chris can attest to the stock market. I mean, there's about a 70% chance that the opening half hour is going to be a higher low of the day. You can look at the same thing in the energy. That's going to be H period. That's between as you can see on the clock right there, 11:30 to 12, and in the grains it's going to be F period. 10:30 to 11. So if you really have an axe to grind and want to put a trade on, and you have an opinion or a bias, you can lean against those times of the day to try to initiate a position. So that's something that if you weren't able to view something with letters, you would never kind of see that relationship or that likelihood of that.
Interesting. Yeah, I read your book, and I was gonna touch on how I see. Correct me if I'm wrong, but I view the shape and looking at the minus and positive development, we'll get into later in this lesson, to be more important than the actual letters themselves.
Of course, right? Yeah, the letters just are. It's almost a curiosity that people are wanting to know about the letters, which is why it just saves us having to answer the question in the future. But to your point, yeah, it's all about the shape, huh?
Yeah, yeah, for sure, it's a shape. Yeah, it's just and I think there's pattern recognition, lots of things out there that one can integrate into using profile to help them understand the likelihood of the market, moving sideways, vertically up, vertically down. So here, just to continue along the process of what is a profile. So you notice I grabbed some bars and on the previous two charts, and then we converted those to letters, and those same letters or the range of the letters are now referenced with that orange box, and they're now displayed in daily profiles. As you can see, across the bottom of the page, you're going to see individual dates, and that's a 24-hour profile. So, all the letters of the alphabet are kind of covered. You can kind of see what stands out within these. As you're going to see fat parts, you're going to see pockets, lack of letters. You're going to see ranges. You're going to see just kind of a potpourri of different patterns to look at. And does that mean anything to an experienced eye like Chris or myself? Of course it does, but to someone who doesn't have any understanding of profile, it doesn't mean an awful lot. So that's part of the reason that we evolved to what we call the time variable profile. So we can jump on to the next screen. Yeah, so this is kind of getting back to what is a profile, the Gaussian distribution, the whole idea of statistics classes, the first, second, third standard deviation, going through stats class, ways to organize data, anything and everything, from the height of something to the cost of something to just kind of a good visual. So I think, seeing here what, in profile, the legacy profile we would look at value areas. So that's the first standard deviation. So that would be 68% of the data. Then the first and second would be 95, and the first, second, and third would be 99. So just the purpose of this slide is just to convey to the profile user that the whole foundation of a profile is based upon the Gaussian distribution. So, flipping that display of a Gaussian distribution, 90 degrees clockwise, and it's going to generate what is a profile. So, that's the purpose of this, is just to kind of understand that the profile is generated from statistical contribution.
Okay, cool.
Toggle back and forth and just notice, that's what's encompassed within that orange box is three profiles, right?
Yep.
So now jump forward to the next one with the time variable profile. What does the time variable profile do for us? Is it takes the chronological daily profile and segments it based upon volatility. So we're looking for a minimum amount of data to build out. I just kind of say it's a container. We're building a container of something. Once the thing gets full to the top, we're looking back at something. What is the vertical range of a set that it's the user defined? Once that is violated, we're going to segment the data. But if that is not violated, you're going to continue to build that data mass larger and larger and larger until it does finally violate the range of the most recent chunk of data and then segment. So, what you can see by looking at these, and if you could make the font really, really small and see how many letters are in each of the profiles, that they are very varying. So, we can see in this profile display, you're seeing, essentially every letter of the alphabet. It's running from 12 in the morning to 12 in the morning is essentially what you're seeing in this profile. Now, if you jump into to the next screen, you're going to see that, we see different letters of the alphabet. Once again, we've gone over what those letters represent. We can kind of see the progression of the market from the upper left, the top of the box. It builds, starts trading lower. You get something down at the bottom. You have a spike low. It bounces back up. Get lots of letters across the top of it. What does that tell you? That the market is accepting those prices. Then it continues to grind higher. So you kind of did a round turn from the top down to the bottom and back up to the top. And it's just a much clearer picture of what one would look at. And looking at the profile, you look at this, and there's a degree of clarity, I believe. Then you go back to the previous screen, and you're looking at the same amount of data. And in those three profiles, and I don't think you can read it as clearly. So, I think that's something that we've started building, or I think we created the idea of the time variable profile. Actually, we started the whole idea early on with the software. I would say in the early 90s, we just understood that the the market was really moving away from day trading. We understood that we use the term the minimum trend. There's little imbalances coming in the market. If you look at like I always like to use crude as an example. Crude, if you look at a crude chart, you know that it traded negative $40, we'll say, to $140. So that's $180 range. So in that $180 range, you're not going to be able to sell the high and buy the low in anyone's lifetime, probably. So you really have to kind of break it down into all the little micro moves within that bigger picture. And I think looking at the profile allows for you to see this puzzle, built out, and the little moves in between, and the pushes up and the breaks back down, and then kind of put that all into context with what's happening, like in this orange box, which is kind of more the foreground or the shorter term perspective. And then, just like everyone trades, when anyone who trades with, they're looking at a bar chart, whatever they're working with, they're going to be looking at something that is going to have kind of a foreground background perspective. So just really trying to understand things in the context of what is the bigger picture versus what is the more immediate perspective.
Oh, so Stephen, that's the idea. I think we're trying to give the people who are watching a first sort of how to approach profile. The first, in a sense, trading is solving a puzzle, and this is one of the keys to solving the puzzle. And so when the person first lays eyes on a profile, is the job to understand the shape? Is the job to understand how the background fits with the foreground? Is the job to see where people want to buy and see where people want to sell? Or is there a priority? In other words, someone's just looking at profile, they're a new student and they're looking at it for the first time. And you've got to say, what do we tell them? We say,
yeah, okay. That's good. I think maybe the next slide might address that a wee bit if we move on to the next slide.
I just want to interrupt this episode to give you guys a special opportunity. Now, I'm actually going to be trading live every single morning. If you want to sit over my shoulder, watch me enter and exit trades, and put this system into practice, I'll put a link in the description below, and I hope to see you over there.
So, like, for example, this profile right here, like there's, I don't know, probably only 30 prints. And then you go to, this profile, and then there's probably 100 prints. So when does a market classify as, okay, this profile is complete, I'm going to move on to the next one?
Yeah, well, that's kind of the difference. That's why we've kind of evolved to a time variable profile. This is a daily profile.
Yeah.
So, every profile here is a 24-hour trading, and so obviously some have big days, right, and some have very small days. So that's what you're seeing there. So the range of the profile is the range for that 24-hour period. And then, if you look at a time variable profile, so if you go back to the previous screen, we once again, the orange box, if you recall, and you even go back one more screen if you want. So so there's 3 days of trade, right? So that's 3 24-hour periods of trade, and that's the gold. So you can kind of see that I'm trying to see the prices on the right side. So they're $20, $30 ranges each of those days. They're pretty much the same range. You're seeing so the 1734 down to now drag it a little because now you remove the price. Okay, it's the 1712. So you're $22 one profile, then 17 down to 60. Yeah, so 22, 20, and so each of those days are kind of what we would call parallel. So you're kind of having similar ranges. So a lot of people look at average daily ranges, right? So I think what you're seeing here is you're just seeing, the profile organizing itself, with the different letters, and that's the way the old profile was. And reading that book, from the Board of Trade, it'll give you some nuances and things that you can look at within the old legacy profile that I think are still useful. But I think the new way of looking at it with the time variable profile is offers much more clarity. So if you move on to the next screen, this once again is 3 days of profiles, but we're breaking this profile down into what do we have here? 7, 1, 2, 3, 4, 5, 6, 7. We have 9 profiles. Is that right? Or 8? 1, 2, 3, 4, 5, 6. Yeah. So 3 days is being broken down into 8 little different segments, and what causes the segmentation is amassing an amount of data. So for us, a time variable profile, we're saying we want to make each profile be X amount of time minimal. But if you are getting a situation where the market is kind of building upon itself and not expanding a range, we're going to make a bigger and bigger and bigger profile. Okay. And then once the market does expand outside of what we define as a range, it's going to segment. So, this is really kind of showing what the time variable profile shows us is the market getting some degree of imbalance, which causes a segmentation and a push, and then achieving balance, and then segmenting again once you get some type of a push. So, that's what you're seeing here is you're going to have a tendency, like I said before, you're going to have a tendency for the market to move away from the fat part or the point of control of a profile. And if you look at the rightmost profile in that orange box, you can kind of see how the bottom of that profile lines up against the widest letter in the previous profile, correct?
Yeah.
And then if you'd move down one below that, you can kind of see the same thing. That J period comes out of the fattest part of that little squat profile. Then the next profile down, the profile that's absolute bottom, you can see that little profile moves out of the fat point of that, and then the fat big profile with the bottom, it kind of moves out of the fat point of the previous profile. So, once again, it just kind of lines up or syncs up with our whole idea of markets moving from balance, and then gets efficient, and then it moves away from there.
Yeah, you see that? How it goes from here's the fat part, moves vertical, here's the fat part, moves vertical, here's the fat part, moves vertical. Okay, that makes sense. And these are inputs that you're putting into the CatFlow technology, like every, I can't.
Yes. So we're saying, you're building a database, right? So your database, transcends the contract. So I'm looking at 50 different markets and, standardized inputs as far as, what is a segmentation algorithm. But, so it's each contract I'm going to pull up is going to have a segmentation algorithm that's going to create some type of an output like this. And, I think a person could trade just a segmentation every time, if a person would, you trade a stock and then you're going to follow, 10 stocks and, you create a segmentation algorithm, and you put every time the market breaks out of the range of what was balanced and it starts creating a new profile, you just put on a trade to try to buy it or try to sell it, with the idea it's going to have some degree of continuation with a relatively tight stop. And so, like I said, in this example here, the 4 profiles, the 5 profiles on the right-hand side, each and every one of those were pretty clean, I think. So I think, once again, that just kind of confirms that, markets do trade, from some degree of balance to imbalance, and one's ability to trade that. And obviously the profile is, a wonderful tool to organize it and kind of convey that visual to the trader.
Interesting. Okay, cool. Well, and then last little thing is the highlighted letters. Is that something for later, or what are?
Yeah, that's kind of later stuff. It's much more advanced. So we don't want to get people lost now while we're trying to give them basic stuff. So, we all understand, or you've been in the market for a while. You understand, what is the purpose of a market. And then I think what we need to do within Profile is we need to kind of understand, that the markets are in price discovery, right? You go in the pit, way back when there was a pit, Chris can explain the whole auction process. We don't need to get into that too much detail, but just, the bell rings, people want to buy, people want to sell, locals have to fade the order flow, market sets a price too high to shut off the buying, then it sets a price too low to shut off the selling, then it moves to more balance. And then is there something that external to the market that comes in to move it away from what is balance, or is the market just going to jab around and trade sideways? So, I think, from, when you're on the floor, just like a person off the floor, I think that the fact that I think today, my feelings are that a person really needs to extend their time frame a wee bit trading off the floor versus when you're on the floor, just because of, the cost of doing business, access to information, things like that. But I think the first thing that one needs to try to understand, is what is the flow you're looking at in both the immediate time frame versus the longer term time frame. So when I try to come to a trading decision, what I'm always going to do is look at what is the background. I want to understand what is the bigger picture. So, I think that if we'll talk about our stock market, as I recall, our stock market put a high in during the first couple weeks of the year, right? Then did we put a low in? Chris, better than I was. A couple weeks ago we put a low in, or when was the low put in? So it's 9 months down the road, right?
Yeah, these guys know it as well. It was 34.80, something like that, not long ago.
So
I can If I can, yeah, the low in the SPY is right above right below 350. So it was 34.87 was in the actual S&P cash.
Okay. Yeah. So for me, like, and just kind of, playing it from my recall. I mean, obviously the market crashed in 08, 09. Then the market had a nice rally. Then we had the COVID crash, right? Then we rallied strong off of that. And so now we're breaking again. So, that's what is the trend? The forever highs we were put in 9 months ago, right? The beginning of this year. So you can't say the market is anything but in the macro, it's in an uptrend. In the more intermediate, which I'll say is beginning of the year, the market's in a downtrend. Now the market's trying to bounce. You put in the low, you had a decent rally, you've had a decent break, you're trying to hold in. So you're at a decision point. I think if the market takes out the lows we saw a couple weeks ago, it's going to get slammed again. But, the fact that the market, if it can hold, what's the current levels, and there's a chance for it to, if we can get past the elections. And, I'm a sentiment guy too. I mean, I always like to gauge what is the sentiment. I think, that's the one thing that, Pete's always instilled into me is, he's got a saying, what's more important than what does happen is what doesn't. So if you got a bullish grain report, and the market is, we'll go back to, 20 years ago, when the grain reports would come out before the market opened. So you get a bullish grain report, they're calling the market up 20 cents. You go down the floor half hour before it opened, it's called up 10 cents. The market opens up unchanged. And what happens? They're going to get crushed. Why is it crushed? Because everyone was long the market. So, I think we're in an environment now where you're looking at everything with interest rates and inflation and everything going on politically and the war. And, everyone is obviously bared up on the market. You can't find a lot of great reasons to be long. So, is there anyone left to sell the market? Maybe. But, their likelihood or the chance of a short covering rally is great. So I think, it's a lot of things I'm throwing out, but I think that's what trading is. It's just kind of, we as traders have to take in information and process it. And, all of us have different experiences, knowledges, understanding, life experiences are going to influence how we interpret things. So, for me, like I said, I'm always looking at the background, understanding that relative to the intermediate or the foreground, and then, which one is going to win out. Is the background going to overcome the foreground are going to overcome the background, or something in between. So I think that's how I look at the market. And I think the profile helps us, looking at this screen right here, we can look at where, and these, you can see these are daily bars actually. So, trying the green arrows try to, reference where we can see the market has a strong move directionally. So we can see the green arrows pushing up and the red arrows pushing down, and just the auction that one is going to always see is you're going to see that type of a dynamic, the market pushing one direction and it's going to stall out, it's going to push another direction and stall out, and it's going to then move to efficiency. So I think the profile kind of gives a good visual of that.
And so is the shape a distinctive tell?
I think if you understand what is the shape, why are you getting lots of letters across a profile, is because the buyers and sellers are matching up, right? So if you're going to push high, you're going to push low, and then people are going to then have a low to buy against, a high to sell against, and it's going to become more and more balanced, more and more efficient. And once the market becomes efficient, there's people are going to lose interest, right? If I'm not going to be too interested in trading the S&Ps if they're trading in a 5-6 point range, right? I mean, it's hard to sell the top of the 5 point range and buy the bottom. So you're going to miss that, and maybe you're likely to make a couple points. And if you're wrong, then you're going to get your head handed to you. So I think understanding when a market moves to efficiency or balance is in a profile, you want to try to see that, because not so much in here, but there is to a degree here, but you're going to notice that there's a tendency for markets to move out of where the market is balanced. So the fat part, or the point of control, or the mode of the profile, is going to be where most trade occurred at, and there's going to be a tendency for the market to move away from that.
Yeah,
so
Chris, we were talking about with Chris, looking for the tail, looking for the single prints. We spent actually, I think, a whole lesson talking about this, and being able to figure out when the direction. So, for example, as a single print, my eyes are actually really bad. The G, is that a G? I can't tell. So
that's a G, correct?
So you're looking for the tail on the G. This closed out the direction, looking for a close of that direction.
So you talked about how you made I really like the analogy of kind of like the jar filling up to where a profile is complete. We talked about, Chris, I think this was like lesson 1 or 2. We talked about, I forgot the basic math equation where it's like A has to be greater than B.
Oh, we were talking about how we decide mathematically if the market's balanced and ready for a vertical move.
Is that when a profile is closed off?
Yeah, I mean, that's kind of the whole price discovery mechanism. Like if you look at all these profiles, I would say that the ones that have the bigger vertical bars are the ones that aren't closed off because they're trying to still probe. Like if you look at the green, the first green one is a wide range, and then the second one continues in that direction, and then you get the hard reversal. So I think what I'm always trying to look for, and I think if you would, looking at, we'll grab the one with the big, the big red vertical arrow on it. So what I always like to look at, and guys, it's going to be hard to understand, but Chris can relate to it. But you can see that the K, I, J, K, L, M, those are kind of all that little note up there. Then you see the M as in Mary. That's the where the market starts pushing lower and then kind of comes out of the middle, and then it pushes lower, and then the QR, and you get all those letters building sideways like that. Then you get the Y pushing lower. So you're going to see the whole market going from balance to imbalance, and it kind of, you see that progression. And so that's what I'm always looking for, even though, you're getting these nodes or pockets of balance, it's going to go from balance. So, you look at the profile, this absolute top, and it's obviously traded to a price too high to shut off the buying. And then people look at it, I'm long from, the gold at 100 or crude at $140 a barrel. That's no good. And so you're going to, even though the market's in an uptrend, it's going to come off a bit and it's going to build a balance area again. I'm long from crude from $120, and it's typically traded between $40 and $100. So it's still expensive, and it's going to kind of continue that progression down until it gets to an area where then the bigger percent of the populace accepts it as a fair price. And that's when you're going to see the market build more horizontal, more letters across, and then eventually shut off a direction. So I think for me, I'm always trying to understand that, a profile, like we use the term a puzzle, when you're building something, and you're going to see this thing kind of moving back and forth, trying to find where is fair, and then what's going to move it out, and what is fair is going to be some news-related event. It could be, something political. It could be something fundamental. It could be a grain report, a payroll report, anything like that. But, I think that people, the purpose of a market, first of all, is to hedge. So, I mean, the biggest percentage of, or there is a purpose of all these markets. You got people with stock portfolios. You have, people generating loans for homes. You have people growing stuff. You have people mining stuff. And so, those people all have a view of what is a good price for them to purchase something at or sell something at, right? So, that's a big part of what is involved in the market. And all of us, creating liquidity in the market, or we're just trying to trade, speculate. We're trying to trade to make money. Others are trying to trade or need to trade to run their business.
Interesting. Yeah. Knowing the actors in the market.
I gotta go. I have to go. I gotta sign my returns.
You're good, Chris.
Yeah, all good. Well,
yeah, keep going, Stephen. You're doing great.
Yeah.
And you guys, do you hear the difference between about how when I was describing a high as so many people want to sell it that it moves away from there quickly, and hear how Stephen describes it as it shuts off buying?
Yeah, I like that.
Isn't that cool?
Yeah.
I was like, that's really cool.
Yeah.
Like, think of that, right? Like, it's a totally different way to describe the same aspect of a tail.
Yeah.
Yeah. Okay. Well,
all right.
You guys keep going.
Thank you, Chris.
Yeah. I'll talk to you guys later.
All right.
okay,
bye.
awesome.
Bye.
The Gaussian distribution or symmetrical distribution, is the standard, but they're skewed. You can have a negative skewed or a positive skew. I mean, in our vernacular, we talk about, something that has the tail. So the tail would be where is less trade. So if we would have something that would be like on the bottom of the screen down there, a 3, 2, 1 down. So, the third standard deviation, if you recall from the previous slide, that's where there's less data. The most data would be in the first standard deviation, right? So if you line your cursor up with if you go back to the one slide with the profile and the Gaussian distribution, just one back to one more down. Yeah, that one. So so you can see the leftmost, the Gaussian distribution. You see where you have 34 and 34. So that in the middle, the absolute middle. Yeah. So that would be the first, and we call that those two combined. So you find the mode, the widest point, the most common point, and then you they look for 30%, 34% of the data on either side of that. That's going to generate 60% of your data points. And so that's what we would call the first standard deviation. Then if you go on and want to view what is the first and second, then you're going to add another, 13 and a half and 13 and a half, so 27%. So that's going to generate 95% of the data. Then the other two tails, which is the third standard deviation, that's going to add you up to about 99% of the data. So the tails, or the third standard deviation, is going to be where you're down there at the 2.3%. So that's going to be the skinny part, right?
Yeah.
And the first standard deviation is going to be the fattest part of the profile. So if you move on to the next screen, which I'm going to have to fix, as you can see, it's not 180, it's 90. But so the tail, which is going to be the skinny part of the profile. So up above, if you just look at the positive skew and the negative skew. So if you can kind of visualize where the lots of, if you just kind of said where's the most of the data, it's on the blue one, it's on the left hand side of that profile, right? So this third standard deviation would be where less data is traded, so that's the tail, and the first and second standard deviation is going to be on the left half of that profile, correct? And then the opposite would be the orange one, as you're pointing to. The first and second standard deviation is going to be on the right side of that profile, and the third is going to be on the left. So, moving down the cursor all the way down to the bottom of the screen, where we have the 3, 2, 1 down. On the left-hand side, why do we call it a 3, 2, 1 down? Because the tail, or the skinny part, is up on the top of the profile, right? If you move your cursor up, all know that where the profile is, right there. So that the fat part is at the bottom, so that's the first standard deviation, and that the 3 and the 2 are on the upside. And then you move to the middle display, the 313. We call that a 313 because the first standard deviation is in the middle of the range, and then the second and third is on either extreme, correct? It's symmetrical. Mm-hmm. And then the rightmost one, we call that a 3, 2, 1 up, because in this case, the third standard deviation, or the lack of trade, is at the bottom. That's the third standard deviation. Then the second and the first are on the top. So that's visually, every profile should fall into that category to some degree, something which is balanced, which is in the middle, or something that has a positive skew, which is on the right-hand side, a 3, 2, 1 up, or something that has a negative skew, which is a 3, 2, 1 down, which is on the left-hand side. So that's how we like to organize and kind of convey, we're talking about a picture, right? So we want people to have clarity in the picture, and I feel this is a good way to convey the clarity of the picture. And the output from looking at this is conceptually, if you have a 3, 2, 1 down, that's a selling imbalance. So there should be a tendency for the subsequent price action or the near-term price action to continue down. If you have a 3, 1, 3, it's kind of really more of a balanced situation. It really doesn't have a direction. If you're going to want to try to trade something that's balanced, you want to be kind of buying low and selling high. And if you have something which is on the right-hand side, which is a 3, 2, 1 up, the idea being that has a buying imbalance, so you should have a tendency for the market to trade higher. So you want to be trying to play that market from the long side.
Okay, can we look at, say this, whether it's a 3, 2, 1 up, or could you try to kind of point out to us?
First of all, that's a daily profile, so let's not look at that one. Let's look at ours. So there's our display. So that's kind of the time variable profile. Okay. So looking at those, you tell me. If you look at the bottom one, first of all, that one, based upon what we talked about, right? Whereas the first standard deviation is skewed towards the top, and the third is at the bottom. So that would be some form of a 3, 2, 1 to the upside, correct?
Yeah. That's within this single print?
Yep. Okay. Yep. Yeah, that single profile, correct.
So there.
And then you move one over to the right, that little one. Yeah, so that's a 3, 2, 1 up. And then that little one right there, that looks just kind of more balanced, right? That's kind of, you could, the little squat one to the left of that, one to the left of that. That one right there. So you have kind of the point of control in the middle. You have, it's not perfectly symmetrical. Nothing is perfect in life, right? But if I was going to have to categorize that as one of the three that we went over, I would say that would be more balanced. Okay.
Okay.
Like a 3-1-3. Then one over to the right of that. That's going to be the same situation where you got a tail. That's the third standard deviation where there's a lack of letters, right? And then as you're moving up higher over time, you're getting more and more letters. So you're getting a 3-2-1 to the upside, right?
Yeah.
And then similarly, one over to the right, you're kind of seeing the same thing, right? So you're getting a lack of letters at the bottom. You're getting more letters at the top. What does that tell me? That's a 3-2-1 to the upside. Okay. The one thing and the nice thing about, segueing into what are the letters, if you can see the letters there, you can see the beginning of the profile, Y, Z, A, B, C, D on that profile. And so, what is that? That's, 5 or 6 letters. So the first 3 hours of trade, the market tried to trade higher. But then if you look at F, G, H, I, J, K, L, M, all those letters came off and became more balanced. So understand that the tail end of any 3-2-1 is going to be a balanced situation. So there's can be a tendency for the market to move from balance to imbalance. So, this would be a situation that, based upon what I told you, a 3-2-1 up, the market should have upside, should try to trade higher. But this would be a situation where obviously the market did not trade higher, but we did have a little inkling of maybe why it wouldn't be able to trade higher, because the market kind of failed from that high price and moved to more of a balanced situation. And then from the balanced situation, the market did come off. But another thing on the profile, the rightmost profile in that orange box is, based upon what I said, if it is a 3-2-1, for me, that trade idea, I always want to be trying to enter a trade. What is a 3-2-1? It has a bias. It's giving me a direction to try to trade. And I think in trading, we always like to try to tell people they want to eliminate one side of the market. So you always want to be just trading the market from the long side or the short side for that day, not both sides. Yep. So for me, whenever I see a 3-2-1 up, like we have in this case, I always want to be trying to buy against the 2 of that. So I would say the 2 of that would be maybe the bottom of the green letter in that profile. So right in there would be the 2. So I would be trying to, even though the market kind of set back a bit, we do have that tail, the third standard deviation below us. So trying to buy against that third standard deviation. And, you have to ask yourself, why are there no letters or lack of letters there? That just because the buying overwhelmed the selling. We didn't build letters sideways to get letters like A, B, C, D opposite the Y and the Z, because there were not people willing to sell the market that cheaply. They said, if I want to sell, the market has to trade higher. So the idea being the people who bought creating that tail, that third standard deviation should be present when the market trades back to that level.
Okay. Wow. I mean, there's so much to dive into, but I think that was a great start in terms of introductory understanding. I mean, this lesson is so effective in helping people understand the theory that is market profile. I've noticed a huge difference, and
I've noticed saying to me today.
Yeah, I was saying today. It's like it's helped. I've used it more as like a context tool to help me understand where price is on the greater scale, and kind of telling and using that theory of when something is cheap or perceived as cheap or a low is in, people are gonna buy it fast. And same thing with a high, vice versa. Looking at the market and taking a step back and saying, okay, this is not the high of the day. I'm looking for some type of pullback, and like you said it, for the buying to be shut off and the selling to be shut off. So, I mean, there's so much to be grasped from market profile or volume profile, which is a good place to start for a lot of people who can't afford the proprietary software. But, we'll get into that. And I think today was a great start, and I'm looking forward to moving through this and advancing to more technical strategies using this.
It's important for them to have a good understanding, and I think a lot of people trading, they get ahead of themselves. I mean, obviously we all want to make money, but I think a lot of people, they don't put enough time into education, and I think it shows. I mean, there's a guy I'm working with now, he's early 30s, and he's made lots of money and lost lots of money, and he's trading. I think it's easy to understand or analyze the market with a profile, but then you have to overcome lots of demons, right? I mean, as far as, the psychological part of it, as well as your risk management. But, I do think if a person, the beauty of a profile is it kind of builds upon itself. So if you spend a year or 2 years or 5 years, I think you're always going to get better and better at reading the profile and reading the markets. Whereas I might not be able to so much say that if you're looking at a moving average, there's only so much information in a moving average that you can look at or other technicals like that. So I think this is, you can achieve a PhD level of trade understanding if you pursue the profile, but I don't think that's available in other markets. And, I'm partners with Stottlemyre, and we go to the likes of a Paul Tudor Jones or at big firms with big traders. And I think that Pete always likes to say I know more than all those guys as far as my market understanding, but my pocketbook doesn't tell me that. But I think for sure it can give you a good intellectual understanding of what is the auction, and I think that's the most important thing in trading is understanding what is the auction. And then, obviously, like I said, I kind of try to really mix in some other things like volume, which is a nice thing that our software provides that maybe others don't. But I think the volume component as well as the, what is the market sentiment. So that's obviously something that you can pick up real easily if you just have a Twitter account, right? You subscribe to a bunch of people and, you can do a bullish consensus with something like that.
Yeah, 100%. Well, yeah, that was great. I'm excited to move forward.
Yeah, this was awesome. Thank you so much, Steve.
Okay.
All right, that is going to conclude this first lesson in Steve's segment. All right, and we'll be back in the next one. Thank you, Steve, and thank you, everybody.
Okay.
All right.
Okay, great. Look forward to doing the next one. We'll be in touch and coordinate that.
Thank you. Awesome.
All right, thanks, Steve.
I just want to take a second to interrupt this episode. I hope you guys are learning stuff so far, but I do want to give you an opportunity. Now, I'm going to be trading every single morning. I'm going to be live. You're going to be able to sit and watch me enter and exit positions, executing the system that you're learning now. If that is of interest, I'll put a link in the description below.
Welcome back to the next segment. All right, this is the second segment on Market Profile. We're joined again by Steve and Chris. How's it going, guys?
Hey,
good.
Welcome aboard, everybody. This is going to be a good one.
I'm excited.
Yeah, we're getting a little more advanced this episode.
Yes, getting more advanced.
Right?
Steve.
Like everybody, we crave sophistication here.
Yeah.
Stephen, do markets or profiles, do they generally go vertical from the wide spot in the profile?
Oh, yeah. There's really a tendency. I mean, if you think about it, why is this the wide part? That's because that's for most of the work a lot of the participants are involved from. So if I'm short and you're long and the market starts working higher, then all the shorts, i.e., myself and everyone else on that side of the card is offsides. We got to kind of get out of our positions and maybe the people that see this market starting moving vertically, they can jump on board. So yeah, there's definitely a tendency for the market to move out of an area of we'll call the price control, or using, vernacular of, the market profile word, the point of control. In statistical terms, it's the modal point. So yeah, there's definitely a tendency for that to happen.
Okay.
And then if it moves from the wide spot, is the potential for the range to be expanded greater there, or we don't know when the potential for the range? We just know that the market's going to move from the balance point, right?
Yeah, what we can say about your question is that the less opportunity people have got to get involved, the greater the probability of a larger vertical move. So if 100 people want to be long this market and only 25 are getting in, so that means there's a lack of development, then that's going to have a greater chance for a larger vertical move. If everyone has a chance to buy, then who's going to buy later? There's not as great a likelihood of the market to have a bigger vertical move.
Like everybody's already at the party, or people would always say, why, you can't buy McDonald's stock. Why? Because there's a McDonald's on every corner already, right? They can't open more McDonald's. So the idea is that if people are caught off sides or no one's involved, then the potential for a larger vertical range is possible. But if everybody's had an opportunity to participate, then the potential for how should we say, because everybody's already at the party can't get bigger.
The whole idea of trading for volatility. I mean, I think some people kind of have the impression that they want to trade markets that are quiet and they can kind of trade around bigger positions and be in more control. But the best opportunities are when markets are moving, when there's bigger vertical moves. So I think trying to gravitate gravitate towards volatility, and that equates to the noise that you're talking about. Why is there noise? Because something new is happening, right? I mean, the market's making a new high or a new low, or some big orders are coming, and that's what's generating the noise. You're talking about physical noise, not screaming and yelling on the floor of the pit.
Yeah.
So then people should be looking to participate in places where there's volatility.
Yeah. And so, I mean, just, we're going to get to a slide later here. We're going to show that the period that this market segments, we're going to kind of reference that market segmentation. And if you can kind of break your database down or create a database that, you have some type of verticality or imbalance coming in the market that is going to cause that segmentation, it makes sense that one would merely be trying to get involved with the market upon that segmentation. That's the market starting to move using the terms initiating versus responsive. You want to be aggressive in trying to hop on board because, the market could have follow through like you see this. It might have little follow through like you see in this, but, that little bit of an imbalance, we in the book I wrote, we use the term minimum trend, that could be a little bit of an imbalance coming in the market that has, great potential for a bigger vertical move like this. So getting involved early allows you to, what you want in trading is you want to be able to have, we use the term of free peek. You want to be able to be in a position to kind of assess and evaluate your trade. So if you never know, is it going to unfold like this or is it going to unfold like this? But, that is a little bit of impulse and it has potential and we're always just trading for potential. So
the idea is that if there's an imbalance, you have to kind of diagnose it as it unfolds.
Yeah, ideally, yeah. And I think that, we talked about the terms background and foreground. So I personally, I'm like to look at the market from background perspective. So I'm looking for, the background is going to be, we'll say constructive towards being long, and then we get the little impulse push higher, like this, then maybe I'm inclined to be aggressive there. And if the market's, bearish and then, down here and like this little impulse, maybe I step away from it. So that's a selection process you have to go through in trading.
So Stephen, in other words, for something to respond to the impulse that you refer to, then you need some sort of knowledge of maybe the background structure. Would that make sense?
Yeah. I mean, first of all, you need to be able to see when the impulse is coming in, and in trading, you're running filters, right? So for me, the filter that I'm trying to run is what is the background. So I want to try to always trade with the wind at my back, so to speak. So, the trend is up or the trend is down. We'll use the term trend. The bias is up, the bias is down. So for me, I'm always trying to find situations where we get the little imbalance coming in the market, the impulse coming in the market that's conducive to what is my perspective of the background. And when I see that, then, we'll say that the background is positive. This little impulse is positive. So I have those two time frames, they're going to be, at least at that moment in time, they're going to be conducive for the market to try to rally. And could it have a huge rally? Yes. Could it fizzle out? Yes. But at least we have something that's going to have some propensity for the market to try to work higher prices. There's a little inkling, something going on that, starts, a little snowball rolling down the hill. And then by the time it gets to the bottom, it's a big snowball, right? So yeah. If you can find if you can get started with a little snowball, you have great potential to, to have a nice P&L, a nice year, whatever your goals are, whatever you're trying to trade. It's kind of really put you in an advantageous position.
And Pete, Pete used to always say, sometimes a good opportunity, or most times a good opportunity, carries further than anybody thinks.
Oh yeah. I mean, it's like the term that the cart runs fastest to the bottom of the hill. I mean, markets always exceed. I mean, anyone who's traded for any amount of time, they've certainly put on trades and made good amounts of money, and it's doubled or tripled or quadrupled probably the price relative to where they got out. I mean, I've certainly experienced that, as have you, Chris. I mean,
yeah.
You use the term "let the market speak." Don't have preconceived notions on levels, and just kind of let the market tell you it's exhausted. And that could be a function of lots of different things, and one of which would be market moving from imbalance to balance, and that could be a function of the time frame you're trading, also, right?
That's you guys get that? That's so smart what he just said. First, the idea is let the market tell you. Don't have any preconceived notions. Right, rewind that and play that again, because you were saying, how the cart moves fastest, the hill, everybody gets out too early, and that, it's going from imbalance to balance, and that also depends on the time frame. Even think about that, like it's the flea on the flea. Like first the 1 minute gets balanced, and the 3 minute gets balanced, and the 5 minute, and then since it's till the market's completely balanced, or the market's moving the other way. It's first the 1 minute gets knocked out of balance, and the 3 minute time frame, then the 10-minute time frame. And then the daily time frame, and then the monthly time frame, things like that.
Right. Yeah. So that's a lot. Everyone in the trading educational side of things. I mean, they always talk about looking at your dailies and weeklies and monthlies, and obviously there's merit to that. And I think, I think we have the better tool to look at the market and understand the market. But I think conceptually or from an application standpoint, that's all good information.
Obviously you need the shorter time frames to go first, but if the longer time frames are in opposition to the shorter time frames, typically the longer time frames will reassert control.
Yeah, let's say that's a good general statement. I mean, I think there's things that one should look at relative to I would call it the slope or the velocity, and then in a bigger picture, you can step back and, there's lots of people that trade relative value, right? I mean, I think crude's traded our negative $40, so positive 140, we'll say, right? But we'll never see 40 again, and our negative 40, I should say. And will we ever see 140? I don't really know, but you can pull up a chart and kind of get an idea. I mean, a lot of people do, as you said, Chris, they're going to get involved in trying to go with what is the intermediate term trend, we'll say, but then they negate to look at the longer term trend. So maybe, the crude trading right now would trade $130, we'll say, in the last 3 or 4 months. And then now you're traded down to mid 70s, low 70s. I forgot exactly. But, you look at the longer term chart, maybe that's an area where you could say, this is cheap, and so I think really trying to understand in the context of at different time frames, is to answer your question. Maybe there is a point in time where if you're trading into a zone, we're in the bigger picture, the bigger picture, it's constructive, the intermediate term, it's negative. Maybe you've got to start leaning against what is the shorter term if you do see it kind of, pulling up there and starting to reverse price.
So if you're using a 5-minute chart, then your trade durations should be in those 5-minute periods, not like weekly positions on a 5-minute chart.
When you enter a trade, you don't want to adjust your time frame to move your stop in a less favorable position. There's all kinds of people that do that, right? I mean, I've got a trade going, and I have a stop, and so it's trading at my stop. I'm going to give it a little more room while the bigger time frame. I can give it 10 ticks. And the next thing, my 20, 30 tick loser ends up being 100, 200 tick loser. So I think you never want to extend your time frame to manage an unfavorable or a bad trade, but you definitely should be trying to do that for a longer term trade, because just Chris, you think about it, if you're going to take 2 tick profits, hard stop, 2 tick profits, and you're going to try to limit your loss to 2 ticks, there's going to be a vacuum where you're going to get your 2 tick loser is going to be a 10 tick loser. Not too many times you're going to allow that 10 tick or 2 tick winner turn into 10 tick winner. So I think aggressively manage your loss, but kind of give the trade room to breathe. We always like to try to do that also.
I really liked what you just said. I've never, it's so true too. I mean, did you hear that? He never does your 1 tick winner turn into a 10 tick winner, but I feel like it's always where the 1 tick loser turns into a 10 tick loser.
Yeah.
I mean,
and how many different kind of there's a long term, in other words, we're supposed to keep a weather eye to the time frame. So we have long term would be like the daily charts, weekly charts, right? And then we have the hourly time frame, and then the 5-minute time frame, or even the 1-minute time frame. I mean, how many time frames should we try and follow?
That's you've heard the acronym KISS, right? Keep it simple, stupid. So I think if we try to look at 5 different time frames, the more situations you're going to throw out there, you're going to get a conflict, right? So get 2 or 3 that are favorable, 2 or 3 are unfavorable. So flip a coin, right? So for me, I like to try to look at something, which is, I'm looking at the bigger structure, then I'm looking at the half hour, and say this is the area or the time to turn, then I'm looking at like a 5-minute, then it's going to be the shortest time frame. I'm going to look at the profile, so that's going to kind of use that to optimize my entry.
Yep. Full disclosure, I use the 30-minute, the 5-minute, and the 1 minute.
Okay.
And
Is that what you use? You don't use like a daily or a weekly?
No, my trades don't usually last that long. I mean,
you just don't need that much.
No, everyone's different. I mean,
yeah, for sure.
People that I know people that just generate their trade signals at the end of the day, right?
Yep.
Yep. And there's nothing wrong with that. I mean, they have a method and
maybe even another career, right? And they don't have time to watch the screen all day.
Oh yeah, exactly. Going back to the market profile is simple in concept, yet complex in detail. So, I think looking at the Gaussian distribution and trying to look at the shapes, I mean, that's what is a profile. And I think we understand, or try to go over just a bit of the theory, but now I want to get a little bit more into the construction of a profile. So,
number one, the standard market profile is built on 30-minute periods.
Yeah. Okay. So, we've gone over the profile, and they do represent the legacy profile, which was developed in the early 80s. Everything was a function of a 30-minute period. I think that over time that's evolved, and some people actually build profiles that are actually larger than 30 minutes. Most people are going to actually drill down and make it less than that. My two that I look at would be the 30-minute and the 5 minutes. So those would be the two go-to that I look at. But I think a lot of softwares out there allow you to look at something which is different than the 30-minute, and I think that's a good feature.
Okay.
Second one, each 30-minute period is assigned a chronological letter of the alphabet.
Yeah, so that's what we went through over in this slide up here. We showed the time clock and the different letters that are associated with it. So I think real straightforward, just really trying to understand that we're building out something that is really going to be helpful in understanding the construction of a profile. And I think we're going to show a slide here that's going to be really enlightening as to why it's helpful to use letters.
The number one question I always get is, what do the letters stand for?
Well, nothing more than half-hour ranges.
I know. Right. What does the letters stand for? I don't know. 8:30 to 9, 9:30 to 10.
Yeah.
All right, number 3, the first 30-minute range, in parentheses referenced with the letter, will occupy the first time slot or column in the display.
Okay. Yeah. So that just told the idea of how is a profile constructed, and we're using the x-axis and y-axis to kind of give one a perspective of price and time. And the profile, think about it as they want to try to line themselves up. The letters, each half-hour letter wants to kind of move to the front of the line, so they're going to try to occupy the leftmost column. So these are columns. I drew a sign graph paper like this to give one a perspective of what is a column. So, when the profile is building, it's going to try to occupy the first column each half-hour period. Mm-hmm. But if that is already occupied by a different letter, it's going to just line up. It's going to queue up behind it. And so, if the market, in theory, if you have 5 half-hour periods and they all trade the exact same range of prices for each half hour, you're going to have 5 different letters opposite each other, and that's going to be your profile. When you bring new periods on and they traverse to a new high or new low relative to what was the previous range, then those periods referenced with letters that trade those new highs or new lows are going to move to the leftmost column and kind of give one a perspective of the expansion of the range and just the fact that that's the first period of the day that is traded in that price high or that price low.
Number 4, the second 30-minute range will be represented by the next letter of the alphabet, and for the prices that are overlapping the first 30-minute range, those letters will move to the second time slot. For prices that are new highs or new lows relative to the 30-minute range, those prices will also be referenced on the market profile display with the second letter of the alphabet. However, they will occupy the first time slot.
Yeah, so that's just what we just talked about. So just kind of the price discovery, new high, new low, moving to the leftmost column or time slot, and kind of giving one a perspective that this period of the day is one that probed that new high or that new low.
Okay, got it.
5, as the session continues to unfold and we move along the timeline of new periods being added to the display, the profile will develop horizontally as the new periods' prices overlap. as new periods are added and the profile expands vertically, new letters will be added to the first column with those new highs and lows in the underline.
Yeah, so just once again, just the whole idea of the first standard deviation, where you're getting lots of letters overlapping. Why are they overlapping? Because there's subsequent time periods that have built at the same price, and when it probes a new high or new low, that's going to generate the tail, right, or the potentially the third standard deviation where the market pushes a new high or new low and then reverses or moves away from that price level.
Okay.
So this is just kind of in long, just longhand explanation of how does a profile develop.
That's good.
Right,
Yeah,
that's a perfect description.
Yeah, more clarification and just going over things a couple times, I think, is really going to help everyone.
I think you repeat yourself 2 or 3 times, and it hits home for people. So here we're just going to go through that process of the letter, the bars and the letters, and eventually the profile. So this is just range of half-hour bars. We have 7.5-hour periods, and the ranges of those half-hour periods referenced with the bars.
Mm-hmm.
We take those bars, those half-hour bars, assign letters of the alphabet, chronological letters of the alphabet. So you're going to see the previous screen and the current screen are the exact same high and low. Just one's referenced with the bar, one's referenced with the letter. Then finally, we're going to have this whole busy screen where it's going to kind of show us, this whole process of, when it's all going to compress when it's all finished. But just to get the idea that here's the A period, the first half-hour range. Okay. Once again, the goal of all these letters is to move as far over to the left as they can. If there's someone in front of them, they cannot move any further over to the left. So we can see the A period range is set up in between 86 and 91. Then we get a B period. It trades 89, 90, and 91. So it overlaps the previous half hour. So they have to queue up behind it. But the next 3 letters or next 3 prices are traded in that same period. So it's going to move those letters over to the leftmost column. We have the C period coming up again, and then the first trades opposite, so it's going to queue up behind the B period, and it pushes a new high. So once this thing compresses, it's going to be in the first column, the C period. Then the D period comes on, it overlaps previous period, so it's going to just queue up to the next letter to the left. You're going to have the same thing. The E period comes on. Then F finally rotates down. Once again, you exceed or take out the lows of what was the old low. So this F period is going to move over to the leftmost column, the first column, and then the G period comes on and does the same thing. It has a hard reversal and takes out the high of what was the previous high. And then doing that, this G period is going to move over to the leftmost column. So you can see that we're going to have the G period and the B period and the A period and the F period once we're done on the next screen. We're going to see all those different letters are going to occupy the first column, talking about our terms, the modal point. This 91 is the most frequently traded price. We have the tails. What is the tail? That's the third standard deviation, right? Mm-hmm. We're going to the first standard deviation is going to be here in somewhere. So this would be, the Gaussian distribution, right? It's not going to be a 3-2-1 up or down. This is kind of a normalized balanced profile. And here you see our price plus time equals value. So, the value, whereas the preponderance of the activity is kind of in here. This is the first and second standard deviation. That's where a lot of the trade occurred at. And, there's lots of applications of trading this, but just how it is constructed is the whole thing we're trying to do in this moment. So
time out. Isn't that really interesting? If you look at the profile, it looks like just a normal balanced day, but when we break it down into each half-hour period, it makes a new low and then rockets to a new high, and yet the profile looks as though it's just a normal day.
Yeah.
Mm-hmm. Yeah, and I think I always tell people that profile adds horizontal depth to a vertical bar, so it kind of puts things in context. You can, if you just pulled up a bar chart, this was a daily bar chart, you'd get just like the high and the low, right? 99 to 83. Then you look at a bar chart, a 30-minute bar chart, then you'd get the 7 different bars, but, they would just use the occupying columns. And I think that, what's really interesting, in profile is that, in the book, talked about idiosyncrasies of markets, and we might have touched on this before, but the beauty of a profile is you're going to find lots of different nuances in markets. I think I talked about like the grains. There's a tendency to put an extreme in the F period for the energies. It's H period. In the indexes, it's B period on the open. In the fixed income, it's G and H period. In the currencies, it's D and G period. So looking back at this screen, we could, if this was a currency, I see this market pushing up. I have negative background. I see it's in the G period. I might be willing to try to sell the market with the idea that the G is going to be the extreme of the market, because there's a propensity or tendency to put an extreme in then, and let the market trade. So that's, if I was just looking at a bar chart, then, then like this, then I wouldn't know any of that. And, it would be difficult to kind of do that type of analysis. One can understand or view the profile or break the profile down into two different outputs, we'll say, and one is balanced. That would be like the 3-1-3 profile or imbalanced, the 3-2-1 up or 3-2-1 down. And, I think it's not always clear, but it should be somewhat clear. And, so this, when I teach, I like to try to, give kind of exercises in what I've taught to see if the recipient understands what we're talking about. So, I've drawn these little down arrows, up arrows that I can drag around, and I was thinking that the Jack or Mark would have control of the screen.
Okay. This first one looks pretty balanced to me. This first,
you just put them on
balanced.
Yeah,
pretty balanced to me.
Yeah, wherever you want. Right.
Down.
Oh no! Come on, look at the tail on the bottom. See the tail on the bottom?
Okay.
Right? See that tail? Right?
Put it to the left.
To the left.
Yeah.
Then I'll just put it above.
Yeah, it's hard to move.
Geez, now I'm nervous, Chris. Okay.
Now just look for the tails, right? Look where the tails are, right?
This one has like two tails.
Right, so that has to be balanced.
Yeah.
It has equal tails, right? Nice.
Okay. There you go. I'd say
right?
This one has a tail on the bottom more.
Oh no, you're dragging the whole screen.
Oh. What did you say?
Yes, look at that big tail that breaks out and goes nowhere, huh? Isn't that a screw job?
Yeah.
The one to the right of that.
Yeah. And
that one's a total screw job.
Okay. So
this is fun.
That one right there, right?
This is like good practice. Everyone
isn't it great?
These shapes and
so what if it has like a negative tail? Like this thing has zero tail, but it kind of has a little bit going on down here.
That's balanced.
That's balanced, yeah.
That's yellow or the gold or whatever that is, right? And what you could almost do is you can make all of those 1, 2, 3, 4, 5, 6 of those all one giant gold thing.
Yeah.
Right? That's just giant balance.
Yeah.
These are a lot of these.
And so what happens when market goes from balance to
same one?
Market goes from balance to vertical, right?
Yeah. And then,
so you see that, right? Yeah, right. But even before that one, look at the one before that. It kind of gives a tail.
Yeah, it's like a little tail.
Tail, right? Yeah. See how subtle it can be? Like nature loves to hide.
Like this one's a little tail. This one kind of gives you a tail on the downside a little bit.
Yeah.
And then this one,
or you could say, given the context of the up, you could say that's kind of balanced.
Yeah. But then this whole one is like a tail.
Yeah. Well, but you see, right? Like it's not really. You have to measure it in context of is it making price progress, right? So it's kind of like whipping around, but in a sense, it's not really making price progress.
Well, I think that one probably is. You think the one to the right of the red. Because I think it probably opened down at the previous and closed up at the upper end of the
that would definitely qualify as a blue. Yeah, you can.
Yeah,
that.
This one's kind of down, right?
Just move over.
Yeah,
because of the tail, right? Right? And then of course balance.
Yeah, we'll say that's
and then balanced.
And then
double. It looks like.
I think this is this one right here.
Oh my god! The screen.
I keep grabbing the screen.
It looks like a double. I can't see.
I don't. Well, what would that be, Stephen? Is that a?
Well, in the context, this one would be.
Yeah, after the fact, it's definitely up, but without looking to the right of the screen, I'm like, I don't know. What is that?
The bottom half of that one opened opposite the one to the left, right, and then it pushed higher because we know that because the top one at the right of that, the little one at the top. So yeah, that's definitely an imbalance. I mean, it's not visually, it doesn't have a great tail or anything like that, but just in the context of where it opened and closed, for sure, it's a buying imbalance.
And then this one's interesting because...
Yeah, that's a hard one. Yeah, to actually some of these like are for the first blue one now, I guess that would actually be is kind of like a 2 time frame day, whereas the first part of the profile pushed up and the second part pushed down.
Yeah.
And that's the way that one was. The first part. Yeah.
I think.
Oh, yes.
Right. That's a top, and yet it looks like an up profile, huh?
Yeah.
Isn't that? It's like, if everybody's expecting continuation, they're kind of screwed.
Mm-hmm.
Yeah.
Well, we do have that tail up there.
Yeah.
The thing that's interesting about that is all prices along the top, and it's kind of fat profile, and it took a long time to segment, so that's kind of telling you that it's kind of losing interest in playing it from the long side.
Yeah, right there, right? Like it's not making any headway, and you're leaving tails on the upside.
Yeah, well, I think like it kind of plays into only looking for A setups. Like if you look at a profile and you're like, I don't know, like what is that balance? Is it up? It kind of confuses you. But if you can find and like look for
like very clear,
like this to me, this one right here is a very clear tail.
Right, and you see like the market never went back
and
there.
Then it didn't go back. Like this one to me is a very clear tail. This one's to me. Oh my gosh.
Right.
This one
nicely done. Nicely done.
Find this is kind of like what I've discovered in my training is like only trade the setups that are good. Like, you don't trade a mediocre setup. If you don't have a strong conviction, don't even touch it.
Yeah, I think that's important. I think especially if you look at a portfolio of different markets, where you get all these yellow dots, or yellow D's or whatever. The balance situations, your market should go from balanced to imbalanced, and that's kind of something to alert you. But if you don't see the imbalance coming in, then there's no reason to get too involved with it. And I think on the left-hand side of the screen, you got eight of those little trying to find situations where you get the balance to an imbalance. That's kind of a 3-1-3 to a 3-2-1. That could be the start of something that has more potential follow through. So
Pete used to say, just because the market's balanced doesn't mean it has to go vertical. It can remain balanced. Markets can remain balanced.
Yeah, I was going to say that. That's funny. Exactly. Yeah.
Right. Yeah. But you got how'd they do?
Oh, good. Yeah. I think we'll give them a star, right? The gold star, or happy face, or 100%, or A plus.
All right, on to the next program.
Just understand this is bigger. So if you go back to the previous one just for a second, previous screen, just show that just you can kind of see that this is segmenting data faster, and so I think you're going to see kind of like a high resolution television. So you're going to see the picture a little more clearly in the high resolution television, right, where you're getting more little data sets, more little dots on the screen, and so each one of these is probably 4 of the other ones. So you can kind of some of those situations like that one right there. That I think Chris made reference to that could be 3 or 4 of those profiles, and there's those 3 or 4 profiles.
Oh, right. Remember at the low, same chart, right? So at the lows where we went sideways for those 8 other small profiles in the last one.
Oh, you avoided that one.
This one balanced, right?
That looks.
Yeah.
There's that's like very different. Like
little.
One, I'd say this is kind of left a little tail there.
Yeah.
This one is weird. I would say there's kind of like reaction. This one's definitely balanced. I'm just gonna skip that one.
Yeah.
This one, it looks, like it's going up.
Hey, isn't that interesting? You guys, look how where you just put that blue line up, right? That's that where it goes down, it leaves a tail, and then see how it respects that tail for 2 profiles, and doesn't leave a tail on those guys there.
Yeah,
and see how see that should be red. Bingo. See that?
Yeah.
And see how there's no certainty on those lows, and then it just wastes down.
Yeah.
Wham. And we kind of got like a down up here.
Or that's almost balanced.
Yeah.
This one's kind of iffy.
There you go.
I would say this one's up.
Yep, because it's a 3-2-1 up.
This one went down. This is kind of like the outlier. Like what happened here? Like we had that tail, right? But then it kept moving.
Well, that's actually, if you understand how it's constructed, so you would think of how that should really be is the 2/3 of the profile is really balanced, and then the last end of it, you have a push up. So. Honestly, that's kind of more of a
up.
If you would segment it quickly, it'd be a balance than a up. But
in other words, that tail could go on the profile to the right of it.
Yeah.
Depending on where it was segmented from.
Yeah. So visually, if we look at
we're splitting hairs, you guys. This totally splitting hairs.
Yeah.
But so far, Stephen? They pass. I say they pass.
Yeah. I mean, the one on the absolute high of the move, that's a 3-2-1 up. That's a blue up, right?
This one?
That one.
No, over to your right, the absolute high of the whole move on the right.
Oh,
that one.
Yeah.
That, has to be a blue. Yeah, isn't that weird? A blue up right at the high.
Yeah, we ran out a little.
Yeah, it's run out of gas. You can kind of see
all the king's horses and all the king's men couldn't move it any higher.
So you did good. I think just the whole idea here is just trying to get a perspective of I think you're going to see in a bigger structure, you're going to see more of the the balance areas, and then the market moving out of balance. In shorter term time frame, maybe use the word noise. It's going to be a little bit more noisy, but some people are good at trading noise, so I think there's nothing wrong with that for sure.
I hope you guys are enjoying today's episode. I did just want to take a second to interrupt because I have an opportunity for you. I'm actually going to be trading live every single morning. You'll be able to see me put this system into practice as I enter and exit trades, and you'll be able to essentially follow along and copy those trades yourself. Now, if you guys are interested, I will put a link in the description below, and I hope to see you over there.
Yeah, go to that next slide. So this is the last slide that I want to show you. I think it's slide one. And just read up there. It's the range of the first period. So this is using that segmentation algorithm, and this is a bigger time frame. And I think Chris will be able to relate to this once I explain it. But so this is creating these more macro profiles. And what I'm showing you within the red vertical bar is what is the range of the first half hour for that new profile. And so, like I said before, the first half hour is creating a new profile because it's segmenting out of what was kind of a consolidation area. So I just want to notice the tendency for the market to have those red bars, towards the top or the bottom, and I think if you count through them, it's about 3/4 of the time the red bar is at the top or the bottom. So that kind of reinforces the idea that you want to kind of be getting involved early on the trade, and if you want to just try to lean against something, the first half hour trade, whether it's a coin flip or have some type of background perspective, but if you manage it properly, I forget how many profiles were here, but I counted them up. But like I said, 3/4 or more of the the highs or lows were generated during the first half hour of that composite profile, and each one of those profiles is at least 30 hours of trade. So that's something to look at and be aware of, and just kind of reinforces the idea that the organic process, organizing data, letting it free form, letting it move from imbalance to balance, and waiting for the imbalance to come back in again. That's the energy that the energy cell, the market needs to start a new attack on higher prices or lower prices.
Isn't it interesting too that must have been 100 years, these guys who traded commodities always spoke about the significance of the opening range or the first half hour.
Yeah, I think that's back in the day, the opening half hour, right? That's there was no night trade, and you had the market imposed time frame of the day. A lot of people squaring up at the end of the day, but now that the markets are 24 hours, and you have lots of liquidity off the floor, you kind of use the organic process, but having a data organizational tool that kind of gives you a perspective of when interest is coming in the market. I mean, think about it. It's all these red bars are where new interest started, because we know that because you broke out of the range of what was a range and is now new highs or new lows. So just like building in the profile we talked about, that's moving something over into the first column, and then I think that probability or the tendency for the market to kind of hold that is pretty impressive in this example, at least.
The understanding that when something is happening, it is actually significant from a game theory perspective. It becomes a reference point down the road.
Looking at it today, this was kind of interesting me, and it kind of reinforced, the idea of using letters versus bars. But if you look at this screen, you look on the left side of the screen, you see the C and the D period. That's the high. You look at the bottom of the move, and the C and the D period is the low. Then you look over on the right-hand side, and the C and the D period are the high. So it's, a small sample size, but, over those 3 days, and if you're looking at a bar, you would have never picked up on that. But,
no kidding.
No, it is interesting.
I mean, that's awesome.
When you can factor in your background, and you use the Terminus development and single prints and a lot of things we get into the next session. But, as far as, trying to set up a trade, but I think the whole idea of last session and this is just to give a perspective of, how a profile is constructed and a little bit of theory behind what is a profile. And And, now we can kind of get more in line with just trying to, look at some real basic setups to try to trade, just ones that are good risk reward and, have some type of a clean, clear structure to trade off of. We don't want to try to look at things that are muddled, but just really clean setups is, like you pointed out, and dragging your arrows up and down and around. Some are clean, some aren't, and look for clean ones and, just trade the clean ones.
Yeah. I had a couple really like big light bulb moments in there where it's just like things clicked, it made sense.
Yeah, light bulb moments are huge. It's kind of like why we, Chris, you said this a lot, there's small wins.
Yeah, and pound them home, right?
Yeah.
If you have that light bulb moment, pound it home.
Yeah.
Pound it home. Like, go home and think about it. Pound it home.
Yeah. And I will. I'll be thinking about this after.
Do not just brush them off. The idea with these light bulb moments, they don't come along. So pound any light bulb moment home.
Yes.
Not make it a non-conceptual realization. Like, embody it in your body, like you feel it.
Yeah. Well, I hope you guys watching had some light bulb moments.
Thank you, guys. Thank you, Chris. Thank you, Steve.
Yeah, have a good night.
Thank you, guys. All right.
See you in the next one.
On to the next
one.
one.
The next section we want to talk about, we originally were talking about the theory and then the construction of the profile. Now I think we want to talk about what is the profile itself, what constitutes a profile, what is the purpose of a profile, and that's to kind of display what is an auction. And we say that an auction consists of 4 steps of market activity. A series of prices in one direction. It can be just, you see, as Chris made note of the CPI number a couple months ago, and the market had a big, huge vertical move and all single prints. And I forgot if Chris told me or someone else did, maybe there was a 50, 60 point move in a matter of seconds. I forgot what it was, but you can see something to that magnitude or something less than that. And it's a function of the volatility in the market. That's what we're looking for, is just the drive, the drive higher or the drive lower. And that's the step 1.
Step 2, trade to a price high enough to shut off the buying or low enough to shut off the selling.
Yeah. And so that doesn't necessarily mean the absolute bottom of the move, but just you're in a lofty price and it distributes lower, or you're in cheap price, it distributes higher, then it starts to value. Then you get a certain amount of development time around a price, and that's going to be the area where the new perceived value is, and that's going to be where the market's going to develop the first and second standard deviation.
Step 3, trade around that stopping price.
Yeah, that's what I just mentioned. It's got to find a stopping price, and it's going to start developing around that price. And that's, as I said, that's the area of perceived value. And that's people are just trading around that price and just getting involved and engaged and looking for smaller moves.
And then step 4, move to efficiency.
Yeah, so then that can be, you can have 2 things. The market can move from that stopping, developing, that's an efficient price, and then it's going to do 1 of 2 things. It's going to try to reverse the move that got it there. So if the market's distributing up, it's going to try to retrace some of that or all of that move higher. We just talked about the single prints. So in theory, trade into the single prints to a large magnitude or a small magnitude or the whole thing. Or it could do just the opposite. It could, in this case, we'll talk about a 3, 2, 1 up. You have the step 1 push higher and then stopping and developing around that higher end of the range. And then the market could actually go out to the top of the developing or the fair price area to create some type of an efficient move. Once again, we're always working towards a profile, developing some visual type of a 3-1-3. So it can do 1 of 2 things, revert back to develop the balance, or it can continue higher. So on this screen here, I'm just trying to give you with the magenta arrow is just what I see as step 1. So we're getting the vertical move. That's just within the market. You're seeing vertical moves, strong moves, and note that this is a weekly. So it's applicable to whatever time frame you're looking at, a 30-minute profile or a daily profile or a weekly bar, whatever, just really trying to see that situation where the market gets a strong vertical move. And then this next screen I'm trying to show you the what I see as the market stopping. Once again, it doesn't have to be the absolute high or the absolute low. But it's going to have some type of stopping area, and then you're going to see the situation where the market's going to start developing around that stopping area, and that would be the step 2 would be the stopping, and then step 3 would be the development. So we're just reviewing the 4 steps of that market activity. Here we are once again, the magenta, the step 1 shows your price is lower. The little yellow dash is the stopping. The white box is developing around that price. So those are the 3 steps we're looking for within any profile, and what's going to happen from these types of, once again, 3, 2, 1 ups or 3, 2, 1 downs. The market's goal is to try to move to some degree of efficiency. So just kind of displaying that same information in a chart. What we're looking at here is a series of prices in a direction, the stopping development. The market, like I talked about before, is going to try to do one of two things. It's going to try to reverse the move that it started from, like you're saying here, the down, the stopping, developing, and pushing back up, which should kind of visually create kind of like a 3-1-3 bell curve. Or the push up, the stopping, developing, rotate down to try to create a 3-1-3 bell curve. Or the other outcome, as I made note of, you're going to distribute down, in this case, stop, develop, and instead of reversing it back up, you're going to push lower. And once again, just kind of look at that visually. We're looking at the same thing. This, where the white box is, that's going to be the first standard deviation. Whereas where you're going to have the magenta arrow and the, pushing lower, those are going to be the tails. So once again, we're always looking for a profile as it's developing to create some type of a visual 3-1-3.
Yeah, it's like you're developing around where there is a lack of trade. So your price is getting more comfortable in a direction where price is normally uncomfortable. That makes sense.
Yeah. I mean, I think, here's the comfortable area, right? The market's stopping here, developing the first standard deviation, the first and the second. The way the market's going to trade is a whole distribution process, the stopping and developing. As the market gets in this zone, it's going to compress the range typically. Over time, people are going to lose interest because they're looking for a bigger move typically. So as they lose interest in the market, that's what's going to induce the market eventually to, whether it's an economic number or something coming out, that's going to cause the market to move from this congestion or comfort zone to a new zone.
Years ago, Pete would say that if you were trading during the day and you managed to buy the lows or sell the highs, your objective wasn't the other side, but was actually the wide spot of the profile to get out.
Yeah, because that's, obviously, I've said before, the market kind of stair steps up or stair steps down, distributes, stops, develops, and then we don't know from there, it could be up or it could be down. But if you're just trading, for the market to trade the market as opposed to trying to predict the market, the stopping is the temporary push that's telling you the market is pausing there, similarly to the downside, the push and the pause. So, if you're really trading, the time frame that's conveyed in this picture, the pausing is, where the market is confirming that that's done, and now you're starting something new. And if you think about it, what is the stopping and developing? Actually, the move out of that is a new step one, right?
Yeah. Isn't that interesting? Even on a shorter term where you're trading during the day, you can see the market push and then pause, as though the people who are trading that even the microsecond level are choosing those pauses to exit from their microsecond trade that just occurred before that.
Right. Mm-hmm. And I think I've told Chris the story and other people that, one of our customers, their fund, and this is when they were trading on the floor, and he would obviously had a big fund and did real well, but he would always try to trade for the imbalance. And I think he would call in in the bond pit, we'll say he would call in every 5 minutes with an order if the market's working higher, he's trying to buy 1,000 bonds at the market every 5 minutes. And what he's doing is he wants to get a worse price every fill, right? And if he's getting the worst price, then that's the market distributing, right? And once he starts getting the same price or a better price, that's the market developing or stopping and developing. So, that's kind of conveys the same message that Chris just said, as far as, trying to, look at this little imbalance in the market. And once it starts pausing or stopping, that's telling you that move is finished and whatever time frame that you're looking at, and it's time to reassess.
That's a great lesson right there, everybody. Hope you were listening.
So here's once again to reinforce, I think that understanding this concept is really the most important part in trading, understanding the 4 steps. This is a 30-minute. So these are just daily profiles, I guess, just to give you a perspective once again, just like the step ones, at least how I'm viewing this. Step one is magenta, then the stopping, and then the developing, the market working up and down and back and forth. And, the outcome, what would expect after that is I'm going to expect this thing to come back and retrace, this vertical move up, vertical move down, to create some type of a balanced profile, or I'm going to look for this market to continue lower. And I mean, I've even found that if we could if you can see my mouse moving horizontally across this range here, and the bottom of that range here. And then we're going to have, this is the third standard deviation, this vertical range right here. So quite often you'll see symmetry. So we'll see, you could almost add whatever this number of ticks is between the magenta line to where the magenta letters are, and add that to the bottom below the yellow. And that would create some type of a big 3-1-3 profile with the second and third at the top and the second and third at the bottom. This is kind of it's a good measuring objective. It's uncanny the way that works, but then looking for the market to set up some type of a balance or reversal type of a trade setup.
Does that also signal a completed data segment if you can arrange data into a normal bell curve, a normal distribution?
Yeah, yes, based upon whatever time frame you're looking at. Like we talked about before, there's different time frames you're looking at, and I think what I always advocate for is whatever time frame you're trading within the context of that time frame, you want to really be trying to organize the data from that perspective. This is a weekly, as you can see across the top of the screen here. So what I'm looking for is, we can kind of start at the bottom of the screen and understand, what's happened in the market. So this little selling activity here, it paused and it stopped, and then what happened, like we talked about, the reverse and try to create something that's going to be more balanced, like a 3-1-3, or this thing could round it out to the downside, right? Mm-hmm. And the same. And so what happened is the market pushed higher, the selling once again, the stopping and developing. What's going to happen is it going to roll down and create some type of a 3-1-3, or could it cause the pause here and roll up and kind of create the single print area here above the market here. So I think, for me, I'm always trying to visualize it, the degree that the market can trade into the minus development area. And I think if we look at the one screen before, it'll be more clear. So here we're looking at these buying setups here and retracing. Is this market going to roll over and visually do that? Or is it going to another probe higher? The same thing here, the push up. Is the market going to roll over and trade down to here, or can have another push higher?
Can we touch back on that? What you said is you should segment data in the time frame that you're trading.
Mm-hmm. Yep. Mm-hmm.
Right. That's a very good concept that most people need to remember. The nature of the market's trying to find some sort of agreed upon fair price.
Yeah.
Given that's the job of a market, right, is to facilitate transactions, and most transactions would occur at a fair price. So by default, would that mean that a market that can't find fair price is one that is in the midst of a trend, an imbalance?
Yeah, it's still in the price discovery. Still in price discovery, right?
Right. So if people who are watching this are watching a market that does not seem to, in other words, it's in the process of an imbalance, mm-hmm. right? They should make sure to respect whatever the direction that imbalance is in, right?
Yep. Mm-hmm. And to your point, trading the time frame that your data segmentation is represented, I think that's something that they keep track of, because looking at this, as I said, that these are all weekly bars. You look at this on a daily perspective, obviously this would be a strong trend up, and this would be something that would have lots of days down. How would one, if you're trading a shorter term perspective, you wouldn't be able to view this, from the standpoint of, the market trading back to this is the third standard deviation, the second and the first. So I think, be aware that you're always trying to look at your segmentation algorithm. I'll use that term as far as, how you're created your database, looking at shorter term chunks of data or bigger, longer term chunks of data. You really need to trade your data, but you need to be cognizant of what is the bigger picture as well. So I think, as we've talked about before, overlaying something which is shorter term with longer term, gives one a big longer term perspective. But I think using the term plan your trade and trade your plan, I think you really need to go into your trading with your eyes wide open and looking for something as far as an opportunity goes in the context of how you're looking at your database and trading that opportunity and entering and exiting it based upon what you have right in front of you versus, really trying to do something that deviates from that, because I think that can kind of put you in a position where you're getting information that can be confusing, because you could be seeing something that is clearer from a shorter term perspective, but then from a longer term perspective, it tells you something different. And that would kind of create some uncertainty in as far as your trading, the trade that you are putting on.
So do you default to the segment that you're most comfortable in, or your expectations in regards to the move, and then align the segment in regards to those expectations?
Yeah, and because everyone has a comfort, your comfort or your what you're comfortable in trading, whatever time frame we'll want to call it, is what you should really try to execute on. Just like if you're an athlete, you're a Kobe Bryant or a Michael Jordan, or you look at the 3-point shooter, the guy from San Francisco. I mean, you want to really be, some of the guys are power players and play inside, and others are outside players. And I think just same thing with trading. Understand what is your strength and try to capitalize on that is important in trading.
Yeah, Pete used to always say, if you're a fastball hitter, don't try and learn to hit curveballs.
Right.
Just crush fastballs. Summarizing, I'm just going to try and summarize what I'm getting is that the diagnosis of the profiles can be done even without the profile on shorter term charts. If you can see where the imbalance is, in other words, where it's spending the bulk of the time versus where it's not. And then using the profiles, I mean, what's the smallest profiles that people use, Steve, time-wise?
I mean, I've seen people use one. I mean, people use tick profiles and all that type of stuff. But I mean, I would say that a lot of that is noise. I would actually deviate, probably to something nothing less than a 5 minute looking at a profile. That's my perspective on it. I think anything more than that, I mean, unless you're trading just one market, that's another thing about trading. I think if you're, trying to focus on just one market, you can trade a much shorter term time frame. If you're trading multiple markets, then by default, you have to trade a longer term time frame.
And what is the longest? Do people put together profiles that go weeks or months?
Oh yeah, there's people who just build big composite profiles, and they're just really trying to, from my perspective, I think it's a bit more subjective versus objective as far as what they're generating as far as a trading idea goes. But so they're going to create a big profile. They're going to see the nodes, everywhere where you see lots of activity, or the areas where you're seeing pockets, we'll call them, where there's less activity. And so they're looking for the market to trade maybe between nodes, or looking for the market to hold the pockets or things like that. But I think that's more of an art than a science. And I think that's what trading is. It's a combination of art and a science. But I think, that's too artsy for me. I think I think the part of the reason we develop software is we want to kind of put everyone kind of in the same place as far as a database goes. So if I have a database and algorithm that gives me this information, then I have a different filters I can overlay it. At least we can kind of come to some consensus on what we're looking at and really try to get an idea on, as we evolve our understanding of trading, the different things that have merit as far as trading, as far as looking for things related to volume, or things related to single prints, or things related to prices being accepted or rejected.
Is timeout, is there a protocol of importance of any of those three things? Is there prices being accepted, single prints, and I forget the third one?
Yeah, I mean, I would
expectations of being right. Are there certain priorities? Are single prints more important than prices being accepted, or even the expectations, right, of people being first in priority would be people being caught off sides?
Yeah, for me, I would say the situation where you get, that's why I pulled this chart up. Can you see CPEZ? Can you see that in the upper left-hand corner as your screen changed? Okay.
Yep, copper.
Yeah, so for me, what I always look at, and then you can relate this to the profile, right? I mean, I'm always looking for these areas where you see prices being rejected, where you see a spike, something that really stands out on the screen. If, I would be looking at this screen, at things that you can see my cursor, I'm just moving my cursor over areas that I think that really stands out for me. And that's where I'm seeing single bars, where you're just kind of seeing the market move up to an area or down to an area, and the market moves away from there quickly. So that's an area where you're trying to move the market directionally, right? In this case, coincidentally, most of them I've highlighted, it's all been pushing higher. The market's trying to push higher, and then you get some type of a hard rejection. So if we talk about the idea of the 4 steps, I mean, can you see my cursor now? So you see this little red, and it's just referencing bars. So, I'm just seeing, these 2 bars as a series of prices in one direction, in this case higher, and stopping, and something stands out there. The development time is short, right? I mean, I said the market should trade to a price high enough to shut off the buying in this case and then develop and then move to efficiency. But the quickness at which this market failed is really significant in my eyes. So, that's what I'm always looking for is a situation where the market, reverses quickly in a couple bars or in the same bar. That's really, really, really powerful as far as trading information goes. And why does that happen? Just two things in this case. One of two things. It could be stops, right? People who sold the market in the case and the market pushes higher, then, they have to enter their buy stops and they get stopped out, or for whatever reason, people bought up into higher prices. In this, maybe where you can see my cursor here, this market's developing sideways, and you get a couple price spikes or pops above kind of the top of these ranges, and people are thinking, well, now the market's, we'll assume the market rallied over here, you set back, and the market's trading sideways, and it's finally going to catch one of these times and then take out this high. So, I think it's one of two things. And what's happening is people short getting squeezed or people long getting involved, expecting higher prices. And the next thing you know, it falls away and they're stuck. So, usually the quickest move is a function of the people on the wrong side of the market. So I'm always looking for those quick moves as far as my trading goes.
So, all right. And then someone caught off sides, and then the single prints are, is that what would we call a single print? An inefficiency in the market, similar, or a place where it's minus development, I guess is what we'd call it.
Yeah. Think of minus development, lacking development, right? I mean, we can, and it's all a function of time frame you're looking at also, right? I mean, we can look at all these bars, and each of these bars are at least 6 hours of trade. So we can see these situations that there's overlapping bars here, so there's lots of trade, and then you get one little push lower and there's less bars here, right, versus here. So it's speeding up more. And then you get, less bars here, or quasi single prints, we'll call them. And then you're getting more bars, so, even though, we're looking at, bars that represent 6 hours of trade, and if we're looking at half-hour profiles, so that would mean there'd be potentially 12 letters there, but we're just looking at bars. So we're kind of eliminating the horizontalness of them. But, conceptually, this whole move, from here down to here is some, big imbalance in the market.
What do you think the definition of certainty would be? The definition of certainty would be the price would move away from somewhere very quickly, right?
Yeah.
Yeah. So how do you explain on the chart, kind of in the middle? Is that just the inefficiency in trading where that would be a low and then we were incorrect?
Think about this, Jack. The understanding is that as more people get involved in the trade, as the trend grows longer in duration, more people have the chance to get involved. That's when you start to get more retracements. I think that's what you're asking. Why do we see the spike lows coming there and not up at the beginning of the move? The beginning of the move, you had that spike up that rolled that Steve was showing earlier, and you see how there is actually no retracements until you get later in the move. And as more people get involved, it's only natural as the move moves both forward in time, in duration, right, and magnitude, right? As more people get involved, because price is going to advertise weaker, right? Price action is going to advertise weaker prices, so more people are getting involved, and at that point, there are elements of the move has exceeded a percent. There are standard variables in regards to duration and magnitude of moves, and prudent people would be covering positions. And because the degree of participation becomes greater, then you have more people involved, and therefore you get the retracements that you're looking at. So those would be considered completely normal in the context of a mature trend.
And then just think about the whole price discovery mechanism, right? I mean, the auction process, and that's what we're talking about. And as you said, I mean, you eliminate if you see the spike where my cursor is, as Mark just made reference to, if we see nothing other than that, for sure, you're buying into that, thinking that this could be the bottom. You've had lots of different things. We talked about, first of all, you look at development time, like here, the push up and the failure. You might be speculating that this is going to be the same thing to the downside, right? You're going to look for this thing to fail here and start pushing up, and you could be getting excited over here, right? Because you think, this is the bottom. You had short development time, and now you can retrace all this up move. And, I would say that, yeah, I might have drawn that conclusion, especially if you factor in maybe if you look further back in time at the background and there's something, with these prices, previously that has some type of a support minus development, some type of an excess, that would reinforce that idea. We'll just assume this is just a half hour profile, right? So you get the market spiking down and then coming back up, a half hour later. So this would be single prints, like an excess is different than single prints, but similar, but this would be an excess in the market. So buying it into here, would be a logical trade also, because we're dealing in markets of uncertainty, right? So, you can't associate a probability of 100% to anything, right? I mean, as far as a trade goes. So, this would be a situation that, everything looked constructive for the market to rally, and it attempted to rally. However, it didn't follow through.
In fact, so in regards to certainty versus uncertainty, which is kind of where we're leaning right now, certainty would be a tail, right? Certainty would be a direction being closed off. Uncertainty would be a market that has traded into balance and is ready to go vertical from that agreed upon fair price. Would that be accurate? Kind of. What is uncertainty? I mean, uncertainty would be anything other than certainty.
Yeah, I mean, I think there is no certainty in markets, first of all, right? So I think maybe whether we can organize the market from that perspective, I don't know. I mean, I guess, you look at basis and all these different things like farmers growing, there's certain formulas or people trading yield curves and then things like that you can kind of really sharpen a pencil to and really have a high probability of saying this trade isn't going to get any worse. It might not get better.
Didn't long-term capital have to get bailed out by the Fed because they had a certain trade?
Yeah, right. But that's a kind of their definition of what the fair trade wasn't an actual definition, right?
Right.
But I think, just kind of looking at it more from a, very, very simplistic standpoint, I think we just really have to understand that, markets move from, balance. This is balanced, all this is balance, and you're going to get all within all this balance area. You're going to get all types of false moves out of here. And us as traders, we just are in a position of trying to trade, unless you're a mean reverting trader, or there's lots of algos out there that relative value, and they're just maybe trying to trade the extremes of this. But for me, I'm trying to look for the situations where the market is balanced and moves in balance, and in this range here, which runs from 713 to 11. So yes, range runs for almost 4 months, 3.5 months. You've really had lots of false moves that maybe would have got you involved in the trade, but nothing that really paid off. So I think, for me, just really trying to understand what is the structure and looking for this market balance, here and moving in balance, maybe getting involved and allowing for a certain degree of retracement. When that retracement exceeds what I would expect it to, then for me, it's just the writing on the wall that idea is no longer in favor and time to move on to something different.
I just want to interrupt this episode to give you guys a special opportunity. Now, I'm actually going to be trading live every single morning. If you want to sit over my shoulder, watch me enter and exit trades, and put this system into practice, I'll put a link in the description below, and I hope to see you over there.
It's Pete used to say the most certain trade was a vertical move that was coming from a balanced position because there was absolutely zero chance of a retracement.
Yeah, in certain context, right? That's important. I mean, then, first of all, what is balance, right? I mean, looking at this chart, this is a big range of balance. You look at something shorter term and different, and it's going to be a different, a different degree of balance. But I think, you're going to have, like you have in this situation, balanced, imbalance, but markets, that's what markets do, right? They go from a balanced situation or an imbalanced situation to a balanced situation. So I think, you're building this big composite. What I wanted to get to looking at this chart was this is some, a series of prices, step one, step two. And so this is that 3, 2, 1 down we're looking for. So from a trading standpoint, I want to be trying to sell against the two, thinking this market's going to develop down to here and create symmetry to the downside. If I'm wrong, it's going to roll back up to the upside. So I think, for me trading, I want to be aggressive early in putting the trade on, so over in here, I'm trying to sell it the market with the idea it's going to roll over and trade down to here at least, and possibly trade lower. But then later in time, I think the likelihood of this market continuing lower is been negated because we've spent so much time trading sideways. So when you get a market, Chris, you remember reading about the internal time clock of the market, I think, right? Once there's a certain amount of time that we can kind of, that's why we call it the time clock. There's a certain amount of time you're building this composite profile. And depending on where you're at with the development of that profile, if it's earlier on, it can continue. If it's late, it's later, it's going to more develop. And if it's extremely late, it's going to probably try to reverse. So, I think you can kind of associate certainty or uncertainty to numbers like that. Once you get the ability.
That's interesting, right? The timing, right? In other words, the market can continue to go sideways in balance,
right?
But the probability of it doing so diminishes because it's running out of time. I mean, nothing is balanced forever.
Right. Yeah. There's always something. I mean, whether it's an economic number or something happens, within that sector, or who knows what it might be, the easy money, tight money, all those different things can impact, the market in general or market specifically. Understanding, what is an auction and the four steps, for me is something that I look at all the time in any market. I mean, you can look along the bottom of the screen here. These are all the different markets that I track, and any one that I could pull up, viewing in that light, for me, I'm always looking for doing nothing more than this and what stands out on the screen. And it might be different for different people to a degree, but it should be pretty much the same. And here's something right here. This is the German Bund. So what stands out, if I could ask any one of you what stands out, and I'm thinking we would, probably draw the same conclusion.
Look at that sell-off.
Yes, I mean, for me,
if you were, there's certainty right there. If you were long, there was no one in a rush to help you out there.
Yeah, that's a good point. I mean, for me, if I'm looking at this as just kind of working from the left side of the screen to the right, I mean, for me, this bottom, I don't know if you can see down here, the spike down, that really stands out. Then the market tries to rally, you get another spike down. That stands out. This direction is intact. I mean, here again, you get the market trying to roll over, you get the spike down. Once again, it recovers real well. This up here, and then we see this market trying to come off. And we'll say here, looking for something here, where the market would spike down, and I would expect this thing to start reversing if this.
Oh, right. See, when it breaks support and goes sideways and doesn't bounce back is the tell.
Yeah.
So and then it breaks hard.
Yeah, then it starts breaking hard, and then you have the same thing here. You get these spikes.
Right there.
Yeah, so that really stands out to me. Then you get the hard break, and the same thing. This right here, and now we get this situation here where you get a couple bars building higher, and then you're getting a situation where you got this low kind of stands out for me. Maybe I'm thinking back in here, or maybe I'm trying to buy it, against this, but then it takes that out, and but then this is where the complexion finally turns, right? Mm-hmm. You get this situation here. And for us, we always talk about the term retest. For me, when I think a market puts a bottom or a top in, it's seldom, like a step one, using the term as step one down to a reversal step one up. Usually it's, something a step one down, the step one up, we'll say, and then some type of a retest without taking it out. And, for me, that's where I'm trying to get involved if I think maybe the market could be changing complexions. And this all makes sense. If we look at this market, we'll say that this is a step one and they're stopping and developing. And, you've obviously traded, relatively deep into the, we'll call this the minus development or the area of, where the market should try to hold support. And it didn't trade to the starting point. It traded short of it. But, that would be something that I would be looking at to try to be engaged with something that had something which did have a negative tone to something that could be moving to a positive tone. And, once again, a bigger time frame, it's negative. The shorter term time frame, it's positive. So is this 3, 2, 1, down? Is it going to kind of fail up in here or kind of roll back up? So that's kind of where you're at right now. And it's really, for me, looking at this market now, and I honestly haven't updated this for 2 or 3 days. I've been doing other stuff. I haven't been able to trade it all for the week, but I'm sure the market's up in here now somewhere probably.
Yeah, it's up higher, I'm sure.
Yeah, so this is updated as of Tuesday, I think, so I'm sure.
Hey, so in regards to certainty and uncertainty, in other words, if the market's going to trade if you're looking for the tone to change, in this case from negative to positive, that would mean that if it's moving back into that area of minus development, that it wouldn't spend a lot of time there.
Correct. Yeah, that's now like we talk about trade early and trade often. You want to really be getting involved early, and if the trade starts working for you, then there's a good chance, as you said, that it has a potential for continuation. You get the trade on, and it just kind of meanders around, trades there. Then obviously there's not a lot of. There was initial interest, right, in buying it and supporting that, so there's some interest. But the fact that it can't move away from there, why would it move away from there? Because people are paying up for it, right?
They want right. No one's coming to the party.
Yeah, no one's coming to the party, or that's zero, right? There's like people coming and people going,
right? Yeah, like
not a big line out in front of it, right?
Right. No, the party's stale.
On minus development, and show us like how we could, identify, see that, find that.
It's like where nothing has ever traded. It's either gapped through it or only went through there in a straight line, never came back.
Here's to your question, and that's why I was looking at it and I told myself this would be a hard market to trade. I don't know if I would be much involved in this one, but like you look at what's going on. Like here's a perfect example. Can you see my red cursor?
Yeah.
Or the red box?
Yeah.
So I know, and Chris can confirm to me that why is this profile here and then this little thing up here, because this market closed up here, right, Chris?
Mm-hmm.
And then what happens? Here's the market opens down here. Like how much dollar wise? That's 149.70 to 146. So it opens $3.50 lower. I don't know if that's typical for that market. Same thing here. Here's a profile, this little one here. Then this is the finish of that one. Then the next day it opens way down here. So to your question, there's degrees of minus development. The greatest example of minus development would be a gap, right? The market.
Yes.
Yeah, there's nothing. Nothing could be more powerful than that, right? I mean, the next thing would be single prints, right? The single prints means there was some trade there, but the gap means there was no trade there.
So if you get involved in minus development and you're wrong, you can't expect the market to come back there.
Yeah, that's you gotta kind of throw the towel in and accept you're wrong and move on, because it's just more than likely going to continue to go get worse for you.
Right. So, and if you guys are trading the wide spot of the profile, you'll probably get a chance to get out if you're wrong, because the market's demonstrated that people think this is fair value. So any sort of deviation, as long as there's no gap or market direction change, then you should be able to bail yourself out. So initiating into the wide spot of the profile gives you a chance if you're wrong, but initiating into the minus development and you're wrong, you've got to go.
Yeah. So anything you're looking at as far as a profile, which once again can be conveyed in a half-hour bar format, whatever you're looking at, but where you're seeing a lack of trade is conceptually a lack of trade, versus the fat part here. So I think there's degrees of minus development, right? I mean, then we talked about the greatest would be a gap, the next would be single prints, the next would be double prints, on so on and so on. So I think for our trading, we always say that one thing that you can lean on is what we would call a skinny profile, and that would be something that is spending a small amount of time, the smallest potential amount of time developing. Once again, we're looking at an algorithm, so if it segments quickly and if it's relatively skinny, that's going to tell me that that thing is going to have buying power or selling power. And when we see something like that, we're going to say that that thing should be able to hold that extreme for the next 3 or 4 profiles. So in trading, what you want is you want to be able to put a position on and evaluate it, assess it, and try to give it as much time as it can to kind of confirm your idea. And so if you can put yourself in a position where the thing should hold levels for the next 2, 3, 4 profiles, that's a good position to be in.
Would you call that certainty?
Mm-hmm. I guess I would call that certainty.
You would call that certainty, right?
Yeah, the thing is.
Do you guys hear that, right? A skinny profile or minus development is good as support or resistance for 3 or 4 more data segments, depending on your time frame.
Okay.
That makes sense.
Okay.
Looking at Apple, we could look at a different stock. This is just too difficult. Like looking at where we are right now, the last profile. What are you thinking from here? Like
as I noted, I haven't updated this for a couple of days. So
Okay.
I'm sure one of you could tell me exactly what it's doing, because this was on the 28th, and I don't know. I think I remember looking at it after. I think it went up the next day, but that would make sense, right? I mean, let's look at, let's evaluate this stock. So, here's the market balance, right?
Yeah.
This is a great example right now, and I'll explain to you why. If you would understand how this thing works, is this market. This was a previous day's close, and if you can make these letters out, I'll make it larger. This will be a good example. So you can see this B period, like B as in boy, right? That's the first letter of that profile, and that's when the market opens, it traded in a tight range. Then the last hour and a half of trade, it looks like it pushed up this K and L period, then came all the way back down, an M and N, and closed down here. Okay, so for me, even though this looks balanced, right, what you should be doing is you should be creating a segment that would kind of start right here. And we talked about the markets moving out of balance, right? They go from balance to imbalance. So what I would do is I would start some type of segment right here. This would be the M, and then that would continue down. So this is all minus development, continues down, and then you have just the flip side right here. You have minus development right in here, this market pushing up to here, and you're pushing higher and developing sideways. Like we talked about before, this minus development zone, this is the most powerful. This is the gap right here. This is single prints. Buying into this area, we'll say 142, 143. That would be an idea as far as the setup goes. My idea would be for this market to.
Everybody's trapped. Everybody's trapped in that, out of that hole.
Yeah. And so is the market going to be able to roll all the way back down here? Of course it can, but the odds favor it holding some of this trapped area, like Chris, all these people who sold the market over these 3 or 4 days.
Yeah, they're so trapped.
They're stuck, right?
Yeah, you see the market just immediately. I'm surprised it didn't go more vertical out of there, since you had so many people trapped.
Yeah, I think the reason this thing came up is, the riots right in China with the Apple phones, and they weren't going to be able to manufacture them or something. I think that was kind of the news that I heard after you mentioned that you were short and we had a bit of a break. I don't know if that was the reason or not, but I could understand that could be the cause of the break like this. But once again, understanding the structure, what we're looking at is the market should attempt to try to hold into these levels and then go and try to trade higher prices.
God, what a great trade that is, right? I mean, the fact that you have a small tail down there, I mean, that was a cheap trade right there, boy.
Yeah.
And I think anything you look at, you can see what I have. I have NASDAQ, I have Bitcoin, I have, I have Ultra Bonds, I have carbon, I have Ether, I have cotton, corn, beans, fixed income, metals, energies, whatever. But I mean, all these principles that we've been talking about, I think Chris, he's more of a stock index guy. I look at everything, but he trades other things as well, and he can kind of attest that however he views the S&P or ES with profile, he can look at any market and kind of draw the same conclusions.
Mm-hmm. Certain markets have different personalities per se, but the principles apply across every market.
Right. So this is the euro currency. This is all I do. The first thing I do is try to look at this and see where you get these, single prints. This is quasi single prints here, right? I mean, I would say this is a 3-2-1 down here, and it tried to push back, and there's a little bit of minus development here. Then this starting point here, is this market going to be able to overcome this imbalance?
Isn't that a great question right there? Do you guys hear that? Is the market going to be able to overcome this imbalance? In other words, if you were looking at it like a ski slope or something like that, right? Like in the snow, imagine the snow just broke loose in a cornice, right? And is there any way that the snow is going to stop rolling down the hill here? Is there any reason, kind of sort of thing? That's a great question. Is there any way the market can overcome the imbalance?
Mm-hmm. Mm-hmm.
I like that. It's kind of like thinking inverse. So instead of like,
yeah, it's like a negative, right?
And when did I enter this trade? It's like, oh, if I was long, when would I cover? Or if I was short, when would I cover?
Yeah, and I think, Chris can attest the most important thing when you're trading is preservation of capital. And for me, I'm always looking for a risk reward of, mine is more than most people. I'm looking 5 or 10 to 1, whatever it might be, to come to that type of a ratio. You got to know when you're wrong, first of all. So always understand, for me, like I said, I'm creating some type of a perspective of, this is the third standard deviation. I have some degree of imbalance. I'm kind of visualizing creating some type of a pocket or a lack of trade where the market, can trade into it, but it should reject it. So for me, the market pushing up into this zone right here is something that I'm looking to try to sell. If the market starts developing opposite that, kind of accepting prices, I'm out. But as long as it rejects it, I'm looking for the market to come back down. And we have a area of minus development. I would say, from right here down into here. And similarly, we got this push up where you have a degree of minus development, maybe from somewhere down in this area to a little bit higher. So, it's a relatively compressed range, but I think when you're trading, you just need to find levels that are worth doing something at. And for me, I just always want to do the right trade. You always want to do the right thing for the right reasons. And so you need to kind of look at your data and assess what's going on, and don't just buy something because it's cheap or sell it because it's cheaper, because it get cheaper or more expensive. And then that's kind of the wrong. We're not fundamentalists. We don't understand what the value of anything is. And I don't think the world today you can approach it that way, just because of the liquidity pools people trade, and just the social media out there, and just the ability for, anything and everything to move the markets. And are they correlated, non-correlated? The only way to be successful, I think, in the world today in trading is just kind of reading data, because, Chris talks about his gold, S&P, and the way back in the day, people had silver gold ratios, all those types of things. And, they might work for a time, and it's great to trade for a time, but, it's nothing that you can just trade forever, because they're going to change.
You said make the right trade for the right reason.
Yeah. And I think my mantra in trading is just do the right thing, whatever it might be. Obviously, Chris can talk about that because he's done it, but everyone does, and I have in my life, moving your stop because your trade isn't working and it looks okay in a bigger time frame, right? So how many times have we done that, right?
Yeah.
We don't want to take a manageable stop and it's going to come back, and next thing we know, our current loss is 3 or 4 times X of what the stop was. So if I can do the right thing, I get out of the bad ones, and that's the first step in trading and being successful in trading is managing your losers properly, right, Chris?
Yeah, for sure. And being able to reinitiate again, get, coming back. You guys have had good experience with that, right?
Yeah, or switch up your bias, like going from long to short in a second when you realize you're wrong.
For me, it's difficult to do that, but
I can't.
Yeah. I know that Pete always tells me you should always try to limit one side of the market, and that way you're not whipsawed. And I've had experience with people. A friend of mine, lost $1 million in a half point range, and in the bonds in 3 or 4 hours, just thinking it's going to break out to the upside, break out to the downside, break out to the upside, break out to the downside. So, for me, I'm always going to trade one side, and as Chris said, I mean, you have to have a strong constitution to get back in a couple of times. For me, I have a general rule. I won't do more than 3 times the same idea. Takes me that long to be right.
There you go. There's a great rule. Finally, we're getting certainty rules here. If only you get 3 whacks at it, right? Yeah, after the 3rd whack, you're done.
Yeah, if I can't do better than that, I move on to something else, right?
Right. I mean, people would say that, there's the Einstein quote of, doing the same thing and expecting it to be different. Right. People would say that, they always say, take a walk or something, right?
Oh, yeah. I mean, I remember Pete always says, if you ever, you made reference to it, back in the day, when trading off the floor, calling into the broker and entering orders and things like that. And you ever get angry and start pounding, slamming the phone or whatever it might be, you gotta go take a walk, because you're in the wrong space mentally, And
even by Friday, most of us are yelling at the screen.
Right.
I mean, I guess one thing we're learning is patience, right? Essentially, the idea is that you can't force the market to do anything, and a lot of times you're sitting with the trade that doesn't feel perfect at the time. It's not, you're right there and wavering back and forth.
Right.
And you most people find that extremely uncomfortable. Will probably do many things to mitigate the stress when in fact you need to be able to sit with that.
Yeah, I mean, my solution is just turn the monitor off. That's always my solution. I mean, if you have a stop pin, right? I mean, you don't have to die by the 1,000 cuts or whatever it is, right? I mean,
Right.
I mean,
Right.
I guess I might not optimize the exit, but at least I'm not gonna, the market's 5 handles in my favor, 3 against, 4 in, 2 against. I mean, you've been there, Chris, right? I know.
Yeah, oh yeah. And then I tend to get, well, many people do tend to get worn out and then cover too early and when they're right, because
Oh yeah,
generally more of the times than not we're right. It's
yeah,
just that the timing is, of course, difficult.
yeah. I think the ability to read a chart it's not difficult, but I think
The
yeah, the
bias is like
biases. Yeah,
you swear this thing's going up or this thing is going down,
right,
and that will bury you. Anybody
right.
who's listening, you make sure you show up with no bias, or if you do have a bias, have a stop.
Yeah. No, I think I said I think reading a chart isn't hard, but I think just putting the trade on and managing the trade, and that's another thing to touch on. I think most people spend the majority of the time looking for an idea and less time managing. We've always said, 75-25. I think, a person should spend less time looking for it and more time managing it. So if I can look at a screen, any screen, and within probably 20, 30 seconds, figure if there's something worth doing, and another 10 or 20 seconds where to do it at, put the trade on, put the order in, whatever it might be. But then how does the market act once I put the trade on? Things that I look at is volume. How is the market from a volume standpoint? Is it getting more interest or less interest? Different things like that. The trade selection versus, management is skewed versus what it should be. Spend more time managing and less time selecting.
You
Yeah,
certainly learn by experience.
Yeah. Mm-hmm.
this would be a good place to wrap it up. I'd like to start, Steve, you mentioned volume analysis. I think that's kind of
Mm-hmm.
something that could, we can go a whole episode on. So I think
Not a whole lifetime episode.
Whole hour.
a whole hour.
Right.
So I think for today's lesson, that was fantastic. And we learned a lot and kind of really got into depth and looked at some examples, which was awesome. I really enjoyed that.
Yeah, I mean, this is pretty high level stuff, you guys.
Yeah, I think volume. I mean, like we talked about. I mean, we've always looked at this is a price database, we'll call it, and I think a person can trade a volume database just as one can trade a price database. So I think just looking at the market from that standpoint, there's definitely some very clear triggers that you can look at with volume that we can touch on.
I just want to take a second to interrupt this episode. I hope you guys are learning stuff so far, but I do want to give you an opportunity. Now, I'm going to be trading every single morning. I'm going to be live. You're going to be able to sit and watch me enter and exit positions, executing the system that you're learning now. If that is of interest, I'll put a link in the description below.
Remember, Pete used to always say that once you have an imbalance in the market, it tended to go on longer than you thought, and the opportunities carry. It was very difficult to get out once a market was imbalanced. It was very difficult to get that imbalance out.
Right. Mm-hmm.
Which is interesting because if you discover about the market about to go in balance, that he would say good opportunities carry further than you ever think, and that was predicated on the fact that an imbalance once in process would stay there for longer than most people think.
Right, and that's also a function of your time frame too, right? I mean, I think some of my friends who have CTAs, you probably everyone, old guys like myself and Chris have heard names like Richard Dennis and people like that. He's probably one of the most well-known trend followers from the 90s, right, Chris?
Yeah. Richard Dennis was the creator of the turtles.
Yeah, correct. Yeah. Yes, I know some people that were turtles or whatever, and their belief, was that and Richard Dennis, I couldn't tell you exactly what his strategy was. I could give you a general idea, but it's trend following breakout is what he would do, and essentially what he would say was, if the trend was a good trend, and obviously they would have some amount of duration to it. It would probably take 2 to 3 days for all the people to get involved in the market. Whereas Chris can talk about old market profile and trend days, and trend days might happen, and what is a trend day? A trend day is when the market's distributing. We're seeing a series of prices in one direction, higher highs, higher lows, lower highs, lower lows. You might have one period where the market is counter to that, but essentially you're going to see that type of activity within the day, and there's going to be probably a 90% probability that the market's going to close within 10% of the extremes. That was kind of the definition of what is a trend day. And, that's that Board of Trade manual that I talked about, those things are talked about in there. But, I guess my point is that, trend days might happen 10% of the time. So there's 20 trading days in a month. So we might see two trend days in a month. And then when you see these people, fun guys putting on these trend following strategies like a Richard Dennis, it could take a number of days to put the trade on. So I guess my whole purpose of this drawn out explanation or topic is that, the activity you're going to see is going to, as Chris mentioned, is going to go beyond your expectations. Those expectations could be contained within a day or 2 days or 3 days or 5 days, or even, nowadays you're seeing all these algos, and you're going to see these little micro distributions, right, or imbalances, and you can see the market move vertically quickly, and it could be over in 5 minutes, but you're going to see a big imbalance coming in.
It's certainly interesting to recognize. You can recognize a trend day by the fact that the market continues to make higher high. In the case of it going up, makes higher highs and higher lows all throughout the day, and it becomes fairly obvious that it's not going back to prior ranges. And then the rule of thumb, which is surprising to me after all these years, is that it will tend to close near the extreme, in this case on the highs. And it seems so obvious, right? You're like, oh, it's going up, and like there's no way. It's so obvious that they're going to just close it on the high, and yet time after time after time after time after time, it just continues. That rule has stood the test of time,
right?
Surprisingly.
Oh, exactly. Also, if we're talking about this 10% trend days, and we're talking about being dominant in the market, and Chris can comment on a trend day, what happens to locals in a trend day? What is the purpose of a local, right? Or what is the purpose of a market maker? They're taking the other side of a trade, right? So on a trend day, that's when they get hammered, right? The locals are making money when the markets are just vacillating back and forth, right?
Yeah, well, the mental process was like, oh, okay, we see it going up, and so you're, as if you were standing in the ring, what were you doing? The brokers were executing orders. Well, on a trend day higher, every broker was a buyer, so you knew that if you were going to sell them, you were going to have to be quick to get them back. But I mean, the initial thought process was like, oh, this guy's paying a ridiculous price. Right? Like, I will sell this to him because I will be able to buy this back cheaper. And then the next broker's got another order to buy.
Right.
And then the next broker has another order to buy. And then the next broker has another order to buy. And you're all of a sudden trying to buy them back at a higher ridiculous price.
Right.
Yeah, you do not want to go down the rabbit hole of averaging a loser on a trend day.
Probably the last 3 or 4 years, trend followers have done well. Prior to that, the previous 10 years, they did poorly. So that's the cycle that you see in the macro. You can, the 10% trend days, 80% or 90% non-trend days. It's all the same thing. And I guess my point is, if we can understand, is the market in more of a tendency or a probability of seeing more trending activity, more mean reverting, and if we could flip the switch, we would be golden. Can I develop strategies that are trend following and mean reverting, and sync those up when the markets are mean reverting or trending? Then I would be God, I guess, right? But
yeah,
easier said than done, right?
Yeah. I mean, how's this? If you know all the selections available, that's the first step, right? Is it a trend day? Is it a mean reverting day? Is it and so just so you are aware as a person who's out there trying to fit the pieces of the puzzle together, at least knowing whether it's a trend day or knowing whether it's a mean reverting day gives you a leg up on people who don't even understand structure.
Right. Yeah, I think if you have a foundation of understanding that can kind of give you some perspective on what to do and what not to do. I mean, like for me in trading, in Stoudemire, I always said, just kind of back up against the wall, back yourself up against the wall. And you always just want to be trading the market from one perspective, whether that be long or that be short. So if you can go in with that type of a perspective, I think that's advantageous, and that would be, kind of more of a function of, is there a tail, right? I mean, if I have a tail, then that would be a condition under which I would have a bias.
Gents, that's a pretty good right there. That's a money clip right there.
I like it.
Right. So the first step is to get your back up against the wall.
Right. Just like you're in a fight, right? A street fight. You don't want to be in the middle of a ring, taking on 10 different guys. If you have, at least you're protected on one side, you're going to have a better chance of something working out for you, right?
Right. They like the cowboys playing poker, never sit with your back to the front door.
Right. Right.
That's interesting. That's so old school knowledge. It's not like programming knowledge right there. It's like have your back to the wall.
Right. Right. all these old school analogies, right?
Yeah, they're great. They work perfectly.
Yep. Yeah. I think they stand the test of time, right?
Mm-hmm.
So here, we're getting to the new stuff here, past was review. Now we're getting to the internal time clock of the market, and just understand this is in the context of the distribution, right? So does one of you guys just want to read the first couple of sentences, and then I'll go down to that little box below?
Yeah, sure. So the logic behind the internal time clock of the market is early on in development. Participants have not been able to acquire enough inventory, so price will continue directionally until an equilibrium price is met, allowing buyers and sellers to match up. At that junction, the model point will grow, and the metric below can help understand what's next for the market.
Yeah, okay. So that's kind of an explanation of what is it that we're trying to understand, and what we're trying to understand is the distribution process or the auction process. Conceptually, just think about a market opening, and it's easy to use that as an example. A new market, the market opens, and there's price discovery, right? And the market's going to move higher, it's going to move lower, and why is that? It's going to be more buyers or sellers and buyers, and it's going to set up some type of a price discovery, and then people are going to be interested in buying or selling those prices, and it's going to create some type of a vertical move. So what we found is if you're building a profile, we understand the sideways trade is where the prices are accepted and overlapping, and where there is single prints or a lack of lots of double prints or prints, then that's going to be an area where the market's more moving vertically. So, we have, when you're building out a profile, the 0 to 18 time slots used, that would be a situation we're talking about letters overlapping. So that would be a situation in which the market could be in a continuation mode, so kind of a trend continuation. Then once we reach 19 to 29 time slots used, once again time slots used, we're talking about overlapping letters. That's the market has reached the level of containment. Therefore, we're moved from a stopping to the development. Remember the 4 steps of market activity, series of prices is step 1, and then the stopping, and then developing, and then moving to efficiency. And the move to efficiency could be the reversion back to the starting point, or it could be continued in the start of the step 1 direction.
So just so people know, it's just a matter of the profile getting wider at its wide spot. Is that right?
Mm-hmm. Yep, you're trading around that, and we're just going to try to really be able to, or hopefully be able to have some type of context as to where we're at within this whole development process. Early on, what is a trend day, right? You don't have lots of overlapping letters. Some type of a balanced profile, you're going to have lots of overlapping letters. So kind of putting the market into context, is going to put you in a position to be able to, hopefully take advantage of, what is occurring in the marketplace.
Yeah, that's cool. It's like you're in step by having these definitions.
Yeah. And, I think just kind of being able to visualize this whole process, I think that's what's helped me in trading. And I think profile people, I think that's kind of what puts them apart from how other people look at the market. And that would be that, they're creating some type of this perspective of what is the structure and where is overlapping and the degree of overlapping. And you can gain lots of insights from that. And, so moving on, we're talking about the 30 to 42 time slots used. And that's kind of the normal development time. You're looking at the market creating some type of a little mini auction. That's what we're looking at. It's all these little auctions. And once you get out to 30 to 40 time slots used, we're going to say that, that auction is complete. What can happen? 2 things. The market can move in either direction is essentially what we're saying. So, if you're tracking the market from this perspective, that would almost be an alert. If a person is like Chris and they're trading options a lot, then that would be a condition or a situation in which there'd probably be more buying volatility, right? Chris can elaborate on that. Once the market is matured and has moved to a balance point, they go from balance to imbalance. And so, Chris, what would you do under those conditions with an option?
Well, let's just say first, Pete would say, we've arrived at a place of balance. And so by default, we're ready for an imbalance, right? But he would also say that just because a market's balance doesn't mean that it has to go imbalance.
Correct. Mm-hmm.
So the
Yes.
idea is that you would first look for the market to close off a direction vis-a-vis many different ways to shut off a direction. And then you would, of course, want to go with the move. You would buy strength rather than sell strength. It's complete 180-degree opposite to what you would do in a reversion to the mean program. So the benefit and the understanding of everything Stephen's telling you is that you can become in step with an organic process that is out of our control. And so to answer your question, what would you do with options? You would want to be long the options and in the direction that you expect the market to go vertical.
Right.
And then Pete would always say that the chance of a retracement from the market going vertical out of balance is zero. In other words, he would say it this way. He'd say there's zero chance of a retracement if the market is leaving a balanced position and going vertical because so many people are trying to get involved.
Right.
And or control damage if they're wrong. So that's actually the very safest place. It's so strange. It's like you're operating with the least amount of certainty because the market's been balanced and you're leaving a balanced position. But if you are right in regards to judging where you are in that cycle, it's the safest place to trade.
Right. And also, as you said, the safest place to trade, partially because there's an easy exit, right? You're not you're having a situation where there's a big balance area. There's the perception is that that's the fair price, and so if you're stepping out and looking for the vertical move and it doesn't happen, you're going to lose some money, but it's not like you're catching the proverbial falling knife and they're going to get your head handed to you.
That's a great point. And the threshold for being right or wrong is short in time. Right? So you can, if you're looking for a vertical move, if you're not right immediately, you should get out of the trade.
Right. I mean, I think if you've been around in the markets for a while, and especially with all these algos and things like that now, I think the proper approach to trade from a shorter term perspective is to trade time and not price, right? I mean, you're looking for something to happen and it should happen, immediately, and defined immediately, that's all relative to your time frame, but immediately is a short amount of time. And it's different for me and for Chris and for you guys and everyone else in the audience, I'm sure. But, for sure, there's one thing that you can say is that, when you are looking for the market to move vertically out of balance area and it doesn't materialize, and it's, I just use the analogy, it's stuck, so no sense in looking for something and trying to squeeze it, just get out of the trade and then move on and look for something else.
No question. That's a great distinction to make there. And Pete used to describe it as the stock market as an urgent market, right? I love that. It's right. always in a rush.
Right.
So if it's not going immediately when you put the position on, and its general tendency is to be in a rush, definitely heave to the sidelines.
Right. There's that's the one thing a young trader probably needs to learn. Probably one of the most important things, and Chris probably agrees with me, is there's a lot of downtime and don't force yourself to be involved in the market. I'm out more than I'm in, and Chris is probably the same.
Yeah, I always say you have to be very discerning about the initiation of trades, because once you get into the process of a trade, we're all good at managing, even losing trades. But the idea is you can avoid a lot of headaches by making sure that the first step into the river is a good one.
Right. And I think people that I'd work with and what have you, I've always said in trading, the most important thing is to do the right thing, so to do the right thing is getting out of a bad trade and not trying to squeeze a trade. And when the opportunity is there, take advantage of it and don't second guess yourself and just kind of go with the process and, understand that it's a statistical probability business and understand that one or two or five bad trades or trades that don't work out doesn't necessarily mean that your idea or strategy isn't a sound one. You really got to give it a large sample size of data points to really assess if you have something that has merit or doesn't, and don't just look at your last trade and just start trading a different strategy just because you've had a bad trade or a couple of bad trades.
Mark talks about that all the time, style drift when things aren't working.
Yeah.
Okay.
Mm-hmm. And also, I mean, at a certain point, you have to realize that maybe what you're doing that was working is no longer working. And I think for some people, and I've spoken with this trader back in LA when I was in LA, he traded based off, I don't even need to go into detail. He'd find something that would work. It would work for 3 to 4 years, and then it would stop working. And it would take him about 6 months to figure out that what he was doing no longer worked. And he'd build trading algorithms, and it was more, obvious to him that what his edge was within the algorithm that he built out was no longer going to be effective. And so how do you, if for someone watching this, if they have something that's been working for them, at what point when it stops working, when they're on a losing streak, how do you discern whether that's the time you're going to step away and find something else, or whether it's not going to work, or whether you got to push through that?
I mean, my opinion would be, are the conditions of the market the same? So I mean, as in the conditions are, for instance, the volatility. Are we seeing similar type of volatility? Are we seeing a situation, talking about, the market's distributing or developing? What conditions, under what conditions do your strategy work? And I think if the conditions, in theory, if the conditions remain the same, then the strategy should work, right? If the conditions change, then the strategy won't work. And I think also it's a function of what the algo, as far as what is it trading. There's little inefficiencies, and I'm in Chicago, and you've all heard of Citadel, and some of these big houses, and they're big market makers, and I know people that work at basis houses and trade treasured fixed income stuff, and when Citadel got involved in the market, they took away all the inefficiencies. So back in the day, there might be some type of a spread between the trade. You trade the yield curve or the basis, whatever they're trading, and you could always make a little bit of money doing that. But then when Citadel came in, they just overwhelmed the market and they removed the inefficiencies. So I think what is the strategy you're working with? I guess most importantly, if it's something that has a very, very, very short-term time horizon, I know people that trade algos that look for just little inefficiencies and just like taking little ticks out of the market. And I can understand how those could be overwhelmed. But if you have something that has some structural integrity to it, then I would think it's probably not a bad strategy. It's just conditions have changed, and you could almost, put that on the back burner. And I would be confident in saying that once the conditions reverted back to what they were, that strategy should probably work again.
Okay.
The understanding that the market is an economic process. It's not a mathematically based formula. And so the reason that all these things are working in the structural perspective is because this is a capitalistic system. This is the way the markets work in a capitalistic system.
Mm-hmm. And I think that I don't know what the time frame was that he was trading, but I call them opportunists, and that's great. I mean, anyone who's been involved in the trading space, they probably know lots of people who have had that same experience, and they have something that just really knocks the cover off the ball for a while, and then it doesn't work, and they got to go and create or develop something else, and it'll take some time, as you said, to find something else. And I think if you're Chris and myself, I think we have a foundation of what is a structure. And I think if you can build something around that structure, then you can pivot a little bit, or don't even have to pivot. You can just kind of drift, as Chris called it, or just a little subtle change to what you're doing might kind of move something that was great, and then it's had a setback. And then if you make a little adjustment, then you're going to be back in the game again. So if you do have a good foundation and a good understanding of markets, that's why some of these big CTAs have been around for a long, long time, because they do have something that has merit. And I would assume that a lot of these guys have been in the business for a long time. They've had some subtle changes to what they're doing, but I would bet that the core of what they're doing is similar to what they were doing when they started and then built up their careers.
Okay. All right.
So the last little input here, we're talking about the internal time clock of the market, and then the 43 to 75 times let's use. That's when the market has reached a state of overdevelopment, and price should move in the opposite direction that it took to get there. So, we've all seen it. The market's, it's price discovery. It's trying to create some type of an area balance, and it tries to push and push and push one way, and it can't achieve any more movement in that direction. And so you have the people who are trying to push for that next leg lower, they're going to have to cover. And then there's also people that are going to be reflecting back in the mean reverting types or the guys looking for balance. This is an extreme, and we're going to try to trade against that, and that's going to cause the market to reverse what pushed it in that direction. So what we have is trying to understand the market in this context. I think really helps you understand is the market and have a greater chance of continuing or reversing. And I think if you can kind of get yourself to that place in trading, then I think you have a bit of an edge. So I put together some slides, some screens here. This is the S&P. You can see these are bigger composite units. You can see the date. This is from 11/14 out to 12/06. I've highlighted the point of control, so that's talking about the time slots used. That's exactly what we're talking about. So, and in your profile, there's a lack of letters. There's less trade. Well, there's lots of letters. There's more trade going on. So, what I want to focus on, if we toggle back, and the thing that stands out the most for me is if this last entry, 43 to 75. I'm always looking for that because that's when the market potentially can change, and that's a pretty easy, straight opportunity for you to try to look for. So and the next on the screen that I've highlighted for you, I've kind of put fat rectangles around areas where we're within that 43 to 75. So just understanding the market is moving down. In this example, we get out to a situation where we're overdeveloped. So my bias. When this thing gets overdeveloped, early on, it's going to be 10-20. It's going to be in continuation mode. Then 30-40 more doesn't give us a direction as to up or down, but we should be getting a move. Then once we get out to 50 or 43 to 75, that's when the market is going to be able to try to reverse what got it there. So we can see that happened here. The market came down. Got overdeveloped. It reversed and traded higher here. The market became overdeveloped here, 43 to 75. You got to 52. The market came down from here. The market rallied up here. You got 43 to 75. The market came down to here. So, once again, being aware of getting out to these development zones and the propensity or probability that the market's going to reverse kind of puts one in a favorable position, I think, to try to take advantage of the market. Understand that we're building a bigger composite unit. So each of these, profiles are, 2+ days, we'll say, and we're monitoring these things working sideways. And, we'll just say that you don't have access to a profile, but you have access to a 30-minute bar chart, right? So if you want to go through monotony of counting out the overlapping periods, and you could do that within your software, then being alert to once this thing gets out to 43, that the market should be in a position to try to reverse the direction that got it there. And I think that's quite a useful tool.
No kidding. That's really useful.
I like to have a perspective and get a favorable price entry. That's what I would call myself. Some people are just initiating traders. They want to try to go buy high or sell low. For me, I want to go with the background, but I want to get a favorable price. So, this could be the starting of a favorable price. If I think the situation, is such that then Chris can look at, this is a couple days ago, this was the 6th, so this was last week's high. And what was my perspective last week? Was it, with the market pushing up, was there minus development? We talked about that term before. Was there something that would have told me that, somewhere up in here, the market, was rejected? There's a series of prices lower. There's some type of selling. There were single prints back in a bigger structure that would lead me to believe that maybe the bias would be down. Then I get to this situation where we have the short-term positive price action, then the overdeveloped, leading me to believe that the market could retrace to the downside. Then I have a background picture that's negative, and there's a more immediate overdevelopment would say, I want to be trying to trade this thing from the short side. And I don't know how many handles it broke, but it broke quite a few. Chris knows better than I.
Yeah, this week it dropped 4.5% after, was it last week's that speech where Powell rocketed the market 7% in a day or something of that nature.
Okay. So just once again, looking at this example, and the next screen is just going to be nothing more than, adding on to this last page here. But just notice that we had this market developing here, and we talked about the 27 time slots, right there. That just means that over all these letters, lots and lots of half-hour periods are represented by letters. And we had the point of control or the modal point out to 27 periods. And looking at the next one, what happened, that would be this one right here. We're out to 27 right here. And then, that was lost. And then the market continued lower and we got down to 29 here. And then, the market once again, understanding that this 30 to 42 was kind of the hot point for the market to continue for potentially to move vertically, because that's where the market is in a high degree of price control. Once you get out to 43 to 75, once again, looking for the market is at a high degree of price control, but we're looking for that as an extra condition, and that condition is that it should try to reverse itself. So understanding or referencing these areas of high degree of balance, understanding where you're at as that thing is developing, and understanding if you're ripe for the market to move vertically, or if you're ripe for the market to move vertically in another direction, is what I see as far as using the internal time clock of the market.
Got it. That's genius.
Yeah. I think that's kind of really set the tone, and from a shorter term perspective, there's lots of things you can use as far as continuation, just to Chris's statement, market's balance, and then you get to imbalance, right? And then so early on, we get up to zero. Well, I guess there's never zero, but 1 to whatever, that's the 18, that's kind of a trend continuation. So Chris puts a trade on and it starts moving vertically, if he really wants to stay with the potential of a move, he could let that thing get out to 18, periods of overlap, and that, which is 9 hours of trade, and it could take a day to achieve that. Who knows? But just that kind of gives one a perspective, and kind of aligns with Chris's statement of you never know how far a market's going to move. That could kind of give you a perspective of maybe this is when you're getting close to the market moving to a price where it's going to stop.
That's pretty good. That's pretty good right there.
Yeah. So
I just want to interrupt this episode to give you guys a special opportunity. Now, I'm actually going to be trading live every single morning. If you want to sit over my shoulder, watch me enter and exit trades, and put this system into practice, I'll put a link in the description below, and I hope to see you over there.
We're going to just kind of continue this process of understanding an auction, which is a series of prices and some type of stopping and a balance. And so I've moved on from the ES to the Bitcoin. I know lots of people like tracking the Bitcoin, and it's out of favor a bit now, but who knows? I'm thinking it's going to come back into favor. But I think from all the presentation we've sat through, I think we understand that by looking at this bar chart, I think we'd be in agreement that this would be some type of an imbalance in a little bit bigger time frame, and the same thing here and the same thing here. Then we're getting some type of a counter move or some type of a balance, and so these are very clear 3-2-1 downs, I think, where you got a nice tail up here, and the same thing, this push here, you got a nice tail up here. This one, you had a tail that a lot of it was eaten away. Did this 3-2-1, revert back to a 3-1-3. It's close, and once again, we're not looking for contention there or argument or nothing more than just trying to get a visual of what's going on, but just get an idea on how one can use, the next step of what we're looking at, which is volume. So I think that if we understand that the imbalance at 3-2-1, which is what we're looking here, or the tail, is the bias that's been created in the market, and that's what I want to be trying to lean against. So I see some type of visual that looks like this. And, once again, this is a bar chart, and then each bar is a minimum of 6 periods, but it could be more than that. So just understand that we can trade when we're trading, and I think Chris is the same. I mean, we're looking at the market from the long term first, or the background, and then we're going to tighten it up. So, what I'm looking at here is a bar chart, and I'm now showing some similar information, or the last 10, 12 bars of this screen here. This last little bit here, we'll say, is what we're going to show in our profile mode, and that's what we're looking at right here. And so, this is our time variable profile. So this is, those free-forming profiles. It's going to be something that has a volume filter on it. And, as you can see, there's lots of blue and green and one single red. And what is the red? Yes, one of my favorite trades in trading from a volume standpoint is seeing where the heaviest of heavy volume is. And so we know somewhere in this profile is the heaviest of heavy volume. So where is that? I can drill down with one more screen, and I've just referenced it with this array here, and I haven't finished the screen yet, but this is towards the top of the trading range, right? So I like to try to understand, for me, when I see an potential extreme put in, I want to see people on the wrong side of the market. So this example here, if we're at the tail end of this screen over here, this is some form of a 3-2-1, and we see buyers trying to probe higher and push this thing up above this balance point, trying to create some symmetry this way. And then that doesn't pan out for them. Then I'm thinking that this background, this imbalance to the downside is going to overcome this imbalance to the upside and assist in rolling the market over. So
Stephen, is that all the king's horses and all the king's men kind of thing?
Yeah. Mm-hmm. Yeah. And I think it's the speed at which it happens is important. So I think that the quickness at what you're seeing here, and then that's what I want to see now is this thing rolling over and creating some type of an excess here. As if it just kind of continues sideways here, then this isn't such a great trade idea. But yes, everyone's involved on the market to push it higher like this, and then you got this last little hurrah, people coming in trying to trade above the old highs, and then overcome all this imbalance. And I think if they understand how markets work, they might not be acting that way. But what we're looking at is a situation now where we're thinking that if these buyers can't push this market higher, then they're going to step back and say, we'll say this is a week's worth of activity. I'm buying the high of the range the last week, and the market's in more of a downtrend, and maybe I shouldn't be buying at the high of the range, and then I should be, I'm going to get out of my trade. And then the people who want to be short, or they want to add to a position they have already, or people that don't have a position, they see the trend or the bias is down. You look at moving averages, that would be something that would look a little bit negative, I would think. And so, they see the market put in some type of an extreme. And we talk about the market's balance versus imbalance. Chris, this is a situation, right, where the market, this is balanced in the short term, but it's imbalanced in the long term. And just this little push up, is creating that little situation where if someone does just want to try to trade the imbalance, which is nothing wrong with that, but I see it on heavy volume, and as Chris said, of all the king's horsemen. So everyone and their brothers bought the market and trying to create an imbalance into an area of negative price action, and then the market starts to fail. There's really not a lot of hope for this market to continue higher.
Yeah, the price behavior of a particular asset class is its best marketing tool for more money to be allocated to something. So if all the king's horses and all the king's men try and push the market higher and it won't go, it's not marketing itself very well.
Right. Yeah, and I think you see that in all markets, whatever they might be. I mean, Chris has seen it on the floor. Like, I'm from Chicago, so you got the grain floor, and then you get the grain reports. And back in the day, they used to occur before the open. The grain markets used to be open from 9:30 in the morning till 1:15 in the afternoon, and you'd get the grain reports at 7:30. And there's some big grain reports, they're very important, and they could really cause big price movements in the market. And so you're going to see something that comes into the market. You have a grain report, and we'll say it's very, very bullish, and the brokers are going to call the market, an hour before the open, up 20 cents, or we'll say up 30 cents. Then, 10 minutes before the open, it's up a dime. Then, on the open, they're just before the open, it's unchanged. So, we know we have a situation in which, either the market is extremely long and there's no one left to buy the market, right? Or there's just something in the market that really creates a negative tone to it. So I think trying to incorporate what's happening in the market, with the idea of volume and expectations. That's why I think, for me, looking when the CPI comes out or any non-farm payroll, for me, the only thing I want to be aware of is what is the forecast and how it comes out. So how does it deviate from the expectations? And knowing how the market's set, and you can look at it, it's more skewed to long or more skewed to short, and how the market comes out relative to expectations should really give you some insight as to what's going to happen on once the actual number does come out.
Okay.
It's interesting. It's like logic doesn't necessarily apply, but market behavior against collective expectation is relevant.
Right, exactly. Yeah, I mean, today was a perfect example, right? I mean, we're talking about the CPI before you came on, and I forgot exactly how it came out, but it came out, the numbers were higher than expected, right?
Right. PPI came in hot today.
Today, PPI, okay.
For people who are watching today, in the future, today is December 9th, as this was recorded on December 9th, 2022.
Yeah, and the PPI came in hot, as you said, and I think maybe the market came off a bit, right? And then surprisingly, it managed to recover, and then it got tanked. So, what caused it to recover and what caused it to tank, right? I mean, expectations, had to change within the day. And, is that there's, I guess, PPI, so we got CPI next week, right? Then we got some Fed meeting or something. So it's always, the market's always a moving target, right? I mean,
like you say, right? It's always waiting for something.
Right. So,
gents, any questions?
No, I mean, I think that's, what about you?
I'm pretty clear on it.
Pretty clear on this.
Right. I mean, that's pretty interesting perspectives. Hey, Stephen, in regards to volume, what's the most recent thinking on volume? Like it used to be that we'd look for one opposing force to meet another opposing force, like two giant battering rams or something like that. And now the most recent thinking, I think, is that just one side loses interest.
Yeah, I mean, that's the whole price discovery thing, right? I mean, so something's happening in the marketplace, and way back early on, right, when you're on the floor, you'd see new highs and new lows, and you want to see noise, right, or you want to hear noise. That kind of indicates interest, right? And then, the same thing, on the screen, people be looking for the same thing, but nowadays, right, better than I, but it's easier to put a high ball or a low ball in the market with electronically than it was on the floor, right?
Yeah.
So, there's all kinds of people, looking for new highs or new lows just to check for stops and things like that. But, I think the market's 180 different now off the floor, or since markets moved electronically than what they were on the floor. I think now we're always looking for a heavy volume to be more exhaustive, like on our CQG, remember when the high beam, there's lots of activity to get the background would light up, and I would call that the high beam. And so when, I think that's when the brokers weren't held, right? That's the reason that would happen. And so I think when that chaotic environment would be on the floor, would be referenced with your charting or your quote provider. And, I think that's what we're seeing as far as, just like capitulation, I think people are waiting. Some people think the bottom's in stocks. Some people don't. Some people say you got to see capitulation. I mean, there's lots of ideas going on around out there as far as what's going to be indicative of a top or a bottom, and using our term like crazy lines, right? For me, that's the most powerful thing. Like, this is a great example. This chart, this is a good print, and working with our data provider, we got to assume this is a good print. I honestly haven't paid that close attention to Bitcoin, but if I would see some price action like this in such a hard reversal, I mean, I would say this is something we can lean against, right? So I think always in trading, looking for the volume. Exhaustion is what I think is powerful. And I think, is it two parties matching up? Sometimes it does. And when two parties are matching up, I think, what are you going to see? You're going to see a tight range. When they're not matching up, there's going to be a wide range. Personally, I always want to see the people on the wrong side of the market in a wide range. That's, if at the bottom, people are selling at the whole, they've got terrible prices all throughout it. And, that's might be the bottom. And I know people who use our software and they'll just trade these red profiles religiously. And, I think, Chris knows who I'm talking about. One of our guys in New York, a big stock trader, he just watches a database of 100 stocks and he just trades these red profiles, and he makes money religiously. And, I think that's a program that anyone could trade and then have good outcomes with.
Volume isn't, when I thought we were going to get into volume, I'm thinking of the classic brokerage bar at the bottom of the screen that showed the amount of shares.
Yeah. I mean, the volume profile, we've really moved away from that in, 1998, I think, 20 plus years ago. I mean, we feel, because if you think about it, there's a profile that's moving around. So this profile here, obviously you're going to have the volume histogram. You're going to see the preponderance of the volume right in here, right? Yep. But what might be interesting to see is, we can't see it, but you're seeing the market obviously rotating up and down, back and forth, right? So I want to see, when I say rotating up, that means a new high versus the previous high and held the new low, or rotating down, a new low versus the previous low and held the high. So I want to just kind of see within this profile here, what's going on. Is the market, this profile is going to have some degree of net something. It's going to be net buying or net selling. So if I can get a feel for what's going on in the market, that's going to be more advantageous to me versus, a volume profile that you're talking about is, essentially, the volume profile is going to be the same as the market profile, probably 90% of the time, I would say. Yeah, when it doesn't, you're the one plus you're going to have would be on a day like this. You are going to see little nodes in here somewhere where you might see some darkness, right? Some volume that I can't see by looking at a traditional profile.
Yep.
So that is information that you can take advantage of, but understanding that how we look at things, we look at volume at time. So we're looking at all the volumes that are occurring in these half-hour periods in this case, versus volume at price, which is what the old profile volume histogram would be.
Okay.
Oh, that's an interesting distinction. Volume through time rather than volume at a specific price.
Yeah, I think looking at the profile like we do, we've made references to the times of the day that things happen. So obviously, if you're looking at a volume profile, you're not aware of the times of the day or the different letters or things like that. So my preference is the time variable profile or market profile, just because you can kind of get a lot more information out of it. I think the why is this chart better than just a vertical bar here, just because you can get the depth of the bar, right?
Yeah.
Just like all of this, you can find these pockets where there was price acceptance or price rejection. So I think just the more information, I think our process or our concept is relatively simple, but there's a lot to it, and understanding all the working parts, is going to really put someone in a position to be able to take advantage of it, and I think give a pretty clear perspective on what's going on in the marketplace.
Okay. All right. I think I want to encourage everyone to watch these lessons, go over them a couple times. This is a lot to kind of take in, take notes, it's going to take that. It's not going to be, you're not going to understand this watching it the first time. You're going to have to watch it a couple times.
Okay.
So, yeah. But thank you, Steve. Thank you, Chris, again. Sure. So far, I mean, this has been just an amazing journey. I feel like we've been on a journey filming these and kind of coming to the end, which is sad in a way, but we've learned so much. So I hope you guys are enjoying. And again, thank you to Steve Hawkins and Chris Caddy. You guys are awesome.
Hi, everybody. This is Chris Caddy. I'm here with Steve Hawkins. We're very lucky, and you're watching something that's recorded on December 16th. You're very lucky to have Steve Hawkins teaching you. Today, we're kind of doing a nuts and bolts, take your trade apart approach, how to get in, what to do once you got in, and then maybe how to think about getting out. And then after we go through that stuff, we're going to look at the volume, how it relates to market profile. And then, of course, in anything, it helps to be aware of the structure behind what you're looking at and the present day. So we're going to match up some past bigger structure things against the present moment. And then we'll wrap it up with some special situations. And if you've been trading lately, I'm sure you're aware, right? It's always the special situations that happen. It seems as though with artificial intelligence, anything that's already happened doesn't happen too often, because the machines are good at what's already happened. Anyway, without further ado, this is Steve Hawkins. He's a genius about market profile, and we're very lucky to have him here.
Oh, thanks for the compliments, Chris.
You're welcome.
So I think this is our fifth session here, as far as covering this material. And I think the material we started with, as far as first I'll advance to a slide. Just once again, I want to hit on the books that you can pick up to get more educated on the methodology. The legacy stuff would be the More to Trade PDF, which is free, or if you want something more advanced, you can get my book. Wiley's the publisher. It's a great book as far as getting you up to speed on how the market profile has evolved. Any questions, here's an email address. And if you have any interest in the product, the software that we use within the presentation, of course, you can get in contact with me. I'll be happy to give you a demo of what the software can do.
Hey, when was the PDF at the Board of Trade created? Do you remember?
Yeah, I think I noticed on the maybe 98-ish, something like that.
So, and when was the book most recently updated?
2005, I think, something like that. So it's there's 5. I mean, and the PDF, obviously, it was written or published in 98, but it's all the material that we first came up with in the mid to late 80s. Really not a lot of new material between that and when my book was released. So it's my book has probably 20 years of or 15 years of new material,
on that, right? Yeah, both of them are very excellent for anybody who's watching. I mean, you kind of have to be a profile nerd, but it helps you make money. So I would suggest that they're worth free is good, first of all,
right.
and the book's not that expensive.
Yeah, I think our profile groupies, we have like cult groupies, whatever you want to call them, but I think it's a good foundation to trade from. And I think Chris has been around a long time, as have I, and I think the most successful people I have, I'm not going to say they're profile guys or they're Elliott Wave or whatever, but I would say they're people that really dedicate themselves to one approach and really try to build a foundation on that. And I think that's the way to be successful, whether it's trading or whatever you are with your life. It's always important to be consistent in building something versus being haphazard jumping around. I would always advocate that.
So, for everybody who's watching, we're going to start up with the idea of the nuts and bolts, right? How do you enter a trade? Like, what do you look for, right? It's not like I feel like the thing is going to go up, right? You have to have a reason.
Right. You have to have an objective.
And since you're watching whatever it is that you are interested in trading, probably you're going to be early.
Yeah, you have a tendency for that. And I mean, I think that's more the case if someone's focusing on one market. But if you spread yourself out amongst a lot of different markets, then there's probably less likelihood of being early just because you're not on top of the market in a timely fashion.
So what is the thoughts on early, right? You were saying it's better to be early than late. Or no, you can be early, but you can't be late. I think you said.
Right. And I mean, we've all seen it, just think about it in the context of Bitcoin, who I would assume a lot of you are familiar with Bitcoin. And we'll just say when the market put the top in, whatever that was, 67K or whatever it was. And I remember rallying. I remember kind of getting involved with it a little bit. Via a friend of mine, I think it rallied from something and then ran up to $1,200, and then China did something and it broke back down to $300-ish, and then we had the next leg up, and then the thing catapulted up to 17,000 or so and set back. But any of these, you can imagine if you're selling, China comes in, and then I think that they said you could not own Bitcoin in China, possibly something like that. So the market breaks from $1,200 down to $300 or $400. If you would have been selling it in the hole down around $300 or $400, expecting it to go to zero. I mean, cryptocurrency, a virtual currency, internet money, who knows? Is there any value in it? So, I mean, you're selling the thing down there at $300 or $400. The next thing you know, it's back to $1,200, and then
you're like, oops,
10x of that. So, just like buying the top, at 67,000, you almost, you lost 80% of your value, 70% of your value in the next 6 to 8 months. So I think it's important to really be cognizant of where you're at in the bigger picture, as far as trading goes, and that's a function of understanding what is the time frame.
And so, but Pete used to say that the right location of your trade, the right entry spot, is a lot like the best location in real estate.
Yeah. So as far as what Chris is saying, and I think as far as your trade location, I think that's important in trading. I think in trading it's important also to have the right opinion, the right idea. We have this saying that a good idea wins out. So if I've been bullish on energies, since the Russia-Ukraine situation, those 6 months, from February to say June, July, whenever the high was, I don't remember, but you had that strong rally in the market, and being long, if you bought it at $65 or 70 or 75 or 80, I mean, it all would have worked out for you. I think it eventually went up to over 100, 110, 120, 130. So you had a huge run in that market. The idea and the location are important. And, I think, all of one's trading ideas has to be a function of the risk tolerance. So if you're willing to trade with a bigger time frame or want to trade a bigger time frame, by default, you have to accept the fact that you're going to have a larger risk tolerance in whatever trade you're putting on. It's going to be hard to try to, take advantage of a huge move in the market and risk a few ticks on it. There's so much volatility in the market, noise, so much news coming into the market that the market has to digest. There's lulls in the market. I think that we all know or realize that the majority of the activity or the volume comes in during the U.S. session. So our night sessions, you see less activity, less participation. So the probability of the market or the ability for the participants to move the market around is pretty big. There are people that kind of play games in the market. They try to move markets to levels where you might get stop selected or hit, and I think that's something to be aware of. I think we all have to be aware that the market is kind of a living, breathing organism. I think we have to understand that everyone is trying to do different things in the market, trading different time frames, have different objectives. We have speculators which is or most of us are. We have people who are essentially need to hedge with the contracts that we're trading with. And then we have the bots or the market makers, the people kind of facilitating the transaction or just trying to accumulate ticks. So the dynamic of all of those participants move the market in erratic ways to a degree. But I think the structure of the market is what's going to win as far as the direction of the move. And I think just trying to understand that is important in trading. So continuing down the path of trying to understand what we're doing with the trade, I think it's important for us to touch on the whole idea of trading and building out a portfolio. So I put together a slide here, and I think we lost Chris and he's back now. And I'm just touching on the trading process. What's important from my standpoint, or what I feel is important, is us trading off the floor. It was different than when Chris was on the floor. When you're in one pit, you really know that market like the back of your hand, and you really focus all your energies and effort on that and trying to exploit it and take advantage of it, every which way you can. But when we're trading off the floor, there's lots of different markets that we have access to. We have a level playing field now. That's what Pete always likes to say. Back in, having access to the floor was an advantage, and now there's no floor, but anyone and everyone can get an electronic front end where everyone has decent connectivity. So it's a much more level playing field than what there has ever been. So that being the case, appreciate that you have the opportunity to look at lots of different markets and try to take advantage of them.
Right. You have the ability to play in any sandbox.
Yep. Yeah, exactly. And what I do, I'll talk about what I do, and Chris can elaborate on that or, input some of his ideas. But,
so, I think, hey, time out. When you come in the morning, you turn on your screen. What's the first thing you do?
Well, the first thing I do is I've got a portfolio that I track. So I've got an automated process to scan the markets I'm looking at. So I'm looking for certain things, and so I have programs that do that for me. So it runs through, we'll say 150 markets, 50, 60 futures and 100 stocks. And of those, 150 instruments, it might generate 10, 20 different opportunity, criterion under which, the scan is being hit. So
what would be one criteria that people could start with?
One of the criteria that I look for would be volume. So I'm always looking for volume. I think we talked about that in the past, the ability for someone to create a volume or trading strategy off of volume, just as one can trade off a price. So I would say trading, looking for volume, heavy volume is a good thing to try to look for. And when you are on the floor, heavy volume, you'd want to see volume confirm price, right? New high, new low, confirmed by volume. That would be confirmation of direction.
Right. Isn't that's people coming to the party?
Yeah. And I think though it's a new world now. So now heavy volume is, I guess everyone's aware of the party and they all jump in, and it's maybe if you think about it, maybe it's because everyone has access to lots of information. So we're all getting inundated with, maybe there's a piece of news out on something. And so a lot of people are reacting to news and the ECB hiking rates, this past week is a perfect example. And the, euro currency, interest rate differentials, if they're going to start raising rates, then their currency should be more attractive. And people speculating that was going to happen. I don't know. But then the news comes out, it does. It has one spike up on heavy volume and then falls away. So, I think just trying to track heavy volume, if you can track heavy volume and look for heavy volume at a market extreme, and think there's potential for the market to fail from that would be a good strategy to try to trade it with a profile, I would say.
Yeah, that's very smart. It's an interesting kind of concept to think about, right? It's, in other words, we all get the information at the same time.
Right. Yeah, remember back in the day,
right. So if everybody, so it's essentially where it's like in all the king's horses, all the king's men happen much more often because the information is disseminated.
Right. Way back when, right? I mean, supposedly you had services where maybe, and I don't know if this is true or not, but I think I remember hearing about maybe you could pay for a service and get the information, half a minute early or something, or, and
like they did at CPI this week. They've run right.
Right. That was the day before or something, right?
But, right. Yes. Everybody watching, I'd like to apologize that it is not a level playing field. Okay. It's not our fault, and I'm sorry to have to break it to you, but it is not a level playing field. Just so you're aware, right? That if you know, someone else knows probably before you know.
Yeah. But it is much more level than what it has ever been, right? I mean,
of course.
We can say that without question, I would say.
Of course, right? Because everything is tracked now. Every time you do anything, there's an electronic record, which works great for us to learn how to trade. You actually have a better ability to learn and quantify what's happening.
Right. Yeah, there's a lot more data points to work with. Just like back in the day, if you weren't on the floor, you had to call in, right, to put an order in, and you had a good broker or a bad broker, and their ability to get a fill. I mean, there were so many different things that they were disadvantageous to the small guy, which aren't there anymore.
Okay, so just the one thing that Steve was suggesting that people look for on the first thing they do is look for areas where there had been a high volume event, and then you can diagnose, in other words, what happens from there, given the degree of participation is important.
Right. Then if you look at the screen, we're review the hits, that's what we're talking about now. And then for every hit that you see as an opportunity, right, you need to generate an entry and then a stop and an exit. And, for me, I mean, from our school of trading, we're going to be wrong more than we're right. We're not algos or bots that are just, trying to accumulate ticks. We're generating some type of a trading decision idea, based on the structure that we're looking at in volume. Those are two pretty simple approaches. And, for me, if I'm going to be wrong more than I'm right, I need to have some type of risk profile. For me, I'm looking for something that's going to probably be, the reward is going to be 3 to 4x of what the risk would be. So, for me, it's a simple, backing in type of a calculation. You don't want to put a financial stop in, right? I don't want to risk $100 or $200 or $300 on the trade. I want to know where I should put the trade on and where I'm wrong, and does that fit within the context of my risk profile?
So that leads to the next question of how do we define wrong? And this is an important question for people who are watching and learning how to trade.
Someone is wrong when what your idea is. If we're going to generate a trade off of volume, we're going to generate a trade based on structure. So we've talked about the idea of minus development, or talking about the first, second, and third standard deviation and the tail. So if we're going to see a situation in which a tail should hold, or some type of a 3-2-1 up structure, we'll say we're going to say that this market is a 3-2-1 up structure, and the minus development is a zone in which the market should try to hold. So I'm going to look for myself to enter a trade into the minus development zone, and I would be wrong if that minus development zone is negated. So once again, the minus development zone would be some type of single prints or a lack of lots of prints. It's all relative, but with the market, why does it have single prints or not lots of prints? Is because there was a kind of an overwhelming buying or selling. So if we look at this from a buy perspective, the situation in which, the market has some type of a minus development zone, and we'll just use crude, which has a nice round numbers we can work with. So we'll say crude is trading, $100, and there's a minus development zone between $99.80 and $100. I'm going to buy the market, aggressively into we'll say the top of the minus development zone at $100. And if it goes back and trades and takes out all that minus development zone, which is $99.80, so that's 20 ticks, then I'm wrong. So my question to myself would be, am I willing to risk those 20 ticks on the trade? And if I am, then I would put the trade on, at the $100 price, and then put the stop at $99.80. So we're just I'm just walking through the thought process of, putting on a trade based on structure, some type of a 3-2-1 up. So the minus development would be the tail. So we got the tail, we'll say between 99, 80 and 100. So if I'm going to be aggressive and buy the market at 100, I'm wrong. My stop would be if the market trades below the minus development zone 99.80.
Yeah, if you're expecting a vertical move, it's actually the safest place to get involved. It's so weird though to buy strength.
Yeah,
because
right.
everybody is always so price sensitive, and that's an interesting concept. And we need to be more structure sensitive rather than price sensitive.
Yeah, I mean, I think usually you're well, they have bots, right, and the algos. I mean, they're trying to go with momentum, and I think the trend followers. We talked about the Richard Dennis's turtles of the world. When the markets are trending, they're not allowing to get inventory, and so that's going to allow for the verticality to even go greater than what one might expect. If you're getting an opportunity to get in, then that's not going to be a situation in which anyone's left behind, right? So everyone's going to be in, and that doesn't mean the market can't move, but if everyone's in, there's no one left to pay up for the market. It's going to have its natural flow, whatever that might be, and then it's going to falter, and then are you quick enough to get out, or are you going to have the market reverse on you?
And so, right, the idea of getting in is where it's very nebulous. You're acting usually with not a lot of time, not a lot of information. Especially if you're early, you feel very lonely.
Right.
Getting in, and then the next task is assuming that you're right. How do you know when enough is enough?
Yeah, that's a good question. I think I saw something on Twitter, what something to the effect of the billionaire traders aren't necessarily the best traders, but
right.
They're the best. Said they're the best waiters, So
right. And Jesse Livermore was, there's all these famous books where they're like, I made my money by waiting, by sitting.
Yeah. Right. So
good luck. They didn't, in our markets, things move quick.
Yeah. So we have a saying, stay as long as you can without overstaying, and to find that one or try to, express that to someone or write up an algo on that. So I think, as you said, dealing in a market of uncertainty, and every day is different than the other, but they're similar. Sometimes you get a shorter development time, sometimes longer development time. But in general, if we talk about what we talked about in previous sessions, the market structure or the 4 steps of market activity, the stopping and developing is essentially where the market is. Doesn't mean it's not going to continue, but it's resting, and buyers and sellers are matching up. Why is it developing? Because we'll say in an uptrend, there's active sellers as well as buyers, and the market starts trading sideways. So once that velocity, or I always look at things from a math standpoint, what is the slope of something? So once the slope, where you start building prices horizontally, that's the slope is going to become less, right? So that's going to tell me that maybe it's time to get out and reassess.
So for everybody watching, is it interesting that the answer to the question of how much is enough is that, well, the market will tell you. It's even saying that the market will start to go sideways, or the rate of slope will go flatter.
So you're increasing it, diminishing returns, increasing and decreasing rate, or lots of different ways of describing it.
Right, the momentum is slowing down of the particular vertical move. And so what's interesting is so that stands in stark contrast to people who have a predetermined price in mind for the exit.
Right.
I hope you guys are enjoying today's episode. I did just want to take a second to interrupt because I have an opportunity for you. I'm actually going to be trading live every single morning. You'll be able to see me put this system into practice as I enter and exit trades, and you'll be able to essentially follow along and copy those trades yourself. Now, if you guys are interested, I will put a link in the description below, and I hope to see you over there.
I mean, for me, I always have an exit idea. Price, and it's going to, once again, it's going to be a function of what is the structure, but I have to be flexible in modifying that. If there could be situations where it blows right through it, and hopefully I'm monitoring it and I'm not taken out too quickly. But then there's going to be lots of times where you try to squeeze it too much, and we've all been there looking for that perfect exit price. Next thing you know, it evaporates, and you give all those profits back.
So for everybody watching, it's not exactly frustrating, but it's messy.
Yeah.
Right. So we can't be this is not a game for perfectionists.
Right. No, absolutely not. That's trading is one of the last places I would say where perfection is going to be an attribute that brings success in one's trading. You got to have you have to be loose is a good term to use. You're loose in what you're doing. I mean, it's with time, like Chris and myself, it's becomes intuitive, I think, and it's some people say you're born with that intuition, and maybe some people are, but you can also kind of build it, I think. We've been sitting around watching a screen and it's understanding the relationships of how markets impact other markets. And so, I think that your screen time is going to really enhance your abilities to manage a position much more so than just reading a book.
If you're going to watch, you can't help but learn.
Right.
Right. And so if you're going to watch, you might as well have an understanding of the structure.
Right.
And then the process that we're talking about. So we've discussed entries, and we've discussed now trying to, how much is enough.
Right.
Right. And then I don't have a hard answer for how you're wrong or when you're wrong, other than you're just wrong and you need to go.
Yeah. Yeah. And I think, I threw a screen up here. This is Exit Principles. I think Chris recognizes this fella from Twitter, as do I. He's a sharp guy, I think.
Oh, yeah.
And so yesterday I saw this and I thought this all looked good. And, instead of recreating all this myself, and we won't go over it now, but, at your leisure, read through it. There's some good morsels of information here that, the exit principles, and he talks about the importance of exit, and we're in agreement here. I think we talked about the how people trade in general. Most people spend most of the time looking for a trade and less time managing, and these, we don't agree with that. We think you should flip those around, 75-25 more management. And then he also talks about position sizing, which we have. And reading this first one is the only one I want to touch on. Is the three most important, from the least important to most would be, the least important would be the trade idea. Then, something more important would be the management or the exit. And then even more important would be the position sizing. So, and that's kind of in line with Stoudemire always says, you pay the grocery bills with the short-term trading and put the money in the bank with the long-term trading. So, when your long-term trading is a function of position sizing, as well as what does the market bear, what is the future for that opportunity, is something that extends well beyond today, or is it a day, week, month, long-term trade that really is something that you can put in your back pocket. And I think, what the successful traders I know, and I don't know if Chris is in the same camp, but, Pete can tell me, or he's told me that, he's made lots of money trading, and then we'll say, that he's made the majority of his trades or the majority of the money on 10% of his trades. There was a guy in our office, and he was a big 10-year note trader. And, he would make tens of millions of dollars a year trading in the pit. And he said he made 90% of his money on non-farm payroll, just one day out of the month. So, that's when the big moves were, right? Mm-hmm. And if you step up and trade those things, then you're in a good position.
So for everybody watching, exits are, you can never sell the high or buy the low. And Pete used to say, someone would ask why, what are the metrics for getting out? And he would say, well, the metrics for getting out are you find a better opportunity. And then he always used to say that you exit the trade. He always exited the trade in one fell swoop, not piecemeal.
Oh yeah, that's right. Yeah, he would never scale out. He figured he was getting out. It was because something changed, and if nothing changed, then stay with the idea.
So there you have it. But there are people who do it the other way. But Pete was pretty good.
Revisiting what you just said about exiting all or part, we're proponents of exiting all, because we feel something's changed in the market, something from a structural standpoint that maybe it's fulfilled an expectation. What we feel is the best approach. There's people who have all different types of exit strategies, and you can read up on those. But from our camp, we feel your exit when you feel something has changed or the market has gotten to a level where you think it should pause, and then you go and look for other opportunities in other markets.
There are people who say that if you get 90% of the move in 10% of the time, you take the position off.
Right. Okay. I mean, I remember reading a quote from Tudor, that he does never expect or hope to pick the bottom or top, but just expect, hope to a good trader be catching 2/3 of a move or something like that.
Yeah, right.
If you can do that,
that's yeah, you're a champion if you can do that.
Right.
No question.
So I think, what we talked about as far as trading, you want to use the profile to trade with. And, I think that we talked about a couple of strategies. One would be volume. So I'm just going to throw up a couple of screens, you're going to see pictures of profiles. And so just notice all I'm trying to convey to you is where is a red profile, and the red profile that has the heaviest volume. So, looking at this red profile right here, this one somewhere here has the heaviest volume. So we're looking at that volume at time. So understanding that somewhere in this red profile, there's a big impetus of some type of activity, we can kind of drill down and we can kind of see this red letter here. It actually happens to be buying in this. So we can see that you're seeing heavy volume buying in there. And if we also, in our discussions, talked about minus development or space, and we can kind of see, we're getting lots of letters in here. That's price acceptance or balance. You see, the skinny profile, that's an imbalance in the market. That's some type of unopposed activity, and generally, so that's selling. So if we're trading with our idea of a tail, the third standard deviation where there's less letters, and the second and first where there's lots of letters, as this market trades, you can see it building a base, the 4 steps, the series of prices, the stopping, developing, and then you're trying to retrace. So we know somewhere in here, this red profile, through these area of less prints, we want to be trying to sell. So if I can find myself a situation where I've got a direction in place, so we'll say that the bigger term, intermediate term direction is down, and then we can see this market pushing up here with this red profile, that somewhere in that red profile we have the heaviest volume. So with the idea, of all the king's horses, all the king's men, buying into this area of, what in the bigger time frame is resistance, whether it's algos or whatever is getting involved, momentum type participants, they're buying into an area where there should be longer term participants selling the market. So for me, seeing minus development, the combination of minus development and heavy volume, and especially when the volume is on the wrong side. So you see this is buying into an area of resistance. Now these people are stuck. From my standpoint, and I'm expecting the market to pause here and develop, some type of a 3-2-1 down, or we could kind of, this could be the first standard deviation. It could even trade lower. So that's kind of one of my layup strategies. Anytime I see that, I would be willing to do it, and I can with confidence say that it's going to make money over the bigger sample size. In a big way, because you got some type of a situation where you have some type of a structure, in your favor, some type of volume that's in your favor. So you have those two pieces of dissimilar information giving you some type of a consistent output. I think that's an ideal trade setup.
Do you want, for everybody who's watching, these long, skinny profiles are...
Yeah, the long, skinny profiles, that's a situation in which you're getting unopposed activity. So is it a function of some type of a news report? Is it a function of, just in this case, you can see that the letters are kind of, building lower and lower over time. So it's some type of a sentiment-based thing, whatever the reason was. But the market started trading up here, and you had hours and hours and hours or half hours of the market building lower prices. So it isn't so much you had the market falling out of bed, like we're just talking about the skinny profile, and I'm just kind of elaborating on the fact that it wasn't a CPI type profile where you had just kind of a shift in price. This was one where you had maybe more like a sentiment, erosion. So the market built lower half hours, and this 6, 7, 8 lower half hours of lower prices, and that's a situation in which it should have some type of staying power as far as that direction holding.
Yeah, and so many people were wrong.
Yeah. So every time you get these prints doubling up and tripling up, that's the market stalling or stopping. So the sellers reached a price that buyers are willing to step in, and it held here for an hour and a half, and then you had the next leg, and then you're obviously getting more symmetrical Gaussian symmetrical distributions, more balanced. But the ones that you really need to focus on are the skinny ones, because those are the ones that are setting the tone for the foreseeable future.
Right, and you see for how far, look how much in time went by without anybody even attempting to go back to those levels.
Yeah. So I mean, you can see here, this is 12.5, and this is the 16. So that's what's that? That's 11 days, of trade where the market, and we rallied back, less than half of the selling unit right here, right, and then you came back, and so this move, as far from a tick standpoint, that's 73.94, and down here is so that's that's the market, that's 100 ticks, this move from here back down to the bottom of the range down here.
It's what did Pete say? Pete used to say the biggest, fastest move usually has something going for it.
Yeah, there's some type of situation, or the largest, as far as vertical price movement, and the fastest, so obviously this is a large range. Look at these bars; it's the largest range, and then the fastest, the amount of time that you're building, horizontally is less, and just the total amount of time in these organic profiles is less. So that's the one that's going to really stand out, and that's one that's going to have directional integrity. And for us, if this is quite normal, when you see a skinny profile like this, you're going to have a situation where it's not going to be able to recover that price for at least 3 or 4 profiles. So that's another setup you can trade when you get this vertical, large, and speed fast type of a move. You can always lean against the other extreme of that profile, looking for it to hold.
Or if you're caught wrong in that position, you can't hold on, you have to exit.
Yeah, that's it's trading. I think the preservation of capital, right? That's the most important thing. So you can always trade to fight another day, but you never want to put your account at risk. And that's what can happen in situations like this. I mean, it could have continued lower. We've all seen markets where you get some type of people see key reversals, and a lot of technicals are kind of self-fulfilling. People start seeing that and talking about that, and next thing you know, it accelerates, right?
Right, isn't that's an interesting point? If I see it, other people see it, and therefore it
becomes self-fulfilling. Then you're talking to your friends, and everyone's talking to their friends, and
right. And who's first? Right, I'm going to beat you.
Right. No, exactly. So I mean, this is just a setup, and I can show you it in different markets. Here's here's the DAX. The same thing. We got the red profile there, and you look at a bar chart.
Yeah, that thing fell out of bed.
Yeah. So what do you see in the bar chart? You see this spike here, on through the highs on heavy volume, and the heavy volume. People were speculating that this range would be negated and taken out, and we'd start another leg higher, and instead just the opposite happens. So all the people who bought the market on this day, this is the highest. Last time we were trading this price was way over here in June. So you're buying the market new highs 6 months later, and then with the expectation it's going to trade higher. Can it trade higher or not trade higher is the question. So I think always looking for some type of an exhaustion when you do see heavy volume at a market extreme is a good market profile trade setup. So here's the same thing. This is the Australian dollar. You're seeing the same type of thing here. Made a new high here on the heavy volume, and the market falls away from there. And so what do? You look to see if the market does start to fail, and if the market does start to fail, then maybe there's opportunity to play it from the short side.
I am back.
Okay, so just another example. Very similar with heavy volume. In this case, buying at a market extreme into an area of minus development, right? I mean, you're looking at this situation here. You get these bars and then nothing opposite. So this is a step one. A series of prices in one direction, then you're trading back to it, and looking for it to hold some of that would be the right approach.
Do you ever think that the charts replicate? In my case, I sometimes think of it as like skiing, like you're going down a mountain and you can feel the when you're skiing, you can feel the rolls in the trail, so to speak.
Right.
And I maybe people who ride bikes or surf or something like that, as though there's a rhythm
Yeah.
sometimes.
Oh yeah. No, I think, you're from looking at things, it seems like some type of a decent vertical move, and that's going to be that's another quote, risk happens slowly, then all at once, so it's
Oh yeah.
so
Right.
you get, a situation where it starts and, COVID thing, we just look at a chart in COVID, with the, 2020, where the market, started coming off and rallied back a little bit, and then you just get, all these vertical bars just kind of cascading lower. And I think, that's kind of pretty much a characteristic of markets in general. And then just once they do, I would think the week would be an interesting one. It's been basing for a long time, but, you had with the Ukrainian thing and them being big producers and losing that. So, here's the, I'm sure that this would be the rally of the market. I think the war started in February-ish, and so here we are, middle of February, and then here we are less than a number of weeks later, and obviously, maybe it backed off a bit, but just visually, this would be a 3-2-1 up right here, right?
Yeah, oh yeah.
And then, the market, holds, and, if you're being early, being aggressive, and then the market does manage to make a new high, right? Just marginally above these highs, but then we have the market coming back down, and, the starting point has been tested, and now this whole big structure is some form of a 3-1-3, but, just.
That is interesting how they left tails at the highs.
Yeah, no, that's when inflation, this is probably, this is the middle of May, and I think a lot of things topped out towards May or June. People's talk about inflation going to whatever it would go, and, I think it carried over in all markets, and, I think this is one that it did, but making a new high, right, and then, pushing the highs and coming down, but just the the pauses and you've got momentum, right? And this thing did not retrace at all. You get, this is kind of more of a normal type of a retracement, like halfway back, and this one is normal also, but then you just get this huge break, right? There's literally no retracement, from, whatever this price would be, $11 all the way down to $8.
When you get caught in a vertical move, it's really kind of distressing.
Nothing worse than being on the wrong side of the vertical move, right?
No, that's the worst. So anybody watching, try not to get caught, or if you're caught in a vertical move, don't hold on, and definitely do not average.
Right. That's, averaging any trade in general. For me, if I'm trying to trade the structure, so I think, looking at the example of the ES would be a good example. I think if we kind of look at that market, more long term.
Look at that spike.
Yeah, so you had this spike on what was that? Was that peak?
This Tuesday CPI.
Or CPI.
For people who are watching, it was expected to be 7.2. It was 7.1. It wasn't 2%. It was 7.1.
Right. So people are speculating that they weren't going to be tightening so aggressively or whatever.
Right. We had won the inflation battle on Tuesday.
Right. With 1/10 of a percent. Right.
Right. And then on Friday they're down 8% from there.
Right.
In a straight line.
Yeah. So and this was probably some number also, right? Which it's a date here.
Mm-hmm. In the case, if you have high volume that is immediately rejected, that's a blueprint to go the other way, right?
Exactly right. Mm-hmm. Yeah, and for me, I like it when the buying would be on the top, which it was in this case, and the selling would be on the bottom. So
right, it's just as though that's in a sense all the king's horses and all the king's men made an effort to go this way, and that's it. They don't have any more troops.
Right. Yeah. So you can see that we got the red profile, which is showing us the heaviest volume. So if you're looking at a bar chart or anything like that, or if you overlay a volume histogram at the bottom with the profile, and you're going to notice that this is the heaviest volume. You can kind of see that we can drill down and see where is the heavy volume period, and we can see that it is the Z is in zebra. We can see the Z period takes out the Y period high, so you know that's buying. The Z period takes out the Y period high, so you know it's buying. I think that's the 7:30 number coming out, and so you have all the buyers coming in, right? And by the time the next half hour later, so 7:30 to 8, the market pushes up the Chicago time, and then 8 o'clock the market's some 30 handles off the highs, and never looks back. You have the market coming off in the B period, and then trying to get moving around in the C period, and here we are. So it's 4180, and what are we at today?
38.
3880. So
yeah,
300 handles lower, right?
Yeah, in 3 days, and so that's 8% drop.
Okay.
My math, maybe it's 7.5%, 8%, which is a lot. The average yearly range for the stock market's or gain had been 9% for a couple hundred years. So
okay.
The market's a little bit more urgent these days because I guess, but like we're saying, right, we all have the information.
Right. Yeah, I think we all have the information in a relatively timely fashion. Anyone and their brother can get access to it. It's everywhere, right? Everyone has access to a computer and the internet. And there's all kinds of services out there that push it out to you for no charge. So we all know what the expectations are. You have a bunch of economists, banks that have good generate these numbers, and then people aggregate them. So we all know what the expectations are, some average of what the forecast is. You might find your favorite economist and then see what his are, but how does the number come out versus expectations? And as you said, they were looking 7.2. It came out at 7.1. The market spiked up, and I was broken 300 plus points. So I think that's a good point. Is that when you're trading, I think understanding what is the market structure, and then for me, I always want to know what is the expectations. Then I can see the headline number, and why did this market fall away like this? And I would speculate that there were longs in the market, and you could say that based upon the price action, that would make sense, right?
Sure. You see that for that bottom that occurred leading up to that spike.
Yeah. So you people speculating on or wanting to be long, and maybe for whatever reason, they formulated the idea that the number would come in less than it did, and lo and behold, it does come in less than it did. So you had one more wave of participation, right? Buyers coming in, and so you had all this accumulated buying here, and then these new buyers at the top, and they all got to give up. The first ones to give up are the ones here, right? And then as the market starts to set back, these people who are still in the money, they kind of reassess things, and now anyone who bought the market, during the first part of the week, they're all even to underwater now, right? So
they're buried.
Yeah.
You see that there was no bounce.
Yeah, right. So you'd think that maybe had one little bounce right in here, like you would expect, right? This thing breaking down and trying to come back up, but then here we have another aggressive, right, hard sell-off. The single prints minus development. So even though the market's cheap, the right trade is to sell into the minus development, sell into this area, and whether you got the price or not, I don't know. But based upon what the market is telling us, I think it's important to see that referring back to a longer term chart, this single bar here is a minus development zone, and buying into that, the two of that is okay, but if which is where you're at right now, but if the market that doesn't hold, then we come all the way back down to the bottom of that bar. So, the bottom of that bar is down here at 37.70, and here we are at so we're 100 points higher right now, right?
Yeah, 10 days before Christmas.
Yeah, right. So, I think understanding what is the structure, the minus development areas, and understanding what is the volume. Integrate those two pieces of information. I think that's the most powerful tool that a movie could have with the software. Really trying to be able to get a starting point for trading. Any chart that you can pull up, we can talk about the areas. This is a wheat chart, so we can all see the single prints, right? Minus development. So you want to be trying to sell into it. I mean, this is all minus development. You want to be trying to sell into it. When filled you and it didn't take you out the first time. And then once again, always seeing the starting point of the minus development point is where I'm confirmed I'm wrong. So for me, I'm selling it somewhere in the minus development zone with a stop up at the top of the minus development zone. So I'm selling it. I would be getting short here. The idea is going to develop down to this level, and maybe it doesn't achieve my balance, my 3-1-3 structure, and maybe I get stopped out. But yeah, what's the right trade to do? So yeah, this one really, they had a big windfall. This one did, yeah.
Right. When we're leading off, in other words, we're trading and we're initiating a trade in the middle of minus development, we should probably be cognizant of the number of people that are caught.
Yeah, I mean, correct. Yeah, on the whether it be wrong or it be right. So for me, I'm looking to see, in this example here, this is an interesting one because you did have people aggressive selling and then another leg lower, and so that's created by selling. And logic would tell you that if the market kind of traded back into this balance here, you're going to have to spike up higher. But the magnitude of the spike, not taking this all out, would lead me to have some degree of comfort of putting a trade back on and thinking it's going to at least trade down to here. So it traded 53. That's 53, and then down here is 32. So it traded 20 cents. So that's $1,000 a contract if you would have gotten in there and gotten out of it here. But then it did go out and take the minus development zone out. So we're kind of viewing this whole here as some degree of balance.
Right. Because okay, so in other words, if it is minus development, could almost be considered like a gap sometimes.
Yeah, it's some momentum, right? And it's something that should have put you with a bias, right? We talked about finding the pictures back up against the wall and trade. So it tells me what my bias should be for that market. And that's why I'm a proponent of, like we talked about, trading a portfolio. So now this trade doesn't really have anything that really stands out and is clear for me, but I can throw up other markets that are clear that I want to be trying to trade. So something that a lot of people don't look at, this would be lead, so.
Yeah, I have never heard of anybody trading lead.
Right. So, looking at this one, we had the red profile at the, at the top, like we did a lot of these markets. But then looking at this type of a move up, we're trading into some degree of minus development in the market. So I think, is this one that's going to hold this 3-2-1 up and balance and then push back higher? It's going to roll back over. So I'm certainly not going to be a seller down into this zone with the idea it's going to trade lower. I could be a buyer. However, if I do see something that tells me we're going to be in a position of getting like exhausted selling down here in the hole.
Hey, with most stocks at the lows, right? I guess one of the setups that we could use would be, is the downside volume exhausted? And then you were saying that if the downside volume is exhausted and we're running into some minus development as well.
Yeah, that would always be a lead that I would be trying to trade from any type of a trading standpoint.
So for everybody watching, the other understanding is that the market has dropped enough to shut off selling, or the sellers are gone, and that there is some degree of minus development or a tail in that area.
Yeah, then you do something. I mean, if all the sellers are gone, there can only be two outcomes, right? The market can trade sideways or it can reverse. You're trading, whether if you're an option guy, right? You could sell puts, you could buy. I mean, better than I as far as the pricing of what's an option going to be once if it kind of runs out of selling. That means by default, I would guess it's kind of trading sideways. So maybe that's an environment where you'd be buying premium, right?
Well, the problem is sometimes at the bottom of a move, because the puts generally price all the options. In other words, the VIX is.
Okay, so Chris was touching on options trading, and I refer to him for that. He's the expert on the options much more so than I. So I think once he comes back, we can have him finish his discussion on when you're looking for the market to stall out. You see something of a profile picture that the volume is exhaustive. You see some type of a tail, as he alluded to, which would be a tail, it could be single prints or minus development, or some type of a spike one way and the other, whatever it might be, just something that's telling you that the market has traded to a price and it's rejected that price. You can integrate that with options. What is the best way to formulate an option strategy? I'm not a big believer of selling premium. You hear all kinds of stories about people blowing up. Even though the majority of options expire worthless, I think it's hard to get out of a trade once it's going against you to sell premium. Didn't want to get in your way as far as explaining your options. I'm just
Oh,
saying.
yeah, I was saying, right, if you're buying calls at the lows, just be aware of the vol is high and that
Okay.
and then the calls come in even though the underlying is moving towards your direction. So, I mean, if the idea of selling puts, doing the fence, selling puts, buying calls is a smart way to do it if you can
Okay.
assume that risk.
Yeah. I was just kind of noted that selling options is good for a professional if you know what they're doing, but the novice, you've heard all kinds of people lowering their accounts up by selling premium, and that's not a good.
No, it's not a great way to start. Just buy the physical, buy the actual stock.
Right. Okay. So I think we've gone over some examples. I think just to reiterate, just understanding the structure and understanding volume, and really trying to understand that volume can be exhaustive, and trying to see the footprint of when the market is telling you that you have some type of exhaustive setup, with some combination of minus development. There's I can guarantee you that on 100 trades you'll make money on that. I think it's important to have some good risk tolerance. I don't know, Chris, do you have any good ratios that you look at as far as how much you want to risk per trade? I mean, some people have 1%, 2% of their account. I'm not that much. What you comment on that?
Yeah, I mean, the idea is to stay in business. Everyone always tells you keep your seat at the table.
Right.
And there's a certain element of understanding your own tolerances. You first want to be able to think clearly.
Right.
So if your position's too big, you tend to not think clearly.
Mm-hmm.
So I would prioritize your positions along the lines of if you're holding your breath, you're too big.
Yeah, right.
And so also the underlying volatility of the market sometimes has a bearing on the size of the position that you feel comfortable with.
Right, and that's the one thing that I've always found in trading is that quite often when there's a lack of volatility, and then you feel you can size up, and that's a precursor to more volatility coming in, right? So
I just want to take a second to interrupt this episode. I hope you guys are learning stuff so far, but I do want to give you an opportunity. Now, I'm going to be trading every single morning. I'm going to be live. You're going to be able to sit and watch me enter and exit positions, executing the system that you're learning now. If that is of interest, I'll put a link in the description below.
When volatility is probably going to come in, and you could be wrong. That's probably your biggest position on if you're just trying to trade the lack of volatility, right? Because you want to make your lunch money, right? So
yeah, the Murphy's Law of volatility.
Right.
It always shows up when you least expect it.
Right. Exactly.
God, not laughing, but laughing.
Yeah. No. It's all life experiences that everyone's going to have, and I think if you learn from them, then it's an experience that you'll benefit from, really, right? I mean, you can shadow someone or have someone mentor you, but until you experience it, it isn't as meaningful to you, is my belief. Just like, I mean, I build some automation and models and things like that, and I can appreciate the bit of value in back testing and simulated trading and paper trading, but they really don't compare it to real trading. So the sooner you can get into, and trading is the better off you are. And nowadays, right, with all those little mini contracts and stuff like that, you can have your toe in the water and experience trading, and you're not going to lose much, nor are you going to make much, but you're going to at least go through the process.
Stephen, you come from a kind of the education background that was part of the culture where you worked and grew up there. The Chicago Board of Trade was very much tough love.
Right. Oh, yeah.
Where you had to get in there, you actually had to trade, and you actually had to be accountable, and you actually had to face your own demons, losses, gains, etc.
Yeah. No, I think that's the only way to success, really. I mean, you can't be coddled or babied, right? I mean, I remember a story Pete told me about, some new guy that bought a membership or leased a membership, had some financial wherewithal, so he wasn't broke or whatever, but he would just always sit off the edge of the pit, and he'd bid way away from the market, or he would just sit there and watch, and Pete, hit him with 100 corn or whatever it was, and walk
It
away.
was Bonds. It was Bonds.
Yeah.
And I remember the story. Pete said that the guy did a point and figure chart for months in the bottom of the bond pit and never traded.
Never traded, right?
Pete walked in and said, "How's the market?" He says, "It's 15-16 or 14-15 something." He said, "Sold you 100 and walked out."
I'm sure he learned more than that 5 minutes than he did the previous 30 days, right?
Yeah. So for everybody out there, you must act, and it's a tough love environment. So big boy shoes, Pete.
Yeah.
Bull. You need the passion to learn because the people you're competing against are the smartest in the world.
Yeah, absolutely. So I think you just understand the dynamics of all the different types of timeframes people trade. You have the algos or the market makers, you have the swing trading guys, you have the speculators, you have the hedgers, and just it's a big dynamic relationship. That everyone is approaching it with a different goal or intent, and that creates opportunity, right? So me being a longer term trader is going to fade some type of an order flow momentum based into an area where there would be resistance, and it's not a zero sum game. Some of the momentum based guys are going to make money, and then I'm going to lose some of the trades. But I think that just really trying to understand that you really need to kind of step back and take a view of the market that has a little bit more of a longer term time frame is important. I've worked with people who I look at their chart. We share a screen, and they show me, and they have a tick scale of one on it, and I'm just scrolling. They scroll up and down the screen, and then look at the profile and try to discern anything from that. And that really doesn't serve anything at all, other than you can see the amount of time that the market has traded a price, but you really need to understand what the market did to get there, and then what's prior to that activity, and just really understand the whole puzzle of what you're looking at within the market. I think that we're in agreement, that you really need to, shrink the font down, as I said, and try to understand, what you're looking at in the context of a bigger picture.
There I am.
Okay. Yeah, I'm just kind of pointing out, that.
I heard you. I heard you talking. You have to. It's like we're solving a puzzle every day. You come to work, and you have to want to solve the puzzle. If you have an opinion, that's not solving the puzzle.
Right, or you're solving the puzzle with information, and I was just trying to touch on the fact, that looking at this screen, I can kind of see all the overlapping of letters, and then it's a small amount of time, and so I don't see the full picture. But as I get more and more data on the screen, it really helps provide clarity to me as far as what the market has done recently. And we're not trying to predict anything; we're just trying to read the flows, right? What is the flow?
Yeah, that's genius, right? Like you're telling people to like integrate the background with the foreground.
Right. Yeah, I think that's the most important thing in trading off the floor. Obviously, when you're trading on the floor, you're just watching order flow, right? You don't, some people didn't even care about what the previous day looked like. Some people did, but then, if the premise is that you're going to have lots of overlapping days, it doesn't really matter, right? If you're going to have overlapping days, and every day is a new, and then trade that day. But if you're going to go beyond the day, then I think it's important to look at what is the background, and just kind of really formulate your perspective on that with the volume.
So then it's kind of an interesting question for everybody watching too, is like what time frame do you feel comfortable with?
Yeah, I think that comes from what is one's risk tolerance and capital base too, right? I mean, if I want to risk a real small amount of money, then I'm really forced to trade a much shorter time frame, right?
Yeah.
Whereas if I'm willing to take the negative price action, it's required to get involved with the trade. If I'm going to try to trade a bigger time frame, we always want to kind of sharpen the pencil as best we can. But like this is an example right here. If you look at if I'm in the perspective that I think this thing is putting in a bottom, this is a bigger bottom, and we're getting a huge rally. Maybe I'm in the camp that I'm willing to put this trade on. We got this minus development zone here, and we could kind of make a case for this kind of being some type of a 2-1 here. So I'm willing to buy the market here if the idea is going to hold here. So I'm going to risk 200 ticks on the trade. But if I'm looking to put on a trade and risk, a couple of handles on the S&P, then I'm going to have to really trade a much different time frame. I mean, I'm hopefully I can find something like we had if we have the ES, we have something that maybe conducive for the bigger time frame. This could be support, right? If we look at this chart, we could be trading into some degree of support, and we can try to buy it. So I can see the bigger picture from this, whatever it was, the CPI or PPI, and then I can kind of narrow it down to, maybe to some type of a 5-minute bar and see if there's anything that can kind of reveal itself on looking at the volume.
Time out. So less money, less capital to risk shorter time frames.
Yeah. Mm-hmm. Yeah. Just by default, you have to do.
That's an interesting distinction out there for everybody watching.
Yeah. So I think, like I said, if you can find your time frames, that by time frames, I mean, you're looking at a bigger time frame, for default to trade a bigger time frame on the S&P, we'll say buying it here. And so, but I have a big range of prices I can trade. I can narrow it down to a shorter term chart and just kind of get looking at this here, if we would see some type of volume excess down here with the red profile, then maybe I can combine that on the shorter term perspective with the longer term.
Nasty chart.
Yeah, that doesn't. Yeah.
Nasty. Not a plus tick.
Yeah, not a lot of things to be encouraged about on that. I guess we're coming into the holidays, right? That's touching on the holidays, right? I mean, everyone's year end, people have made money or lost money. If you're working at a shop, you've got a good year, you're not going to give it back. You're going to quiet down. If you had a bad year, you're going to quiet down because you don't want to make it worse. So I think historically you'll find that, coming into major holidays, and obviously this is one here, you're going to see volume drying up and less participation and with volume drying up, just touching on the holidays. So less participation, less involvement, but that could allow for greater volatility, right? Because there's less people in the market.
I mean, people will be watching this in January, and they've always said January is very volatile as new money gets put to work.
Yeah. I think there's people in the market, they've had a bad year, they're probably putting their head in the sand. If they've had a good year, the same thing, they don't want to give their money back. So, and then you got people want to spend time with their friends and family. And so, as the week progresses, this coming week, you're going to see less and less participation. And we always like to tell people, one thing is that markets change directions over long weekends, right? So holiday weekends. So, people have an opportunity to assess things, and maybe this thing has overshot itself to the downside in equities or other markets, whatever we're seeing in energies or metals or fixed income. But time for people to they kind of start over, especially at the year end, right? New year, and kind of formulate a plan, what are my forecasts, not forecasts, but ideas, for the coming year. When I hear a lot of people expectations are foreign exchange is going to be a good market, lots of opportunity there with interest rate differentials and things like that. And
right, because we have interest rates now, so there's actually going to be interest rate differentials to trade off of.
Yeah. So that makes sense, right?
Yeah, that makes great sense.
Yeah. So, just what is your focus going to be? And, just getting back to, trading one market or lots of markets. As Chris noted, if you're watching one market, then, you're going to really be focusing your energies on that. And it's going to be less of an opportunity to sit on your hands because you feel that you should be trading. Whereas if you're trading lots of different markets, maybe like myself looking at 40 or 50 different markets, maybe there'll be 5 or 6 different things to occupy my time, and I won't be forcing some marginal trades. So, but that being said, Chris can do better in the indexes than I can in a market because he knows it better. So
you get better at what you watch.
Yeah, for sure. Yeah. So if you got a good market, whatever it might be, and you're focused on just that market, you're in heaven, right?
And they all have different personalities. And so you may find that you feel more comfortable with one. In my case, I think crude traders should be, moonlighting in a dungeon. Crude is crazy, and stocks are not exactly mellow.
Right.
But again, find what suits you, or what Pete would say, if you're a fastball hitter, just hit fastballs. Don't try and learn to hit curveballs.
Right. No, for sure. Yeah. I think also what you find in markets, they rotate, right? I mean, you sat down for a half hour, we could go through the different cycles where energies were in favor, or the most, the lead. I mean, for me, you ask about, the first thing I do is, what's the lead market? What is it? Is it energies? Is it metals? Is it interest rates? Is it equities? So decide which one it is and what's that doing today. And there's going to be some type of relationship between that and other markets, right? So
for sure,
what is the focus of the market?
For sure, it's interesting how the focus changes too.
Yeah, for sure. Yeah, I think that's right. Interest rates are big, right? I mean, I mean, we talked about energies. I mean, so it's always different. It's not just equities don't drive the market, or energies don't, or metals don't, or fixed income, but just kind of rotates back and back. It rotates around for sure.
Shall we wrap it, everybody? Have you had enough out there?
Yeah. Right. Yeah, I think this is good. I think keeping it simple with the profile, especially starting anything, keeping it simple is important. You can really peel back the onion like we talked about, and really complicate things, but simplicity, there's beauty in simplicity, right? So keeping it here is a good endpoint, I think.
Great. So thank you everybody for coming. We wish you luck. You can find us on Twitter, Stephen at Profile Trading. Don't hesitate to let us know if you've done well.
Right. Good feedback.
Right. And then someday you have to pass this knowledge on to somebody else.
Right. Payback, right?
Right. Yeah. So talk to you later. Hello, everybody. Today is January 6th, the fateful January 6th. At the end of the trading day, it was a non-farm payroll day. My name is Chris Cady. I'm here with Steve Hawkins, probably the number 2 world expert on market profile, and very grateful to have him. Today, we're just going to look at volume profile, which is a simple and easy and generally free tool that's provided on most front ends, which is where you access prices and you execute your trades. The idea is that market profile and other profile programs are a subscription-based thing, and if you are just looking to get your feet wet and want to observe some of the profile, the particular behavior patterns associated with the auction process, and the volume profile allows us to take a look at that. We're looking at just short-term 5-minute charts today of the stock indexes. That would be the S&P, the NASDAQ, the Dow, and the Russell 2000. Again, as I said, in 5-minute bars, and with the collection of data is for the days or the one session only, so we can see how the prices distributed themselves, and the associated behaviors that we can discern proper entry places, or shall we say, the probabilities associated with each particular entry predicated on how it is being represented in volume profile. So I believe I'm sharing my screen. On the top left is the S&P,
right?
And you can see the number came out. You can see the number came out at 8:30, which is these are all New York Times Eastern Times on my screen. Steve, if he shares his screens, is in Chicago. So you see you have a vertical move, and then the market comes down. And there used to be a thing, Steve, about the opening period being significant, right?
Yeah, the idea of initial balance, and that's when participants would come in, or locals would come in and set up the range, and longer term participants would get involved in the market, moving away from that range. But I think obviously when you get in the economic number, especially the non-farm payroll, which is the most important number as far as the numbers that come out every month, and I think that number came out, as far as I recall, I think they were looking for something like 200,000 new jobs. It came out at 230, so that's a little bit positive. They're looking for unemployment to be at 3.7. It came at 3.5, so that's a little bit favorable too. So it's kind of the difficult position we're in right now, as far as the easing that we had the last 2 years. Now they're tightening, and are these improvements justification for the Fed to keep pumping the brakes, or are we going to have a soft landing, a hard landing? So I think regardless of how the number comes out, I think That's and people's expectations versus how it does come out, and that's the initial knee-jerk reaction to it, and then people start projecting, how that number came out and what that implies for the future, and that's the difficult thing about trading, and I think that's why we had the big move today.
So if everybody's watching at a later date, which is going to be the case, you can see that Steve has no idea of why they do things, but what we can, and he's looking for a why, and these are all kind of, you're throwing darts. Essentially, what we can look at is the volume profile. And we can see, in this case, we can see each of these horizontal lines, all on a 5-minute chart, all different stock indexes, all the same time frames, exactly the same time frames on all charts. That we have a horizontal line drawn at a place of what Steve calls minus development. So the behavior around minus development is interesting. If you execute a trade in minus development and you're right, you will see that the market goes your favor very quickly. And if you enter a trade in minus development and you're wrong, you'll see that you never get a chance to get them back. Is that right, Steve?
Just the whole idea of minus development, that's just a significant imbalance. And as Chris made reference to the pocket or the lack of volume or the skinny part of the volume histogram, what you're seeing on the right-hand side of the screen is volume histogram. That is what is the volume profile. So where you're seeing less of a horizontal bar, there's less contracts being traded. Where you're seeing a lot wider horizontal bar, there's a lot more contracts being traded. So, the ability for the market to move away from a zone or accept in a zone when the market's developing a lot of horizontal, that's price acceptance, and that's the market just kind of jobbing around, and that's more of a mean reverting opportunity, not so much a trending opportunity like we saw today. But when you have a day like today, as Chris made reference to, you're more inclined to see some volume void areas, where the horizontal line is, where there's lack of trade. You're going to see some pockets of that, and that's the minus development you want to be trying to trade with, expecting the market to kind of hold that zone and continue directionally.
So minus development works very well if you're right, and it's impossible to get them back if you're wrong at that price. Now, an interesting corollary to that is if we put lines at the high volume areas, you can see that you have many opportunities, if you're wrong, to get them back there. Now, implicit in the understanding of a high volume area is that many people agree that that's, for whatever reason, a fair price. And we're not here to judge whether it's cheap or expensive. We're just here to say that the marketplace and the participants feel for whatever reason that this is a place where most business gets transacted. And so two things that are implicit in the fact that it's an accepted price, I think Steve would call it an accepted price, is that like I said, if you're wrong, you could probably get it back there. And then that vertical moves occur from balanced prices.
And the point Chris drew his rectangle, the box, the darkened area across the wide area or one of the wide areas, and you can look at that based upon the time frame you're looking at. So these are 5-minute bars, they encompass 1 day of trade. But as I made note, I sent Chris a text today and pointing out that we've had 14 days of overlapping trade, so essentially 3 weeks of overlapping trade. So the market's just jobbing around. I don't know how many points this 3-week range has been, but it's every day over the last 14 trade
days. Right.
You've had at least some overlapping prices, and that's unusual. What can you draw from that? We kind of have a saying that balance or neutral activity begets neutral activity. So if you do start getting the market becoming overdeveloped, it's going to kind of serve as a magnet and just kind of get a bigger and bigger and bigger range. And then finally you are going to break out, and then you're going to maybe have a tendency and ability for a bigger move away from there. But I think, understanding that this whole idea of price acceptance or rejection, it can be looked at in the minimum trend, looking at a tick chart, or anything up to a daily or weekly or beyond.
Isn't that interesting that you basically are saying observe what is happening and assume it will continue in regards to if it's balanced, it has a predisposition to stay balanced.
Yeah, and just today isn't stay balanced or imbalanced, like the old expression is a trend day, right? And what's the characteristics of a trend day? They're going to have higher highs and higher lows, or lower highs and lower lows. They're going to maybe have one intraday rotation against that, and they're going to close within 10% of the extreme. So if you recognize that early on, you can really be in a favorable position, and same thing, if you recognize the market's more in a mean reverting position, then you're more in a position to buy low and sell high, or is the market more directional and you're looking to go with the direction and pay up, whether you're buying or offer it down aggressively if you're selling it. So I think understanding where you're at within the dynamic of balance or imbalance is important. And I think looking at the volume profile or just the legacy profile can really help you understand that.
Yeah, I mean, if you can look at the behavior even on the shorter term charts of these horizontal lines today, you can see that, for example, in the S&P, which is the top left here, you see how it used the balance point as a floor, testing it many times before it took off to the upside. And then you can see the next also balance point became a floor.
And also from that, you can note from where the number came up. I mean, on the S&P, you had the big vertical bar and the reliefs of the number on the 5-minute bar, and then the market had retracement of that big move up. And the one above, just look at the S&P is the cleanest example, I think. So the 830 number, the number gets released, and obviously it's a positive that reacts to it, and the market.
This number.
The market rallies, from round numbers 3,800 to 3,880, so it rallies 80 handles, it sets back 40, halfway back on the range.
Yeah.
And, kind of visually develops some type of an imbalance. You got a tail on the downside, right? We're always looking for a tail, or a tail is an area of minus development.
Right? So people be aware of the fact that a tail is minus development.
Yeah, and it's kind of setting the direction or the tone. If you see a tail somewhere, that's a tone in the market. That's a directional bias that from my trading standpoint, I'm always looking to trade against a tail, and it's good until it's violated. So
and in trading, we're always looking for certainty, which is so strange, right? The currency that's most valuable in trading decisions is certainty, and a tail is the definition of certainty.
Right. Yeah, exactly. And you can kind of see that the whole market, this whole idea of a tail, and so the market breaks halfway back, and then you get the next 10, 15 bars, you have a strong vertical move up, and then where you have your second horizontal line on the top, you kind of built against that for a while. Then you had another strong move up, and you set back a bit, but the integrity of the structure or the move, some type of a balanced imbalance, it held throughout the whole day, and that's the definition of some type of a trending type of a pattern that you can take advantage of. As I said, if you understand what's going on in the marketplace, you should be buying breaks, and what's going to negate that idea is it could retrace the entire move, or you can start looking at it from a shorter term perspective and not looking for more than one period, 1.5 hour period of counter direction, movement. And if you see that as markets essentially moving from something that is imbalanced to something that's balanced.
And so we're looking back. It's always easy to look back, right? But we'll look back on today. So you have a tail, that's certainty. It retraces 50% and then goes up. And then it tests the balance, it tests the widest accepted price and it functions as a floor. Yeah. So you can see that there's actually cogent and you could say logical decision-making processes taking place in the minds of people who are buying them. They have a reason for why they're buying them, and they also have the structure that's in place that allows them to act with confidence. And so you see they have demonstrated a tail, then they've demonstrated a 50% retracement, then they've demonstrated that it's holding the balance point, which means that everybody who's bought them lower in the tail is right.
Right, correct.
And then it marches higher till it finds, again, another place where people are willing to step in at what is perceived as fair value and look, and then they go again.
Yeah, I think what's interesting on your histogram, you can kind of see where you get the fattest one or the widest one. You can interestingly, you can kind of see that goes the heaviest volume throughout the entire session is right there at that kind of pivot point, and it's just big volume coming in, and then obviously anyone who would have sold onto that. So I always like to try to look at it. That point is where everyone's long, everyone's short, and obviously in that case, if you're long or short from that level, anyone who got short, throughout that whole period, those 5 minutes, those 10 or 15 5-minute periods, they were never really profitable on the trade. So that's
No, never.
something that, kind of, and if you think about trading, whatever your perspective is, you don't want to be coming in with lots of biases, but just the whole idea the market's up strong and you're selling it, at a decent price level relative to the day, in the bigger picture, not necessarily the case, but the immediate or the day you're selling at a nice price level, it's not coming back. So you're going to be more inclined to want to get out of your position because you're given it time to trade, and each of those are 5-minute bars. You must have 15 5-minute bars or at least, or even more.
Yeah.
So a couple hours of trade, it didn't work, and you're going to be throwing in the towel, and that's going to add to the potential upside in the move.
I just want to interrupt this episode to give you guys a special opportunity. Now, I'm actually going to be trading live every single morning. If you want to sit over my shoulder, watch me enter and exit trades, and put this system into practice, I'll put a link in the description below, and I hope to see you over there.
Is there, I'm sure everybody out there watching is looking at the wide spot, which in this case is 38.87.75, and then they're looking at the low. In this case, O2, and this is the micros. Is there any credence to taking the low, measuring to the wide spot, and then extrapolating a high from that distance, or is that is from a long ago and far away?
No, in the book I wrote, that's one thing I touched on, and that book was written in 03, I think, and as far as range projections off of looking type of structure, I look at structures relative to dailies as weeklies, or even, you can do structures based upon economic numbers. So you could, essentially run some type of a big composite unit from, non-farm payroll to non-farm payroll, or,
Oh, right. That's interesting concept, right? Yeah. Like how you segment the data is just from payroll report to payroll report. That's interesting.
Yeah. And then so similarly, just looking at any type of a profile, you're expecting, what is the profile? It's an auction, high, pushing a high to shut off buying, a low to shut off the selling, and you should create some type of a quasi symmetrical type of a profile. So looking for what you asked for is something that I always look for. So looking at this example here, it's obviously skewed a little bit more. You have more of a tail on the downside than you on the upside. So maybe you haven't actually traded high enough to shut off the buying yet. That's kind of how I would do just what we're looking at right now.
So people who are listening, bottoms have been for the last 30 years have been Phoenix bottoms, in other words, tail bottoms, and tops tend to be long, drawn out processes where it's just that the buyers run out of gas. And that, of course, is subject to change. And of course, the concept of symmetry, or the idea of symmetry here, is what we're kind of talking around, is that the distance between the low and the wide spot would be equidistant to the high as things unfold. But the world is not necessarily symmetrical. And so just be cognizant of the fact that there are things that can change values. And as the price moves higher, it could actually spend a greater amount of time higher, changing the potential range of the symmetrical move. So as comforting as the idea of symmetry is in trading, it's just be careful. Don't bet the ranch on the symmetry aspect.
I like to tell people trading is as much an art as a science. So, we can't be looking for these perfectly shaped profiles. We can write software that would do pattern recognition, and we could have all these different profile shapes fit in different buckets and then things like that. But, understanding the auction process, market can skip steps or extend steps, as you said. So I think just looking for a perfect picture, is impossible. Just what one needs to do is understand, how the auction's working, and if the market's developing under the normal context, as far as time goes, or if it's shortening it up or expanding it, and that's giving you some insights as to the trading, and I think if you can kind of gain some understanding there, you're in a good position. And I think
we have seen symmetry work. We have many times, right?
Yeah, I think I went off on a tangent, but I made reference to the book I wrote. But there's one individual, that I get emails from every other day, and essentially he's always looking at the idea of weekly auctions and fixed income and equities, and understanding what is the old term as far as the initial balance and looking for the market to expand that directionally. And then also I talked about the idea of a symmetrical neutral type of activity. So the same thing, you're looking for the market to expand up and expand down. So it's, I can't explain it, but, there is quite a tendency for markets to meet some type of objectives that are based upon a weekly structure. And, is it,
to be filed under mystery that we don't have the answer to.
Right. Just like a lot of people look for average daily ranges and all that kind of stuff. I mean, it all makes sense. What's normal. We're trading for normalcy. We can't be trading for trend days. But if we're looking for something that's normal, we're looking for things to fall in that bucket. And
that's interesting. When we're looking, and normal happens more than not normal. So symmetry, there is a predisposition towards symmetry, given the fact that normal happens more than not normal. So before we change, and we're going to look at a little bit of longer term background, the last 13 days, which is why the reason being is we've gone sideways. But before we leave, we just want to touch on the fact that if you're trading against minus development or the area of no area of development in the volume profile, you have to be right. You better be right, because it ain't going to happen. And the market will go to, and from the wide spots, which is currently up on the screen, you're going to either get a vertical move from there, that's the balance point, and or if you trade there, you have more than a reasonable chance of getting them back if you're wrong.
Right. Okay. Yes. So we got like 5 minutes to finish up here before we time out. So let's get the
here's the background. So this is the past 13 days of the S&P, and we're waiting for the volume profile to come around on the guitar. There you have it.
Okay.
And so I mentioned to Steve that I thought perhaps a tell here was that every time they tried to trade down below the value area, which is shaded yellow, in regards to volume, that they didn't spend much time there.
Yeah, and why don't you tell them what is the value area? Talk about that for 30 seconds.
That's a standard deviation, is that correct?
Yeah, yes, the first standard deviation. 68% of the data should fall within the confines of the yellow rectangle there.
Right. So it's kind of spitballing it. It's in the case of price behavior in regards to value, you want to see if it's being accepted or if people are using that as a place, in the case of if it's below value, to buy it. And that would mean that the market would leave a tail or wouldn't stay there very long. And of course, the corresponding thing above the high is that if you're getting above the value area and it's leaving a tail or not spending time there, then people are looking to sell. And the flip side of that would be if it's sustaining or drawing in players, right? You want to go to a party where more people are coming to, right? And in this case, if it's sustaining participation above the value area, then it may actually be trying to leave this corresponding, in this case, 13 days of sideways behavior that you can see is reflected in what looks to be a fairly symmetrical bell curve.
Yeah, and I think it's interesting, to understand that the value areas, that's where there's lots of volume occurring, and there are lots of people out there, or I should say, there's lots of funds and entities out there that need big liquidity pools. So, these type of liquidity pools like that. I mean, this is a big liquidity pool, obviously, but understand that these liquidity pools or these value areas, they give people opportunities to get involved in the market. But if there's not those liquidity pools, then there are people who maybe want to get involved who can't get involved, and that's when the market really has an opportunity to move vertically. So this has given us days and weeks of opportunity. So everyone, conceptually, I always look at it this way: it's given lots of people a chance to get involved, and so as this thing kind of loses its momentum higher, you're going to see lots of people along from this yellow area who are going to probably be getting out, and that's something to keep track of. The speed at which something moves away from something which is value, and the verticality that is going to really give you insights as to whether there's going to be potential for this thing to really move away. So do we have pockets or not? That's important.
So you're saying, in a sense, as the process is unfolding, that we integrate both the background and the foreground, but you need to even diagnose the behavior of the participants as it's unfolding, right?
Yeah. Yes, I would say like the last, I can't count the bars, but we'll say the last 20 bars or something, 30 bars where you moved away from the point of control. When you have all these bars, you have the leg up and the sideways, another leg up and sideways. Is this thing going to recover and trade back down to 38.90, or is it going to not trade that deep and hold higher prices, or are going to trade all the way down to 38.90, then back to the top of the value area? So I think, those are the things that you really need to understand, because obviously looking at the value area, that's kind of a bigger picture. And then these 20 most recent bars, that's a shorter term. And is the shorter term going to be able to break away from the
longer term?
Yeah, from the longer term, or is it going to be sucked back in?
Right. So there's an interesting conversation, not that we really have the answer yet, but you're always sort of measuring process, that's the present moment, the process against the structure, which tends to be the background. So things to think about when you're trying to read the particular mood of the tone. I think that's your term, right? The tone. You want to measure are the people who have this particular position getting what they need, and are they happy with it?
Yeah, and so we got 1 minute left here. So I mean, I think the whole idea of coactive timeframes is what we're talking about here. But I think this whole presentation we've been doing, I think this 5 or 6 sessions is just the purpose is to kind of get you all up to speed on what is the market profile, just on a very, very, very basic perspective, and just understanding the auction process, understanding details or minus development, understanding markets go from balance to imbalance. I think those are the general ideas you need to pick up on in order to become at least a student of market profile. And then obviously the screen time you spend, you can hone your skills and become more proficient. And I don't do anything that you want to add, Chris, to that?
Yeah, the difference between where price is accepted and where there's no development or minus development are 2 completely separate strategies. So just be aware of that.
Yeah. Okay. Well, I think we're probably going to time out here. So we appreciate all your attending.
Thank you. Right.
Yeah.
Go find Steve or go get his book.
Yeah, read the book and start on the progression of market profile, and I think it'd be a worthwhile endeavor for everyone.
Wait, so Steve, you said you know some of the turtles? Well, that's interesting. Chris, do you know any of them?
They're mostly out of Chicago. There were many other groups. I was taught by a guy in Market Wizards under the same sort of program, and that happened frequently on the exchanges. Like you, in a sense, now are a turtle, you guys.
That's cool.
He actually decided that he had gone, I think Richard Dennis had gone to a turtle farm and saw all these little baby turtles, and he's like, I'm going to teach people how to trade. And so the successful ones who made it were called the turtles.
Okay. Yeah, I remember when I read that in the market, because I read the Market Wizards books. I don't think you've read it, but
no, I haven't.
Super interesting, and I remember being actually absolutely fascinated when I came across that chapter about the turtle. So it goes Chris again. I'm just so curious, where are the turtles at now?
Oh, some of them. I mean, that was in the 80s, so some of them are still involved in the market, but a lot of them are retired. And lots of people, when they make lots of money, they do things. They're managing their own money possibly, but they're no longer in the public eye, and just have a home office and just kind of really trying to keep a low profile. Like a good friend of mine, he's one of Richard Dennis's best friends, and just I hear stories, about what he's doing, and I mean, there's all kinds of stories. Markets change, and that's if you could track trend followers, that sees a trend follower, you could go back and I would say the last 3 years, there's a Barclays, and there's all these different reporting services that track different CTAs, and they're all categorized, right? How they trade and things like that. And I would say that maybe the last 3 years, for sure, maybe the last 4, the trend followers have done well. Prior to that, the previous 10 years, they did just terrible. So I think that was Richard Dennis's, he did real well when markets were trending, and he continued to trade that strategy. And then, there's stories about him, taking funds from a Japanese bank, a big, back then a big CTA might be $300,000, $400,000, $500,000, or pardon me, $1 million. And he took that, and unfortunately the conditions for trading weren't conducive to his trend following strategy. So he lost half of that in 6 months or a year. I'm just talking about Richard Dennis did real well early on, and then he took on a big account at Japanese Bank, as I recall, and the market was not trending or conducive to his strategy. And then the story goes that maybe a $500 million account or fund, he lost 50% of the the value of it, and that's just the way markets work, really.